다시 찾은 hope in us. I'm feeling you so let get in mood. 매 순간마다 내 마음을 보여주고 싶어. Let me get it for you. Alright, got it for you. 리본에 풀어봐. We're gonna have some fun. 자 이제 새롭게 다시 시작해. Here we go. See a better version of myself. I'm like a feather. Now I feel so light. 무엇을 원해 뭐든 다 줄게 for sure. I'm reborn. Now I've come back to my spot. 두 눈을 감으면 I feel so right. 무엇을 원해 I got you 놀러 갈래 you. 안 너라면 어디 가도 let's go boom boom. 두 눈에 담긴 서로의 모습 마치 feels like a diamond glow. 다시 찾은 hope in us. I'm feeling you so let get in mood. 매 순간마다 내 마음을 보여주고 싶어. Let me get it for you. Alright, got it for you. 리본에 풀어봐. We're gonna have some fun. 자 이제 새롭게 다시 시작해. Here we go. See a better version of myself. I'm like a feather. Now I feel so light. 무엇을 원해 뭐든 다 줄게 for sure. I'm reborn. Now I've come back to my spot. 두 눈을 감으면 I feel so right. 저 깊이 찬란해진 푸른 저 하늘 위로. I'm reborn. I wanna go, just wanna go. Feels like I go back to 7 years old. Yeah, I gotta do it. I'm gonna feel it. I'm gonna do it. Whatever I wanna do. Let me hear you say, oh, you got me, you got me. Oh, oh, yeah, 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 yeah. Baby, I want you to stay. Yeah, I gotta do it. I'm gonna feel it. I'm gonna do it. Whatever I wanna do.
पापा मम्मी के लिए बेस्ट गिफ्ट कारवा मिनी।
काजे जादव जी का विचार बा? हम रौरा हाथ में आवे वाला नहीं खे।
जाने हम बारूद हैं बारूद। हमें छूने की कोशिश करोगे तो जल जाओगे।
गुंडा कर दे बाबू तोहर चले नहीं।
अच्छा
मिली ना ऊंची झवा जवन तोहरा चाहे।
देवे के पड़ी। अरे सीधे सीधे मनबू की
अरे पूरा इंडिया हिली बाबू, खाली तू देखत जा।
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between governments and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
This is Bloomberg Daybreak Europe. I'm Menace Cranny in Dubai. Danny Berger alongside me in London. 4 of HSBC's most senior bankers in the US are leaving the investment bank, all part of the overhaul of its New York operation. Bloomberg understands that the head of debt capital markets for North America is amongst those departing. The changes come as HSBC is planning to revamp global banking business in Americas to better serve Asian clients. Joining us now is our senior editor for Asia Finance, David Scanlon. Dave, good to have you with us. So great work on the scoop. But how does it fit into the bank's pivot to Asia?
Well, it really reflects where the bank is going, Manus. As you mentioned, these are 4 very senior bankers with about 6 decades of combined experience. And, you know, bankers want to be where the action is. They want to be where the bank is growing. And HSBC has made it very clear that's not going to be in the United States. It's not going to be in Europe. It's going to be in Asia. Those are their roots, but also, you know, their future. And so in particular in Hong Kong and China, that's where they're putting their resources. That's where they're hiring. And that's where they're putting, really staking their future in terms of future growth.
We also have some reporting on this Wealth Connect plan, so linking investments between Hong Kong and China. HSBC, Standard Chartered seem interested in it. Why exactly?
Well, again, this is part of the pivot, and this is a very big deal. Potentially, for the first time, you're going to have investors on both sides of the Hong Kong-China border being able to invest in their own markets. That's a very big deal in China, where investors generally have restrictions, capital flows, currency controls. So this allows them to buy into Hong Kong, and so it's not surprising that HSBC and Standard Chartered are hiring a lot of people to try and get a piece of this pie.
David, thank you so much. That's Bloomberg's senior editor for Asian finance, David Scanlon. Now, coming up, Brent continues to rally amid signs of a rapidly tightening market. We speak with Trafigura's chief economist on the possibility of hitting $100 a barrel. It's all about the Benjamins. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Good morning from Bloomberg's European headquarters. It's 6:30 a.m. in the city of London. I'm Danny Berger with Manus Cranny live from Dubai. This is Bloomberg Daybreak Europe. Here's what you need to know. Jay Powell reiterates he sees inflation as transitory. Another thing that's transitory, the markets pivot away from the reflation trade. Treasury yields bounce as stocks claw back losses. Sooner rather than later. That's what the Fed's Robert Kaplan wants to start tapering. James Bullard says be ready for inflation to go higher. Plus, Brent topped $75 a barrel for the first time in over 2 years. We're joined by Trafigura, which says oil could hit $100 a barrel. Manus, good morning to you. And we've had a lot of Fed speakers already. We're getting more. You have to wonder, what do they need to not say in order to not spook the market? Kind of that do no harm sort of mantra, I'm assuming would be for Powell as he heads into testimony today.
Yeah, I loved your word from 6 a.m., so I'll rob it from you. The dissonance. I think you lean into the New York Fed. They vote. Kaplan doesn't vote, nor does Bullard. Powell sent his testimony. Can he unseat? The bond market whipped around, Danny. Let's get straight to the markets. Equities are higher. Goldman says more money's going to wash in. WTI is rising. We move to the August contract on the front foot. 10-year government bonds still sub 150, but we made a 14 basis point whip around yesterday in the bond market yesterday. Third biggest one-day move in 2021. I'll show you what's going on in Europe. European stocks are higher. The dollar is managing to, I suppose, just yesterday's move was perhaps one of the biggest, or the past 3 days, one of the biggest weekly moves that we've seen in 5 years since Brexit. So there you go. And Bitcoin regains its footing, $32,600. Now to the oil market, it hit $75 a barrel for the first time in 2 years, Danny, as you say, amid signs of a rapidly tightening market. And the benchmark has rallied by more than 40% this year. You got a strong rebound from the pandemic in the US, China, and Europe now underpinning the increase in fuel consumption. The market continues to firm. The bullish structure. The time spread, it's the widest backwardation in 7 years. Let's take the backwardation to our guest, Saeed Rahim. We've only seen this backwardation. This is tight as she can be, over a buck. We've only seen it twice, and on each of those occasions, it made $100 oil. Said, your CEO calls $100 oil. When will we hit $100 oil, and is the market tight enough to achieve that?
Well, thank you for having me on. I think, as you say, the current structure of the market is absolutely telling you that the market is hungry for oil. We've moved from a situation where the recovery really was China-led, manufacturing-led, and goods-led, and now we're moving into something that is more U.S.-led, Europe-led, is more services-led, and more experiences-led. So as everyone is out there hitting the road, taking to the skies again, you are seeing a very strong demand recovery. And I think that some of the real issues that were in the market, we were talking about the three big I's: India, Iran, inflation. India has really started to recover there. You're starting to see demand and mobility indicators start to pick up. Iran at least seems to be absorbed by the market. And then, of course, we've had all the talk about inflation, but even that seems to have been absorbed by the market. So now going to where do we think we could hit $100 oil? For us, this has really been a question about structural underinvestment that you've been seeing now since 2014. So this is now going on to the better part of a decade. And to me, this is something where the market is slowly realizing that even with all the spare capacity that OPEC currently has off the market, that eventually you're going to be in a situation where demand has not only recovered, but is stronger than where it was. And you don't have that capacity anymore that you really need, other than maybe as a little bit of a buffer. And in some sense, it's going to be like Hemingway said about bankruptcy, which is it's going to happen gradually and then suddenly. And all of a sudden, I think the market is going to wake up and realize, we have lost significant production from a lot of the smaller producers that people don't talk about, Angola, Mexico, Colombia, Vietnam, just to name a few, and that production really needs a much higher price, not just in the front, but in the back to incentivize new production to start to come on.
If I can push you a little bit on that, can we get a little bit more specific? When do you think that kind of environment is going to be put in place? It's going to happen gradually, but is it going to be next year? Is it 2 years from now? Is it 5 years from now? When do we get exactly that $100 barrel in oil?
Well, I think the demand recovery that we're looking at, I think the amount of stimulus that's gone into the system, and I think the liquidity that's there, I think it is something that you could see potentially next year. Assuming, we don't see real movement on rates or anything else to really slow this economy down, it is something where you will quite quickly, I think, run out of spare capacity as that demand recovers back to pre-pandemic levels. So, given the conditions that we were seeing, given how quickly, frankly, we've come from $35 back up to $70 to $75, this is something that you could see in the next maybe 12 to 18 months. But again, it has to be really conditions have to be right for that.
Okay, let's talk about what OPEC Plus would do in the face of this. We're going into a meeting next week. We know His Royal Highness Prince Abdulaziz bin Salman likes to keep traders jumping on the floor, ouching, I think he said, just over a year ago. So do you expect, with this narrative that you just said, which is services, the eyes are being absorbed, we're moving off the manufacturing into services and travel, do you think that OPEC will return barrels more quickly than we have currently penciled in after this structure that they've announced for July?
I think they're happy with the pace of the recovery right now, and they're happy with where prices are. And again, we're not talking about $100 coming in the next couple of months. There is still, again, that spare capacity out there. We are seeing more barrels come into the market, but certainly this backwardation, the structure is telling you that the market wants more barrels from OPEC. So I think this gradual pace that they're bringing on, I think, suits them very well. What they may do instead is to look at their official selling prices, right? So really to raise the prices for their customers and test really the demand waters and see, is there demand at these higher price levels, in which case that's telling you that the market is saying you can increase production a bit more quickly. Now, some of this will also depend on what's happening with Iran. If there is more progress towards a deal and barrels may be coming on sooner than OPEC is thinking today, then there maybe have to be some adjustment to account for that. But again, given the strength of the market, you could suggest perhaps that at least a gradual return of Iran might be able to be absorbed by the market to some degree. So I think OPEC is in a sweet spot right now, really, with regards to bringing on production back more slowly. And you're not seeing a recovery out of the U.S. in particular, which may be the other concern, as prices have moved up to the levels that they have.
To what extent should the market be pricing in return of Iranian crude into the market?
I think most market observers and participants are penciling in some form of return of Iranian barrels, likely more in the late Q3, Q4 timeframe. When there certainly seems to have been quite a bit of progress on the talks, but there may be plenty of room still between the parties that we're not aware of. But right now, I think most participants would say, look, we're expecting some of these barrels to really start to come back into the market. And frankly, even earlier in the year, we've seen some barrels already moving east out of floating storage and things like that. And the market has been able to absorb that, right? So this is really something where you can dial this up, dial this down, depending on where you think the market conditions are. And given where we think travel is getting to, where not just gasoline demand, but also now jet recovering in a way that I don't think many people had, you're saying this is not something that I think is worrying the market as much as it was a few months ago.
Yeah, could you imagine what happens if they actually get around to getting rapid testing as you go to get on a plane? That would be
right.
That's actually when you radically shift. For me, that's when you radically shift and you talk about much bigger product demand. Saeed, let's pivot to the global commodity super cycle. I know that you as a house call a slightly longer cycle than we are. But where are we on copper? We see the Chinese stepping into the market, trying to take the heat out of this ratchet higher in hard commodities and soft commodities. You would say that we need a better incentive price for copper. What do you make of the Chinese stepping in, and what is the incentive price that brings on more production?
Well, I mean, I think, if you're looking at this from the Chinese perspective, certainly it's been successful in terms of jawboning it down, right? We were at $10,700, and now we were looking like we were going to threaten $8,700, a couple of days ago. So certainly that price has come off a lot. And we saw it in China. You could see the physical market weakening, as buyers were holding off purchases. As working capital requirements went up, you had to get authorization for higher spending, et cetera. From places like the state grid, even the army, in the metal that they were using, you were having to see them go back and get more budget, basically, right? And you could see the ARB into China really closing. So the metal wasn't moving. The structure there was in contango, or is in contango, as opposed to the backwardation that we're seeing in oil markets. So again, it was telling you that there was a bit of physical weakness there. But this, to me, really, this is a short-term story, right? This is just allowing a little bit of a pause, a little bit of a breather. You've done a lot since the start of the year, let alone since the bottom last year. So this is really time for the market to adjust, take a breath, before you really come back into the second part of this year. Part of it, again, you can see what's happening in the U.S. as, tight housing inventory has led to a slowdown in sales, tight lumber markets have led to an increase in prices, et cetera. So that led to some loss of demand there as well. Chip shortages impacting auto production globally. So all these things have been factors in weighing markets down in the front right now. And then, of course, what we've had, with the dollar move and the Fed the last week or so has absolutely exacerbated that. But if you look beyond the next couple of months, you absolutely still need that metal, right? The state grid is still going to have to come back and buy more metal towards the end of the year, but they're doing it at a position where now it's, $1,000, $1,500 less than where it was earlier. And nothing has changed in terms of the demand coming from the energy transition. You still absolutely need that metal. And for that, you need, as we've discussed before, a much higher incentive price in order to incentivize those mines and that supply to come on in time.
Does that mean that your head of copper trading's call of $15,000 in the metal, does that still stand given perhaps this only short-term pressure on copper prices?
I mean, absolutely for us, right? We're looking at that saying, this is really where you need to get to in order to bring on these supplies. Otherwise, you are looking at a sizable deficit. And as I've said before, really, copper isn't something that you substitute away from. It's what you substitute to when you're bringing in renewable power, electric vehicles, electrification of the grid, all of that. And so it's not something that you can really replace, and you have to bring on new supply. The problem is the time it takes to bring on new supply, which is something like 7 to 10 years. And we've seen it, right? With prices even above 10,000, 10,500, you have not seen the new projects that you would have expected start to be, FID to get approved and to move forward. So, this is telling you, again, the market's telling you, look, we need to be much, much higher from here in order to give, corporate boards and shareholders and everyone else the sort of confidence that this demand will be there and these prices will be there if they start to bring on mines that won't be online for quite some time.
Well, when we get to that $15,000 level or that $100 level in oil, we're going to have you back on. Saeed Ram, Trafigura's chief economist, thank you so much for joining. Now let's get to the First Word News with Laura right here in London. Good morning, Laura.
Thanks, Danny. The US says 150 Americans, or over 45% of the population, have been fully vaccinated against COVID-19. However, a study reports the highly contagious Delta variant is spreading in southern states, which have lower inoculation rates than the rest of the country. India, meanwhile, vaccinated 8.5 million people yesterday, a new record. Several large Chinese banks are said to be restricting credit to China Evergrande Group amid mounting concerns about the developer's financial health. Sources say 3 banks with billions of dollars in combined credit exposure to Evergrande have decided not to renew its loans when they mature this year. In a response to questions from Bloomberg, Evergrande denied lenders were curbing access to funding. ExxonMobil is said to be preparing to cull white-collar jobs at some U.S. offices. Bloomberg has learned a performance evaluation system will be used to identify low performers and to cut 5 to 10% annually for the next 3 to 5 years. Exxon had 72,000 employees globally at the end of last year, 40% of them in the U.S. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Malice, Danny.
Laura, thank you very much. Laura, right there.
think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Daybreak Europe. I'm Manus Cranny in Dubai. Danny Berger alongside me in London. Now, to the future of work and a big statement by Bumble, the dating and relationship app temporarily closed the offices this week, giving its employees, 700 of them, a much-needed break to recover from COVID burnout. So, Danny, the question is, what do you do if you've got a week off and, well, you're on the search?
That's a great point. Definitely, I don't know, I feel like there's some sense of irony of an app that you can use 24/7, having their offices shut down for a week. But, you know, it is, I've only been here, of course, for 2 days now in the anchor seat, Manus, but I just want to propose to you, I don't have burnout, but maybe we just do a week broadcasting live from Fiji or the Seychelles. Just going to throw that out there.
I have no problem with that. I think maybe the person that owns this company, the person that runs our newsroom, might have a different thing, and they'd say, what are you doing on Bumble? What are you doing on other dating apps? Shall I get terribly tawdry and say Jeffries have a stock outperformance? You want to know why, Danny Berger, on Bumble?
Why is that?
Guess why they've got an outperformance on this stock? Because of vaccination rates, Danny. You got your double vaccine, you're locked, you're loaded, you're ready to swipe, you're ready to go. What's swiping? Do they swipe on Bumble? I don't know.
I don't know, I don't have it. I'd assume that they do, but you know what my hot take is that eventually these work perks, they're temporary. Eventually you're gonna have to start paying people more to combat burnout. That leads to wage inflation, brings it back to Fed Powell. Someone should ask him about Bumble in his testimony today. Just putting it out there.
Absolutely, but the question is, of course, is it baby boomers who want us all back in the office? What do the millennials and the next generation want? Let's stay with this thing, because the whole focus now really is about the global return to the office, Danny, isn't it? 15 months after the first lockdowns, many of the world's key financial centers really struggling to kickstart the comeback. New York, Hong Kong, the picture differs widely. Steve Aarons joins us from Frankfurt. Steve, how quickly are workers returning to the office? In London, they had to delay by a month, and the banks are getting, well, itchy.
Yeah, so they over here. It's true. People managers want their staff back in the office because it's been shown that, you know, as you call it, this COVID burnout, people after a while lose productivity if they're just in the home office. So people really, companies want their staff to return, but it's tricky. In Germany, vaccination rates are lagging behind the UK and the US, and therefore it's just not possible. Though there will be the government will lift a restriction at the end of this month, so in a few days, really, that will allow people to return, and we'll see how that then affects the return to office over here.
So assuming that you do get that allowance to be able to go back into the office, what are the big obstacles that remain? Because presumably it still can't go all back to normal, even when everyone's sitting at their desks again.
That's right. I think one of the biggest right now is the fear of the Delta variant catching on in Germany, too. As you just pointed out, the UK has delayed the return to office. And the same could happen in Germany. I mean, as I said, the vaccination rate here is lower than in the UK. So presumably the Delta variant could spread even more easily once it's fully here. And that could lead to a big delay if that happens.
I'm sure a lot of those executives, especially at banks, are not hoping for that. Stephen, thank you so much. That's Stephen Aros in Frankfurt. And you can read that full article on the terminal. Type NI Big Take. Coming up, talking Bitcoin. The original crypto has lost roughly 40% over the past 2 months. What do chartists and analysts say? They're turning to a sinister sounding technical signal. It has to do with death and a cross. This is Bloomberg.
এসো বাবা স্কুল যেতে হবে
No, মামা স্কুলে যেতে হবে না ফোন করতে হবে
এসো 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 বাবা দুধ খেতে হবে
No, মামা দুধ খেতে
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
This is Bloomberg Daybreak Europe. I'm Danny Berger in London with Manish Krani in Dubai. Now, Bitcoin, it's holding above $32,000 as China's cryptocurrency crackdown is now stoking fears of a deeper sell-off. The original cryptocurrency has lost about 40% of its value over the past 2 months alone, and chartists and analysts are turning now to a sinister-sounding technical signal. Joining us is Bloomberg's cross-asset team reporter, Eric Lam. And Eric, I guess technicals are just so important at this point because it's really difficult to judge Bitcoin based on fundamentals, isn't it?
Sure, and you bring the focus that the industry has been taking a look at over the last few days, and that's Bitcoin making a death cross when the 50-day moving average crosses with the 200-day moving average. And that actually happened a couple of days ago, and the price has been fairly weak since then. But for sure, in the absence of any earnings or other traditional fundamentals, we are left often to take a look at technical indicators like that.
Well, that death cross gets written up a great deal, but it's now actually happening there. Oh, there's it's a thing of beauty, Danny Berger, isn't it? I wish you could see it here on the screen, Eric. But look, it comes down to supply, and I think Ben Amons at Medley Global contextualizes supply for me in China on Bitcoin. I mean, look, you got the China crackdown. What's the latest on that? And how should I think about a supply crackdown?
Well, first off, in China, the latest developments we have is that the PBOC, the central bank, held a meeting with some of the biggest banks and the payments provider Alipay, kind of re-emphasizing the restrictions on crypto trading and crypto services in China. Of course, these regulatory pressures have been around in China for a few years now. But over the last few months, we've been getting increasing activity and rhetoric coming from China in terms of a renewed focus on those crackdowns. So the concern, of course, is that we are going to get more crackdowns from here as China kind of tries to stamp out some of those loopholes in crypto trading. We've had a ban since 2017, but we still have plenty of trading over the counter in China. There's lots of activity there. Of course, also the Bitcoin mining and crypto mining industry in China is still very much thriving, but it's unfortunate, I think, a little bit that the crypto industry kind of falls afoul of those two main focuses of the Chinese government, one of which is stamping out volatility in financial markets, and the other being an increased emphasis on the environment and getting back to carbon neutrality. So it kind of falls afoul of both those things.
Eric, I'm afraid we're going to have to leave it there. Bloomberg's Eric Lam, thank you so much. Let's take a look at some of the things that we're going to be watching out for the day. In the UK at 11 a.m., Brexit Minister David Frost is going to be giving evidence at Parliament over the dispute on border checks on the Irish Sea. Then at 1 p.m. UK time, we have Hungary's central bank, and they're likely going to be one of Europe's first monetary tightening cycles. The plan there to rein in EU's faster inflation, Manus.
Yep. Well, they've all got a little bit of cover now from the Fed, perhaps. Look, this afternoon, Danny, Bloomberg presents day 2 of the Qatar Economic Forum. We've got the speakers from Glencore, the CEO there, Ivan Glasenberg, and the heads of the major oil companies, Total, Exxon, and Shell. So they'll continue that conversation. Can't wait to hear what Ivan Glasenberg has got to say. U.S. Secretary of State Antony Blinken meets the Chancellor Angela Merkel in Berlin. That's part of his European tour. And then it's all down to the Fed, really, isn't it, Danny? Jerome Powell testifying in front of the House subcommittee, and that's going to set the agenda for the Fed's pandemic emergency lending and the purchase programs. Mary Daly, Cleveland Fed, Loretta Mester. I could roll call on and on and on, but it is going to set the agenda for tomorrow morning, Danny, isn't it?
Yep, it certainly is. We're going to be listening to it, and that's it for us at Bloomberg Daybreak Europe. European Open is up next. This is Bloomberg.
This morning was a bit of a historic day. It was the first time Indigenous designers showcased at Australian Fashion Week, and it was a full house of all Indigenous talent.
It made me so proud. Absolutely beautifully done. I mean, the designers, the pieces on there, I think just about every model or every second model was like, oh, I want that, I want that. So each of my pieces, we have our signature prints, which are each tell a story and is definitely a contemporary way of experiencing Aboriginal culture. And then each of my pieces are named after, inspiring Aboriginal and Torres Strait Islander women. So when the customer buys something, they're learning about the story, they're learning about women. I would hope that it isn't tokenistic, and I would hope that it's not done to tick a box. And so, those things you have to be mindful about that. But I think it's incredible what's been achieved so far, but, there's always room for growth. I think the elevation of Aboriginal and Torres Strait Islander people in these spaces, it's long overdue, and it's a really powerful and incredible time, I think, and to be a part of that is really special.
Valuations, particularly sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Good morning. Welcome to Bloomberg Markets, the European Open. I'm Anna Edwards, live in London. Mark Cudmore, our Markets Live managing editor, joins me in Singapore to take us through all of the market action this hour. The cash trade is just less than an hour away. Here are your top headlines. Jay Powell reiterates he sees inflation as transitory as the Fed chair gets ready to testify before the House today. Equities continue to rebound globally. But Fed voices vary. Kaplan wants to start tapering sooner rather than later, and Bullard gets ready for upside risk to inflation. Plus, Bitcoin sinks closer to $30,000 after China intensified its cryptocurrency clampdown. Welcome to the programme, everybody. Welcome to the European Market Open. Tuesday morning, just gone 7 o'clock here in London, an hour away, just under, from the start of the European trading session. Mark's been watching what's been going on through the session over in Asia. And, of course, he joins us from Singapore. Mark, what are the markets saying to you?
Good morning, Anna. Well, we remain kind of in these yo-yo markets since the Fed meeting last week. Whatever happened in the previous 12 hours seems to kind of reverse in the next 12 hours. The big moves overall in the last few days have still been yields. We're generally seeing a bit in the dollar, but it came down last night. That's why it's slightly higher today. And overall, it's this idea that many investors are still grappling with what does the Fed meeting last week really mean? And that's in the context that we had some Fed speakers last night. We have Powell on the agenda. We have a host of Fed speakers this week that are expected to add clarity. Personally, my view is that the Fed doesn't want complete clarity. It wants that optionality of what to do. And that's why all the speakers this week might leave investors still grasping for exact concrete direction of what comes next.
Yeah, that's interesting. Yeah, maybe the introduction of two-way markets, different views, maybe that is all something we have to get used to. Maybe the Fed is not disappointed to see that. We'll think about that as we go through the next hour. We're just under an hour away then from the cash equities trading session here in Europe. So let's focus in on what futures are telling us. Mark's going to take us through where the Asian session has been, and we have seen a really strong rebound coming through there. Just as we saw heavy selling yesterday, we saw that rebound on Wall Street. That's working its way into the Asia session. And here we have European equity market futures. So expecting to continue a little bit of that upside. We got most of that yesterday here in Europe, but the US carried on. And so we have a little bit more positivity perhaps to factor in here. US futures also positive, but flat to positive. There we go. NASDAQ futures actually pretty flat right now. So in terms of what the GMM is saying to you then, Mark, I mean, it's a kind of mirror image of yesterday, at least from an equities perspective. We saw heavy selling, rotation out of reflation trades yesterday, particularly in the Japanese equity market, and today we see the reverse of that.
That's absolutely right, Anna. So two of those columns are pretty much a mirror image of yesterday. The equities column, as you pointed out, where Japan was leading losses yesterday, leading gains today. And then also in the commodities column, where we did have losses yesterday, now we're seeing kind of rises generally across the board. And in fact, oil is one of the more disappointing ones. It was one of the more resilient ones yesterday. There's two little discrepancies, very subtle ones, that are different from yesterday. One is yesterday, in fact, the last few days, the bond column has really been about this flattening in the curve. Now, we're no longer seeing that. Today, the bond column is all red. What that means is yields are rising everywhere, both at front end and long end. So it seems like we've had that clean out of the steepener trades that were in pre-Fed. We got that just intense flattening of the last few days. That's now kind of played out completely. Some of our guests thought it had played out last Friday. It turned out it had not quite played out by then, but it has by yesterday. And now we're generally seeing bonds suffer, yields rise. That is the signal from the Fed gradually for the second half of this year. The other subtle message is yesterday we were generally seeing yen and dollar strength and other currencies weaken. Today we're seeing the dollar higher, but the yen is weaker again. So it's going back into that, not just so much just pure risk aversion, we're just seeing dollar strength, a different kind of dollar strength, not just the haven bid. And again, I think that's likely to be a sustainable move.
Okay, so we'll keep an eye on that. But we have seen an incredible amount of volatility in fixed income markets, in government debt markets over the last 24 hours, haven't we, Mark? And so you mentioned how we've seemed to have settled into a bonds down, yields upwards path now across the curve rather than seeing the flattening of yesterday. But just to revisit the scale of some of these moves, I mean, 30-year down to 1.93, up to 2.11% in terms of yield, the 10-year down to 1.35, up to 1.5. So where we've settled now, do we think we've settled into a pattern that is going to more gradually and more calmly start to factor in a slightly more hawkish Fed rather than the volatility that we saw over the last 24 hours?
I think that's correct. There's no way this volatility is sustainable. It really is notable. So the MOVE index, which is an index of Treasury volatility, has jumped from I think around 55 on Friday up to the mid 60s, and I think we're in a new higher range for that. I think interest rate volatility won't reach the depths that it had at the end of last year. I think that for the rest of this year we're in slightly higher interest rate volatility, just not like we've seen in the last couple of days. I do think that overall this idea that it's not so much that central banks or the Fed or any central banks are suddenly hawkish. It's that they incrementally have the possibility to be less dovish. Now that might sound like a real qualifier, but it's a big change. Before, you knew that the reaction to anything is the Fed will be dovish. The Fed will be dovish. There was no doubt. It was certitude. That has now gone. Now, the Fed might be dovish in reaction to something, or it might be slightly less dovish. Either way, there's a new level of uncertainty, and that means a higher level of volatility, and slightly higher yields across the curve is probably the trend for the rest of this year, but not in any panicked way.
Yeah, it did seem interesting that we do still see, or we continue to see divisions at the Fed with regards to the labour market, and they're not necessarily papering over those differences anymore. Those differences clear to see. We got some commentary yesterday from Bullard talking about how he's not worried about the labour market. There's low unemployment to vacancies ratio suggests tightness in the market, and yet Williams saying he's much more concerned about the labour market. There's a long way to go on that. So I wonder once again whether we're going to be back to that data and looking at obviously inflation data and unemployment data has always been the heart of this. But you make the point this morning, Mark, that the reaction function that we see in markets to some of the data might become a bit less predictable.
Absolutely. I think all these data points are suddenly live again. Now that we know that the Fed, the reaction to everything isn't just that the Fed will take the most dovish interpretation. We don't know what the reaction is. It means we've actually got to think about what the data and how it might be interpreted. And I think particularly with labour data, as you kind of highlight, Anna, there are many different ways to look at it. And I think the job market, the labour market is changing significantly over time, but even more so that's accelerating, both with the rise of technology and how that's being used, but also the change in diversity in the labour force. So I think that kind of participation, the age change of the labour force, all these things make it harder to analyse because some of the historical comparisons just don't apply today.
Remember, you can stay up to date with analysis and insight from Mark and the rest of the Markets Live team. MLIV Go is the function to use on the Bloomberg terminal. Coming up on this programme, lots to talk about. We'll continue to think about where the Fed goes from here, but also think about cryptocurrencies. Bitcoin slides toward 30,000. The original crypto has lost roughly 40% of its value over the past 2 months as digital currencies face a crackdown in the world's second largest economy. We'll also talk about the Fed and liquidity, what impact that has. Plus, slow-going global financial hubs are struggling to return to the office. We take a look at the situation in different cities around the world and the impact on real estate in today's Big Take story. Up next, though, we continue the markets conversation. Sandra Flippen, chief economist at ABN AMRO, joins us. We'll get her take on inflation in the United States and unemployment. If you have any questions of your own for our guests, then please do forward those to us. IB plus TV Go is the function to use on your Bloomberg. This is Bloomberg.
healthier again as we're making progress in weathering the pandemic and achieving our goals to start adjusting these purchases, treasuries and mortgage-backed securities sooner rather than later.
There's upside risk to inflation, could go higher than what I've outlined here. And we have to be ready on both sides, I think, to be able to react to that.
Much of the consensus of professional economic forecasters in February was that we would have inflation just above 2% this year. We've already had more inflation than that in the first 5 months of the year.
It's easy to say that the Fed should tighten, and I think that they should. But I think you'll see a very sensitive market and a very sensitive economy because the duration of assets has gone very, very long.
A chorus of influential voices saying the Fed needs to be more attuned to inflation risks. We're joined now with analysis by Sandra Flippen, Chief Economist at ABN AMRO. Sandra, really nice to speak to you. I know you've been doing a lot of work on the European labour market, and we'll get to that in just a moment. But thinking about the US labour market, which obviously you also look at, I was struck by the divided commentary we saw in the last 24 hours from Fed officials around the labour market. Some very worried about the healing required, others less so, and thinking we've come a long way and that's not a big area of concern. How would you characterise the US labour market at this point?
Yeah, I mean, clearly the U.S. labor market is, for the U.S. inflation debate, is the epicenter of whether the Fed is going to do something about it. Because in the end, all the kind of temporary factors, everybody basically is excluding them. And then you look at the homegrown drivers, and the labor market is the key thing. But I think it really evolves around the question: is there a genuine shortage of labor supply vis-a-vis demand in the US labor market? And we've been looking at some data. We're actually still in this research right now, but it does seem that if you take the total employment plus the vacancies that are out there, it really doesn't add up to the total employment plus vacancies pre-pandemic. So we are still quite, even in the US, we are still quite some way off this really genuine supply shortage vis-a-vis total demand. Now, and if you start to look in the different sectors, you see this kind of same picture repeating. Now, the big question is, I think also in the US, but that is the same for the Euro area, is what's going to happen with the reopening of economies? Is there going to be sectoral shift, which also means potential mismatch in employment, which would actually imply that the general labor market statistics could be read in the wrong way? Because basically you can have vacancies and you have labor supply, but if it isn't a match, it's not going to solve, it's not going to create disinflationary pressure. So it's going to create inflation. Now, those are really nasty, detailed elements of the labor market that we really need to get into in these days.
So, Sandra, I need to kind of press you on that. You say that there's not, superficially appears to be labour shortage, supply shortage in the US. And therefore that would imply that you're probably in the transitory camp for inflation. But as you point out, it gets a little bit more complicated than that. So where do you kind of stand? Do you think that inflation in the US will be transitory? And if so, when do you think that we'll start gaining conviction in that view?
Well, so actually, I think that the underlying inflationary pressures in the US are not as big as some of these commentators are making them to be. So we're basically our base case is more on the on the little bit more moderate side. But that said, what could always happen and what could also lead to an overheating scenario is if inflation expectations by, for example, a misreading of temporary factors to be permanent factors, those kind of expectations could, of course, also become drivers of inflation in the end. And then the Fed will have to respond as well.
OK, Sandra, thanks very much. We'll be back with you shortly. Sandra Flippen from ABN AMRO. She stays with us. We'll get further thoughts from her on the European labour market shortly. Coming up, we'll be speaking to the New York Fed President, John Williams, later in programming. Don't miss that exclusive interview. That's at 2:30 p.m. UK time. Let's get a Bloomberg First Word News update. For that, here's Laura Wright.
Thanks, Anna. The US says 150 million Americans, or over 45% of the population, have been fully vaccinated against COVID-19. However, a study reports the highly contagious Delta variant is spreading in southern states, which have lower inoculation rates than the rest of the country. India, meanwhile, vaccinated 8.5 million people yesterday, a new record. The UK has formally started negotiations to join a trans-Pacific trading bloc as part of its bid to diversify its commerce after leaving the European Union. International Trade Secretary Liz Truss says membership of the group, whose 11 members include Canada, Japan, Mexico and Australia, would be a glittering post-Brexit prize. Hong Kong's Apple Daily newspaper may be forced to shut down this week, with parent company Next Digital blocked by police from accessing its bank accounts. One of the most prominent voices of the city's pro-democracy movement, National Security Police, arrested the paper's top editors last week. If funds remain frozen, a final print edition could be distributed this Saturday. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Mark, Anna.
Laura, thank you. Laura Wright in London. Coming up on the programme, a limited spillover. ECB President Christine Lagarde says rising US inflation will have only a moderate impact in the euro area. We'll discuss that next. This is Bloomberg.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
International spillovers from US inflation can be amplified if people in the euro area shape their inflation expectations also on the basis of developments in the United States. Overall, however, the effects on euro area HICP inflation are expected to be moderate. As the recovery is gathering pace, we need to remain vigilant and ensure that policy support continues to provide a bridge over the pandemic and well into the recovery.
That was the European Central Bank President Christine Lagarde speaking with lawmakers at the European Parliament. She reiterated her view that accelerating US inflation will have only a limited impact in the euro area. And Mark, I'm sure that is the received wisdom. And just looking at five-year inflation expectations for the Eurozone, the most recent direction of travel, well, certainly over the last couple of weeks or so, those inflation expectations have been coming down a little bit, as if there is this sort of, has been a de-anchoring perhaps with the US.
Absolutely, and I think Lagarde's comments are crucial because there are not very strong domestic inflationary pressures within the euro area. It's really how vulnerable the region is to the kind of global pressures, which we know are large. There's the supply chain elements and then the pandemic savings that are being spent. So it's both the demand and supply heating up around the world, but it's less strong in the Europe area. What I do worry about, though, is that whether the precedent for these spillover inflation expectations across the Atlantic works in this context of the new multimedia age, when everyone is reading about the massive inflation pressures in the US. So I'm slightly worried to be so definite on the complacency here, but it's important that if she thinks there's not that big spillover.
Yeah, absolutely important to get her take. Let's get the take of Sandra Flippen then from ABN AMRO, who's still with us. And Sandra, I know that you've been looking a lot at the European labour market, and so I want to go to that because I've been looking at charts of European unemployment, Eurozone unemployment specifically, and worth reminding ourselves that at the peak of the debt crisis in Europe, we got to unemployment rates across Europe that were up above 12%. And now thinking about where we've got to, of course, things look very different, and the support, the backstops put in place by central banks and others, very different here as well. There's a lot going on in that one chart there about unemployment then, Sandra. So what are your expectations for where this 8% or so heads to?
Yeah, so the interesting aspect here is actually that unemployment is not really telling the full story of the labor market right now, because a lot of people have basically in the Eurozone stayed employed while basically there has not been work. So that's the whole approach in Europe that is fundamentally different to the US approach, which is basically about fiscal income support to mainly the lower half of the income distribution. Now, in Eurozone, the fundamental difference is that balance sheets have been supported under the conditions of keeping people employed. So basically, what you see is that employment has been very much reduced. About 3 million people less at work, but unemployment has only increased with half of that amount. So actually, there is a large chunk missing, and that is for a very big part discouraged workers. So people who have basically they have withdrawn from the labor market, from employment, but they have not kept on searching for work because they thought, well, it's not actually possible. There is no work in my sector. So I'll just stop searching and do something else, start a study, go on a pension, whatever choices people have been making. But that is a huge kind of hidden part of unemployment in the labor market, which actually could re-emerge when economies reopen. And when that happens, you will see that there is actually a pretty substantive amount of labor supply, which also takes away those fears that vacancies cannot be filled, at least not the fears, not to the extent as we have been seeing in the US. It's really a very different story. You know, on top of the fact that in the Eurozone, the economic damage has been about twice as big as in the US. So it's really not a really comparable situation. And so I think talking about this is very important because Mark just said it. Those spillovers in terms of inflation expectations, they are dangerous. And that's why it's so important that we keep talking about this, why the underlying nature of the support, but also the amount of the damage and the response capacity in the Eurozone is fundamentally different.
Sandra, that kind of perception of the employment market, I think, kind of emphasizes your point that the inflationary pressures in Europe aren't that strong. But surely this lowers the growth potential of Europe longer term. In a way, we're hiding some of the real problems from the pandemic, and we're prolonging some of these kind of zombie companies on one hand, but also this kind of slightly deceptive picture of the situation. Yeah. No, well, I think that is, now you're really talking about the essence of the problem in the Eurozone, because the way the governments have been supporting the economy
is indeed putting a kind of a blanket over all dynamic processes in an economy and preventing like normal adjustments and normal dynamics in labor markets, but also in other facets of the economy. But the question here is now going to be what's going to happen with the reopening, because at some point we will get to the stage, and Christine Lagarde also said it, support needs to be building the bridge the pandemic well into the recovery, she said. But the question is really what's going to happen to the unwinding of support? How fast will that be? To what extent are firms basically having a debt overhang, and could that cause a wave of bankruptcies along the reopening?
Yeah, certainly something to watch through the reopening. And it does also make you wonder how much residents of the Eurozone, and to a large extent the UK as well, our psychology around unemployment and what we expect from governments at times of high unemployment might be changed by this. We will no doubt return to this theme in the future. Sandra, thanks very much. Sandra Flippen, Chief Economist at ABN AMRO, thank you very much for bringing us your thoughts. Coming up on this programme, our exclusive conversation with Bridgewater's Ray Dalio. The billionaire investor says the Fed won't be able to tighten without upsetting markets. We saw a little bit of upset yesterday. Things a little calmer, or at least more positive for risk assets today. This is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the European Market Open. 7:30 here in London, 8:30 in Paris or Berlin. European equity market futures pointing to the upside. Mark, let's think about the correlation between various asset classes and what we're learning, what we're establishing post the Fed of last week. There seems as if there's still a lot of flux in markets. And as you were talking about at the top of the last hour, maybe there's still some uncertainty as to really what the Fed means, as to what the reaction function is going to be to various data points. But you seem to have established what you see as the relationship between the dollar and the US 10-year yield at this point. So what are you seeing here in the charts?
Yeah, and I normally avail of this slot to kind of take a slightly bigger picture, or step back a bit, or to draw attention to something that's outside the main radar. But today I'm doing the exact opposite. I'm focusing in very short term about the thing we're all looking at, yields in the dollar since the Fed. And what's been really, really remarkable is since the Fed, dollar has had a nearly perfect inverse relationship with 10-year yields. So as US yields have risen, the dollar has dropped. As US yields have fallen, the dollar has risen. Now this is quite counterintuitive. So here's your chart on your screen. The white line there is the Bloomberg Dollar Index, and the blue line is the inverse of 10-year yields. And it's slightly bizarre that they've suddenly had this very, very inverse relationship. Now, there's a couple of things going on here. Obviously, it's more important what's happening in real yields than the nominal yields, and it's also about the front end is the kind of bigger driver of currency market. And what we've had since last week is this kind of flattening of the curve, and that means actually we've had the front end rising as the back end has kind of dropped, and that's why it seems to go the opposite way to the dollar. But that's not entirely telling the picture, because it's just been too good a relationship. What it actually seems to be is this is where all the hedge fund pain was. And we've got a great Bloomberg story out in that today, talking about how basically just going into the Fed, hedge funds, speculative positions had overall increased their shorts in the dollar and increased their bets on a steeper curve. And that's been the two trades that have kind of really, really blown up. So you wouldn't normally expect the dollar and 10-year yields to trade quite so, directly inversely. But it's at the moment, it's all about pain in the markets. It's about risk aversion. It's about cleaning out those positions. So it's probably got another couple of days to go before we revert to more normal trading.
OK, something to watch then in the shorter term. Yeah, really interesting. I remember in the very immediate aftermath of the Fed last week, Mark, we were talking about how it had simply revealed just the positioning that we've gone into the Fed meeting with. And that's we're still seeing some of the overhang of that then. Economic Forum.
There's something like 10% of GDP stored in financial assets that's going to be coming out. And so it's likely that there's going to be a big pickup in demand, and that will probably raise prices significantly. And it also depends how you count for inflation, because like housing prices themselves are going up a lot, but rental prices are going down a lot. The big things I think are, and if you went to a 3% inflation rate or some bounce, that's not one of those things that gets me very nervous or very excited. The real issue is that we have a supply-demand issue of bonds, because we're going to have to sell a lot of bonds to those in the world who own bond inventories. And they have very low interest rates, negative real interest rates, and they're overweighted in U.S. bonds, and they're going to have to buy a lot more. And that is also coming at a time when Chinese capital markets, other capital markets are becoming more attractive. That creates a supply-demand issue that can create a monetary inflation, because there will not be enough demand to buy those bonds. And that means that it's likely that the Federal Reserve will not be able to taper or cut back, and might actually have to increase to prevent interest rates from going up. And that's a classic monetary inflation. So that's my bigger concern than just the spurt. I think for most of the world, the real question is, what are interest rates relative to inflation, and also what is happening with all this liquidity, because there's a huge amount of liquidity and negative real interest rates. And that means that it pays not to own any debt instruments, that pays not to own cash, certainly not cash, where you get no interest rate in an environment, like Larry says, of some amount of significant inflation. I think it'll be, let's say, in the vicinity of over 3%. So you get taxed at that rate in terms of buying power. And so when I look at that, I think you're going to see the continued inflation in other assets, and it pays to borrow a lot. I know, like to borrow houses right now, I mean, to buy, I'm seeing interest-only loans being made when there's basically no interest rate. In other words, you don't have to pay back your principal anytime soon. and and the interest rates are so low, so there's a lot of money being thrown around that way. Those are the things that concern me more, because you build up a bubble. You saw the reaction in the markets when the Fed just even hinted at tightening. I don't think they can tighten a lot without having a big negative effect.
That was, of course, the Bridgewater Associates co-chairman and co-CIO Ray Dalio speaking yesterday at the Qatar Economic Forum, powered by Bloomberg. His phone ringing, I think, in the background. Busy man in demand, giving us his thoughts on the supply and demand of bonds. Not enough demand for all of the US government debt that needs to be issued, so the Fed will have to, will not be able to taper as much as it perhaps wants to do. That was part of his view expressed there. Now, let's think about some of the things that are coming up on the radar today, things that are on our watch list, if you like. In the UK, Brexit Minister David Frost is giving evidence in Parliament on the dispute over border checks across the Irish Sea. Interesting to see some of the Irish newspapers this morning reporting that the Irish might want an extension of the arrangements that have been in place up until the end of June. We'll see where that one goes. At 1 p.m. UK time, Hungary's central bank will likely start one of Europe's first tightening cycles, if you're watching for the global central banking story. This afternoon, Bloomberg presents day 2 of the Qatar Economic Forum, with speakers including the Glencore CEO and the heads of the oil majors, Total, Exxon and Shell. This afternoon, US Secretary of State Antony Blinken meets with Chancellor Angela Merkel in Berlin as part of his Europe tour. She's been meeting a lot of leaders as well recently. And later, Fed Chair Jerome Powell testifies at a House subcommittee hearing on the Fed's pandemic emergency lending and its asset purchase programs. We've already heard a few of the highlights of what he will say with regards to the temporary nature of inflation. What else will the Fed chair say? Now, San Francisco Fed President Mary Daly is also speaking, and Cleveland Fed President Loretta Mester, both of those Fed officials speaking at events elsewhere. Let's stick with some of the events that we're watching out for then. And German Chancellor Angela Merkel and Italian Prime Minister Mario Draghi met in Berlin yesterday to discuss the upcoming EU summit. The two leaders emphasized the importance of cooperating on migration.
We touched upon some themes that will be discussed at the EU summit, particularly migration, and on this we will work together and help each other. This is the direction our two governments are working towards.
Meanwhile, Italy and Germany's recovery plans are set to be approved by the EU Commission today. Joining us now to bring us up to speed with all of this news flow from Brussels is Bloomberg's Maria Tadeo. Maria, good morning. So how in sync are Germany and Italy then in terms of policy? We saw this meeting taking place between Merkel and Draghi.
Yes, Anna, and well, you know, they're in sync to the extent that their two recovery plans, the one for Germany and the one for Italy, will be approved today. Of course, Angela Merkel and Mario Draghi, they've known each other for many years, especially when Mario Draghi was at the European Central Bank. Now, when you look at the policy, however, yesterday you had the CDU present their election program. It was your typical CDU program, which really emphasizes that fiscal responsibility and the debt break. But then a week ago, you heard from Mario Draghi call for more stimulus. So to that extent, you know, they're sounding different, but you would expect that, or you could expect that ahead of the German election. What is interesting, though, is that the meeting they had yesterday in Berlin, it focused very much on politics. It did not focus so much on the economy. This is Mario Draghi taking on a new side to this job as prime minister, and the real focus was migration. You know, this is a real touchy subject in Italy. There has been a perception in the country for many years that to some extent it's Italy that has to deal with migration inflows by itself, and there should be a much better redistribution system across the European Union. So that will be a very political subject for Mario Draghi to deal with in this European summit coming up later this week. And of course, the two did agree that to some extent Turkey will be key on that, but we know that in the past that has been a very difficult relationship with Erdogan, in particular when you look at migration and the inflows into Eastern Europe.
Good morning, Maria. And is this all part of Mario Draghi cementing his political position domestically?
Well, look, it's actually interesting. You know, when you look at the way that Mario Draghi has really just compressed all of the yields for Italian bonds. When you look at the Italian assets, there really has been a Draghi put, and there has been a Draghi rally to some extent, but it really very much depends on him being in office. There's a real debate, and we have a story on this on the terminal today in Italy about what his political future may look like. We always said that Mario Draghi didn't, at least publicly, have big political ambitions, that he was only taken on this job momentarily to just help with the recovery fund, but potentially, that could be extended until 2023. He could complete this full mandate, not as president of the Italian Republic, but actually as prime minister of the country, which does have the real executive power. So it'll be interesting to see next year whether Mario Draghi decides to stay put until 2023, or perhaps want to aim for that job for president of the Italian Republic 2022. It's very institutional, but doesn't have as much power.
Interesting one to watch there, Maria. Thanks very much. Bloomberg's Maria Tadeo in Brussels, thinking about the politics between Germany and Italy and Mario Draghi's future. Now, coming up on the programme, China has reiterated its commitment to a ban on cryptocurrency services, sending the digital token into a further tumble. They called in the banks, had a word with them about exposure and use of cryptos. Details next. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the European Market Open. 17 minutes until the start of equity trading for this Tuesday morning, and European equity market futures look poised for a little bit of upside at the start of trade. Let's get a Bloomberg Business Flash, the top corporate stories we're covering here at Bloomberg this morning. Here's Laura.
Thanks, Anna. Several large Chinese banks are said to be restricting credit to China Evergrande Group amid mounting concerns about the developer's financial health. Sources say 3 banks with billions of dollars in combined credit exposure to Evergrande have decided not to renew its loans when they mature this year. In a response to questions from Bloomberg, Evergrande denied lenders were curbing access to funding. ExxonMobil is said to be preparing to cull white-collar jobs at U.S. offices. Bloomberg has learned a performance evaluation system will be used to identify low performers and to cut 5 to 10% annually for the next 3 to 5 years. Exxon had 72,000 employees globally at the end of last year, 40% of them in the U.S. The company behind Soho House, a members club for creative industry executives, has filed for an IPO in New York. Membership Collective Group owns 28 clubs and 9 workspaces around the world, including the Ned, a vast hotel complex in the city of London. The company, which is yet to make a profit, says it plans to use the IPO proceeds to pay down some of its more than $800 million of debt. That's the Bloomberg Business Flash. Mark, Anna.
Laura, thank you. Laura Wright in London. Let's get the latest on Bitcoin then. We've seen ongoing volatility and some selling of Bitcoin. Digital currencies suffered losses after the People's Bank of China, the PBOC, summoned officials from the country's biggest banks to reiterate a ban on crypto services. Both Bitcoin and second-ranked Ether slipped on the news, with Bloomberg's wider Galaxy Crypto Index also dropping. Let's speak now to Joanna Ossinger, Bloomberg's Asia Crypto Czar, who was, of course, then very much focused on this story. Joanna, it seems we don't talk about fundamentals so much when it comes to cryptocurrencies. We talk about levels, talk about technicals. What are the levels we should be watching for then on Bitcoin?
Bitcoin is trading in around the 32,000 mark right now, and it's really been stuck in this 31,000 to 41,000 range recently. But 30,000 is a round number figure that's pretty key. It held as support in the May tumble, and so people are really watching that. If it drops through that, there could be a big air pocket down to, say, 20,000. And of course, if we see it go up from here, then you could get a little bit more momentum upward. But right now, 30,000 is the one that people are really watching.
Good afternoon, Joanna. And what does this mean for other cryptocurrencies at the moment?
Well, other cryptocurrencies are taking it actually harder than Bitcoin. Bitcoin's share of the crypto market is increasing again after it went down over the past few months. So Ether is down more than half from its record, but actually it's sitting at its 200-day moving average, and that seems to be providing a little bit of support right now. But other cryptocurrencies in general are taking it a little bit harder. You know, Dogecoin, Cardano, things like that are down a lot as well.
Joanna, part of this being driven by what Chinese authorities are saying about cryptos and, you know, reiterating their objection to them to a large degree. How much is China influential then in the crypto space, you know, versus Elon Musk, versus you know, other meme momentum? What is it that really drives crypto? Does the Chinese PBOC have the ability to drive crypto?
It definitely does. It injects a huge amount of uncertainty into things as to what China is going to be able to do. China has a huge amount of holdings, or people in China have a huge amount of holdings in crypto. So that is a big deal, and that's driving a lot of the pressure on crypto right now. But of course, U.S. regulations are a big deal too, especially there was some trouble with stablecoins last week. So the U.S. regulatory arena is a question mark there as well. And then, of course, what Elon Musk brought up, the environmental concerns. And actually, if miners leave China, some of that mining is pretty green, like hydropower in Sichuan. So it could actually make Bitcoin mining dirtier if it starts to leave some areas of China, which would fuel those Elon Musk-style concerns.
OK, yes, we always seem to be just one tweet away from some further volatility. Joanna, thank you very much. Joanna Ossinger, Bloomberg's Asia Crypto Czar. Thanks very much for joining us with the latest detail. Coming up on this programme, then, we'll look at your stocks to watch, including Boeing supplier Senior. The aerospace parts manufacturer is expected to reject a $1 billion bid. More on that M&A story next, then. This is Bloomberg.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European market. Open 9 minutes until the start of cash equities trading for this Tuesday morning here in Europe. And European equity market futures point higher, modestly higher. Let's get the individual stocks we're watching. Sam Unstead has a breakdown of the stocks we're watching. And we'll start with eyewear, shall we? EssilorLuxottica.
Yes, good morning, guys. So EssilorLuxottica have said they're reviewing options over the deal that they have to buy GrandVision, a Dutch eyewear peer of theirs. This is a deal that's been rumbling on for quite a long time, and this is likely to add a little bit of caution around that deal. Particularly, I think, watch GrandVision shares to see how those comments from EssilorLuxottica are taken, but then also watch EssilorLuxottica because this is a deal that's taken up a lot of the board's time over the course of the last few months.
Good morning, Sam. And you're also watching the UK Boeing supplier Senior PLC. Why are they in the news?
So Senior yesterday had a fifth bid in from them from a US private equity company. It's a company that actually has been talked about as an M&A target for quite a while. As you mentioned just there, they're a Boeing supplier, so they're quite well positioned for any kind of improvement in the air industry over the course of the next couple of years. We are expecting that they're going to reject that fifth bid as well as undervaluing the company. Where the shares go from there, we shall see. It'll depend on whether investors think there's another bid coming or whether they think this is the end of the road for the M&A story around Senior. Yeah,
maybe six-time lucky will become a thing then, Sam. Kingspan, this is in the construction materials, building materials sector. What's the story there? A trading update?
Yes, this is an Irish insulation supplier. This is a stock that's benefited enormously over the course of the last 18 months or so from US infrastructure spending, but also making buildings more energy efficient. So a lot of insulation companies have done very well. They are expecting their first half shares to rise nearly 50%. So very bullish outlook from them for the first half of this year. And then as more of that infrastructure spending flows through, it may well be that that continues through the remainder of the year. So this is definitely going to be a stock to watch this morning and for the remainder of the year.
Sam, thank you very much. Sam Unstead from our stocks team. Thanks for bringing us the stocks we are watching. So, Mark, just a few minutes to go then until the start of the European equity market session. I suppose it's interesting to think about where we've been on the sort of roller coaster of the last 24 hours. This time yesterday, we were, it seemed, rethinking all of those reflation trades. Now we're back to some of those reflation trades. Do you think we've just got a better sense of, yes, the Fed might have been at the margin more hawkish last week, but there's still a great deal of support provided by the Fed at this time?
I think that's right. I think people have come around to the realization that just because the Fed has made a tweak, they've not actually become hawkish, they've become less dovish. Now, you might say that the direction is same, but there is a very, very important difference. This is still a central bank that is pumping an immense amount of liquidity into the system. It was only last week that we saw their balance sheets exceed $8 trillion. The ECB has a balance sheet above $9.5 trillion. There's still immense liquidity out there. So that's why I think that the message from the Fed does mean that we'll get a stronger dollar in the coming weeks, does mean that we'll probably get higher yields globally in the coming months in a gradual fashion. So it's bad for bonds, but it's less clear what happens for stocks. Yes, there's a very, very marginal tightening of liquidity, but it's tightening from an exceptionally loose situation overall.
I wonder how much visibility you think you've got on the dollar then, because I know on the Markets Live team you've been talking about how dollar weakness will resume in the medium term, and harking back to 2013 and seeing what we can learn from other playbooks, other periods of taper tantrum. This isn't necessarily the same kind of taper tantrum, but we are talking about some hawkishness from the Fed. So what kind of dollar impact do you expect that to have then, given what you told us about the inverse relationship with yields?
So Simon Flint, my colleague on the Markets Live blog, has done this excellent analysis comparing to prior Fed shocks. Now, the last couple of times they're more like dovish Fed shocks, but he's still doing the mirror image. And he's saying, look, the Bloomberg Dollar Index probably has another couple of percent of upside, but ultimately it will peak out and the longer term, the multi-year bearish dollar narrative can resume. And I have a lot of intuitive sympathy with that idea. The underlying reasons for being bearish the dollar, the significant twin deficits, the deeply negative real yields, haven't suddenly gone away. They've just been put to the back seat for the moment as we squeeze out positions out there.
OK, Mark, thanks very much. Thanks for spending the past hour with us. I'll be back with the European market open next. Futures pointing flat to positive here for European equity markets. US futures deteriorated a little bit during the first half hour of the programme. Nasdaq futures now entirely flat. A little bit of upside down E-mini futures. We'll be back, though, with the European market open next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to the European Market Open. A minute to go until the start of cash equities trading for this Tuesday morning. Here are your headlines. The cash trade is just less than an hour away. And in focus, Jay Powell, in fact, the cash trade is right here and now. And in fact, in focus, Jay Powell reiterates he sees inflation as transitory as the Fed chair gets ready to testify before the House today. Equities continue to rebound. But Fed voices vary. Kaplan wants to start tapering sooner rather than later, and Bullard gets ready for upside risk to inflation. Plus, Bitcoin sinks closer to $30,000 after China intensified its cryptocurrency clampdown. Let's get a look at your futures as I struggled to tell the time this morning. We are just coming up to the start of the European equity trading session. We're not an hour away. It is 10 seconds away, and this is what we have for you this morning in terms of the futures picture. So we do see a little bit of upside, not a great deal, but things looking calmer than they did yesterday. This time yesterday we were negative, and we certainly dropped out of the gates yesterday, but then spent much of yesterday's session clawing back to positive territory and then into gains. And certainly we're expecting to see a little bit more upside today. US futures also pointing to a flat to positive open for US equity markets, as we've had another 24 hours to digest what it is exactly that the Fed means for inflation, for reflation trades and the like. So European equity markets opening up just 30 seconds into the trading day, and you can see move to the upside on the FTSE 100 and on the IBEX, both up by around 0.2%. So modest gains coming through, continuing really actually what was a positive session yesterday. So stocks in Asia have followed their US counterparts higher following Fed comments. Chair Jay Powell has reiterated he sees inflation as transitory. Meanwhile, other Fed officials called for the central bank to be more attuned to inflation risks. Let's talk about where the Fed goes from here. Karen Ward, JP Morgan Asset Management EMEA Chief Market Strategist, joins us now. Karen, it's obviously from a European point of view, European stocks point of view, really important to watch this Fed narrative because it seems to tie so much into reflation expectations or the reverse of reflation expectations, depending on which day we're talking about here. Today, we seem convinced that the Fed, yes, it's a little bit more hawkish at the margin, but it's only going to withdraw support very gradually. Is that where your focus is?
Yes, I think that's right. I mean, first of all, you're completely right. It feels like everything, all the decisions you want to make in asset allocation at the moment stem from where you think that 10 years going. So the growth versus value, the US versus Europe, tech versus financials, all of this really does hang on that 10-year yield. I think the message from the Fed is, as you say, it is time to take the foot off the accelerator. We have come a long way in the last 6 months in terms of the reopening, learning about the strength of demand coming out of the pandemic, but also learning about the success of some of the support schemes. In the US, the fiscal stimulus, in Europe, the labor market support. So basically, we're coming out of this pandemic in remarkably good shape. And I think, therefore, the central banks are right to acknowledge that. They're right to mention that the balance of risks has shifted and to ease their foot off the accelerator. But they're not going to be in any hurry. I mean, I think my interpretation is they will probably end up being too late and therefore actually be slower, but have to do more in the longer run.
And which are the assets then that are at risk? Because even if it's not going to be a hurry, even if the Fed is not going to about turn very quickly, Karen, we are still then we are now watching for where the talk of taper turns into the actual action of taper. Clearly, you know, the Fed has been buying treasuries, they've been active in the mortgage markets. Which are the assets that you're focused on then that have really gone too far with all of this generosity from the Fed and also, I suppose, from fiscal authorities?
Yes, well, I think it's going to create us some volatility and days where nothing does particularly well. I think we've seen already over the course of this year that, you know, when we have a miscommunication or a misstep from the Fed and we have a particularly large move in the 10-year, then nothing does particularly well in that period. And there are going to be days like that. I think we should just brace ourselves for that volatility and not lose our head. I think if we see this sort of sustained upward march, then it might act as a little bit of a headwind for some of the areas of the market that have really benefited from zero rates and flat curves. So I'm thinking here, some of the tech stocks, some of the growth areas of the market. They've still got very strong earnings, so I'm not desperately worried about what they do, but I think it will act as more of a headwind. And then on the other side, however, I think you're going to get those areas of the market that were the real losers of zero rates and flat curves, such as financials, really catching up, which supports the overall market narrative. So I think that broad markets will still be okay in a rising yield environment, but because the earnings expectations will be rising, but we're definitely going to have days where screens of red, and I think we should just not get too alarmed about that.
OK, so we brace ourselves for that. And you still believe then in this rotation into some areas of value. Karen, where is it that you see markets well supported by that theme? Is that a very much European trade?
Not just Europe. I think actually areas of US values still look attractive. I think the financials, I do think we're going to come out of this with central banks being able to get off the zero bound, even in Europe. It might take a little bit of time, but ultimately I think that those risks of negative rates, which have really plagued the financials, will recede. And I think we're going to have a credit cycle again. We're all focused on government debt, but we haven't realized that households have done a pretty good job of paying down debt in the last 10 years. So that's all going to support the financials. But I do think it will play to Europe's favor. Not only have you got some of the financials heavy, value heavy areas of the market in Europe, but I think Europe's really going to be one of the beneficiaries of the focus on sustainable investing.
Yes, we'll certainly get to that conversation shortly, Karen. Just on that, on the credit cycle, I mean, one of the features of the bank reporting season, certainly in the United States, was the fact that many people had more money than previously because of fiscal generosity to some extent, and so hadn't needed necessarily to go out and search for credit. Do you think then that goes away and we're back to another consumer credit cycle?
Yes, in time. And then I think on the mortgage side as well, I mean, housing markets are booming everywhere. I know earlier you were having the discussion about, is there just too much liquidity sloshing around the system? I think that the housing markets in the developed world, the fact we're seeing double-digit house price growth in many regions, is again, we're entering the early stages of a new housing boom. So that all supports lending growth as well. And you generally get consumer loans on the back of that later on in the cycle.
Karen, thanks very much. Stay with us and we will get to those conversations around green finance, green investing. Karen Ward, JP Morgan Asset Management's EMEA Chief Market Strategist. Thanks very much for your thoughts so far. Coming up on this programme, we'll also be speaking to the New York Fed President, John Williams, later in Bloomberg programming. Don't miss that exclusive interview at 2:30 p.m. UK time. Coming up, though, here, how can markets help the fight against climate change? We'll discuss a new plan by the IMF on carbon pricing. That's next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
welcome back to the European Market Open. Just coming up to 10 minutes into our European trading day, and things looking pretty mixed, actually. Flat across the Stoxx 600 as a whole. The FTSE eking out some gains. The DAX retreats a little. Let's have a look at some of the stocks that are individually then on the move, and indeed the energy sector, which is in focus. Let's start with Grand Vision, though. Grand Vision, the Dutch retailer, down by more than 8%, as you see there. EssilorLuxottica, the eyewear manufacturer, saying it's reviewing its options in the planned takeover of this Dutch retailer. Because of some legal changes, it's been made easier for them to walk away, so they are reviewing their options as it stands. Kingspan, a construction business, an Irish-based insulation business, they put out a trading update. The momentum they experienced in the first quarter passing through into the second quarter, so that's seen as strong news for that London-listed business. And the stocks, the energy stocks sector, you can see they're up by more than 1% as a result of, well, we've got slightly firmer prices for Brent. $75 a barrel is the handle there. WTI retreats just a touch at 73.53, but the general direction of travel in recent weeks has been upwards for oil prices as we head towards that OPEC Plus meeting. What kind of pressure will there be building next week for those big energy players to increase supply to the market? We will watch that with interest. Now, on to other matters green. And last week, the IMF proposed a carbon price floor as a mechanism to slow rapid climate change. The body now says climate change presents huge risks to the world economy and steps need to be taken to counter it. The carbon price floor would be or could be worked out for each country based on its level of development and is part of a range of plans put forward for discussion by the IMF. Let's get the thoughts on carbon pricing and other matters with Karen Ward, JP Morgan Asset Management's EMEA Chief Market Strategist. Clearly a lot of people's attention turning to investment opportunities in the ESG space, in the green space, Karen. And I wonder what you make of carbon pricing as a part of that. The IMF talking about a differentiated carbon price depending on the nation's level of development, either $75, $50 or $25. How much does carbon pricing factor for you into as an important market mechanism?
Oh, it's tremendously important. Certainly our opinion is that these factors, and not just E, but increasingly S factors as well. We're going to hear government coming out with lots of new policies and regulations in order to try and meet these environmental and social objectives. And as investors, we've got to have our toolkit ready. We've got to be thinking about how this is going to impact corporate profitability, because it will be meaningful. On carbon pricing, as you say, the companies that will be subject to higher carbon pricing, and I think this is going to be the topic of conversation at COP26 in November. It will be difficult to thrash out who's to blame as such. I think there's an international relations angle to this as well that we do need to keep an eye on. But nevertheless, I think we will see some movement on agreeing a common carbon price, and that is going to raise the cost for some companies. Now, I think many companies that are at the forefront of this are aware. So particularly you are seeing some energy companies with good transition plans in order to move towards renewables in order to escape this increase in costs. But then there are some that aren't. So as I say, as an investor, differentiating and understanding how this is going to impact profitability is absolutely essential.
Is this transition going to be broadly inflationary, Karen, given the amount of money that needs to be spent to allow that transition to take place?
I think in the short term, Anna, probably yes. It's a tough question, though. I think one of the things that's quite encouraging is if you look at the cost of sourcing from renewable energy, so whether that's the cost from solar, from wind, in the last 15 years, it's come down dramatically. So relative to the cost of some of these fossil fuels, it can in fact be cheaper for certain utility companies, for example, to actually set up new plants using renewable energy rather than traditional energy. So that's encouraging in terms of this not being, us having to source a higher cost source of energy and therefore being overall inflationary. But as you say, I think in the short term, it is going to require a lot of infrastructure to electrify our systems more broadly. We may be able to source that energy more cheaply from renewables, but we need to then change our infrastructure so that we're powering off electricity. And I think that's that investment required, as well as some of the bottlenecks and some of the technologies, the battery technologies, for example. It feeds into the metals and the commodities story that is obviously pervasive in markets at the moment. I think that probably does, in the short term, add to inflationary pressure.
We're going to see the next generation EU, the spending plans attached to that EU bond raising being approved shortly. Italy and Germany, I think, to be approved this week. Those spending plans, of course, will include a lot of investments that are supposed to be green, and infrastructure is part of that. Is the best opportunity, Karen, for this here in Europe? Are you waiting to see more detail about the US infrastructure plans? What's the assessment?
I think globally, I'm not sure I think there are certain companies in Europe that are at the forefront. They're sort of the current winners or the current leaders. I think Europe is more heavily domiciled. So 3/4 of wind turbine companies are domiciled in Europe, for example. So I think Europe does have a lot of the leaders worth looking at. But I think, honestly, Anna, the headline obvious green investment opportunities, the market's already there. And if anything, some of those valuations maybe look a little stretched. I think the opportunities really lie in going downstream the technologies. So perhaps not the wind turbine companies themselves, but who are the suppliers into the wind turbines? So I think it's not the obvious plays. We need to do our research on finding those opportunities, but I think they're abundant. But I think actually they are spread across the globe.
Okay, Karen, really good to speak to you. Thanks very much. Karen Ward, JP Morgan Asset Management's EMEA Chief Market Strategist. Karen will be continuing her conversation with us on Bloomberg Radio at 9 a.m. UK time. Let's get a Bloomberg Business Flash. Some of the top corporate stories we're covering today. Here's Laura Wright.
Thanks, Anna. Several large Chinese banks are said to be restricting credit to China Evergrande Group amid mounting concerns about the developer's financial health. Sources say 3 banks with billions of dollars in combined credit exposure to Evergrande have decided not to renew its loans when they mature this year. In a response to questions from Bloomberg, Evergrande denied lenders were curbing access to funding. ExxonMobil is said to be preparing to cull white-collar jobs at U.S. offices. Bloomberg has learned a performance evaluation system will be used to identify low performers and to cut 5 to 10% annually for the next 3 to 5 years. Exxon had 72,000 employees globally at the end of last year, 40% of them in the U.S. The company behind Soho House, a members club for creative industry executives, has filed for an IPO in New York. Membership Collective Group owns 28 clubs and 9 workspaces around the world, including the Ned, a vast hotel complex in the City of London. The company, which is yet to make a profit, says it plans to use the IPO proceeds to pay down some of its more than $800 million of debt. That's the Bloomberg Business Flash. Anna.
Laura, thank you. Laura Wright in London. Coming up on this programme, the European Commission is set to approve Germany and Italy's recovery plans. We'll get details of those spending proposals next. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
International spillovers from US inflation can be amplified if people in the euro area shape their inflation expectations also on the basis of developments in the United States. Overall, however, the effects on euro area HICP inflation are expected to be moderate. As the recovery is gathering pace, we need to remain vigilant and ensure that policy support continues to provide a bridge over the pandemic and well into the recovery.
That was the European Central Bank President Christine Lagarde speaking with lawmakers at the European Parliament. She reiterated her view that accelerating US inflation will have only a limited impact in the euro area, something that we talked about a lot in the last hour of this programme. Now, the European Commission is set to approve today the recovery plans put forward by countries including Italy and Germany. The German Chancellor Angela Merkel and Italian Prime Minister Mario Draghi met in Berlin yesterday to discuss the upcoming EU summit. The two leaders emphasised the importance of cooperating on political subjects such as migration. Joining us now from Brussels is Bloomberg's Maria Tadeo. Maria, so a lot to focus on today then with the approval of these budgets expected. We saw the two leaders then from Germany and Italy meeting. How in sync are they in terms of policy?
Yes, Anna, you know, it's interesting because Angela Merkel and Mario Draghi were meeting yesterday in Berlin. They've known each other for a very long time, specifically at the time where Mario Draghi served as the head of the European Central Bank. But now the dynamics are changing. Mario Draghi is now serving as a politician, and Angela Merkel is, well, on her way out, and Germany is facing a re-election. So the balance of power there, to some extent, changing now. It is interesting, too, that yesterday we heard from the Germans and the CDU put out their program in which, you know, they stuck to this very German line saying, you know, fiscal responsibility, the debt break, all of this should be in our manifesto, and it's something that we continue to defend. And it's just coming a few days after Mario Draghi, but also Christine Lagarde, as you play in that clip, said that there is still very much need for stimulus to get to a full recovery in Europe. Another thing that struck to me yesterday as interesting from that meeting between the two of them is that it wasn't just about the economy, it was really about the policy and the politics. And one of the big issues that we're going to see at the end of the week when European leaders meet here in Brussels will be about migration. And migration, Anna, as you know, this is a subject that in Italy is very touchy. It's a very sensitive topic. Italians do feel that to some extent they have had to deal with the migration crisis summer after summer almost by themselves. And Mario Draghi wants to put an end to that. You know, he wants to get some type of migration deal before this summer. Having said that, it does look like that is going to be very difficult. So I wouldn't really expect any breakthrough this week.
Right, so we'll keep an eye on that on the politics front. Sticking with Italian politics domestically then, Maria, is Italy starting to think about Mario Draghi being here for the long haul, whatever long haul means in an Italian political context? But how likely is it that he actually manages to stay for the full term as Prime Minister?
Yeah, well, you know, Anna, this is becoming a real conversation because, as you know, in 2022, the president of the Republic will leave that job. He says he doesn't want to run for another term, and there's a huge debate as to who is going to replace him. Now, of course, in the Italian Republic, the president does have power, but is seen as an institutional figure, especially relevant whenever there's an election and a new government needs to be formed. But when you look at the executive action and the day-to-day basis of politics, it is very much still down to government. The fact that the recovery fund is going to span out in a number of years until 2026 also means that perhaps Mario Draghi could decide to not go for that job and actually try to stay and complete a term until 2023. But this is a conversation that will really shape, to some extent, Italian assets, because you're looking at another year of Mario Draghi or potentially an election to come. So that will certainly be a key point.
Yeah, certainly something to watch when we think about how well he's respected by financial markets, I suppose, and what that maybe has meant for some Italian assets, as you highlighted last hour. Maria, thanks very much. Bloomberg's Maria Tadeo with us live from Brussels. Let's check out where we are on the European equity market session then, because this time yesterday we were seeing, well, we had seen a heavy sell-off and we were sort of pivoting back to a more stable level. Today, the European equity market picture looks fairly flat by comparison. The Stocks Europe 600 pretty flat. The FTSE 100 making some modest gains, modest losses, though, over on the Xetra DAX. And in terms of the handover into the US session, things look flat there, really. I mean, NASDAQ futures showing a little bit of weakness, down by 0.1%. E-mini futures and Dow futures, though, fairly flat this hour. And we have gone from that period of a rethink of the reflation trades to perhaps going back to some of those reflation trades and thinking, well, yes, the Fed might be hawkish, the Fed might be about to withdraw some stimulus, but it's not about to do it tomorrow, and it's not about to do it very quickly. So we'll watch that conversation with interest as ever. Coming up on this programme, we get back to the Qatar Economic Forum and hear exclusively from Alphabet's CFO, Ruth Porat, joins us. She'll be talking about Google's cloud business and the use of AI. That conversation coming up right here on the European Market Open. This is Bloomberg.
Being excluded from the workplace, especially when you've got skills and motivation and things to give, can have a really detrimental effect on people's well-being. They can become isolated, of course have the financial stress of not being able to support themselves. That might be their first entry into the broader community where you're building relationships with workmates, and so that's your exposure to culture and you're starting to feel like you belong.
Some people might need to practice their English more, they might just need just some practical experience in an Australian kitchen.
I have not from Australian friend now, but in the kitchen I have many friends.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Welcome back to the European Market Open. Half an hour into Tuesday's session. Things deteriorating just a little, perhaps. We are now unchanged on the CAC 40. The FTSE 100, though, keeping its head above water. And if we have a look at what's going on the sector breakdown, you can see part of the reason why. Anywhere where we have a heavy weighting to energy stocks might not be doing so badly today. And so as we see that the energy sector is the biggest gaining here in Europe, up by more than 1%, in fact, by far outperforming the next best performing sector, which is real estate. We have oil prices actually retreating a little bit, but maybe there's interest in this sector as an inflation hedge, as part of the reflation trade. We seem to be back to some of those themes after our doubts of yesterday. Technology, the worst performing sector today, down by 0.7%. Now, the former US Treasury Secretary, Steven Mnuchin, has given his predictions on America's economic growth at Bloomberg's Qatar Economic Forum.
I would say clearly in the foreseeable future, I mean, we could easily see 6 to 8% growth. I think the other area, and the previous panel commented on this, is the risk of inflation and how that plays out. Now, inflation is good for certain parts of the economy and very bad for other parts of the economy. So I do worry, as Larry Summers and others have said, that the chances are higher as opposed to lower, that this is ongoing inflation and that the Fed will need to adjust for that. I think in the interim, there'll be businesses that are growth businesses, high margin businesses with consumer spending that will do very well with higher inflation, and businesses with lower margins and high costs of labor are going to be concerned. So I think the inflation outlook is something that's going to need to be managed very carefully.
Well, let's talk about managing it carefully, because it appears that the Fed is coming around to the view that at least has to be concerned about inflation. That's what we heard from the Fed after the FOMC meeting. We heard Chair Jay Powell say we're paying attention now to inflation, even though they didn't take specific action. Do you think that what the Fed is doing, basically in indicating down the road they're going to have to tighten some, do you think that that's going to be enough to rein in the danger of inflation?
Well, I have a lot of confidence in Chair Powell, and we worked obviously very closely over the last several years. Clearly, what the Fed did last year during the pandemic really, really helped, and it was critical. So there's no question that the Fed needs to go into a period of normalizing rates and normalizing the portfolio. And I think the question is really how quickly they do that and how they do that in an effort to control inflation. I think the issue is that the Fed is being cautious. The Fed models, the Treasury models, economic models really are not very good at predicting, given the vast amount of fiscal and monetary response we had over the last year. So I think this is something that needs to be watched very carefully. And I do think the markets are underestimating this risk.
That was former US Treasury Secretary Steven Mnuchin speaking at the Qatar Economic Forum, powered by Bloomberg. And let's get a Bloomberg First Word News update. Laura's here with that. Laura.
Thanks, Anna. The US says 150 Americans, or over 45% of the population, have been fully vaccinated against COVID-19. However, a study reports the highly contagious Delta variant is spreading in southern states, which have lower inoculation rates than the rest of the country. India, meanwhile, vaccinated 8.5 million people yesterday, a new record. The UK has formally started negotiations to join a trans-Pacific trading bloc as part of its bid to diversify its commerce after leaving the European Union. International Trade Secretary Liz Truss says membership of the group, whose 11 members include Canada, Japan, Mexico and Australia, would be a glittering post-Brexit prize. Hong Kong's Apple Daily newspaper may be forced to shut down this week, with parent company Next Digital blocked by police from accessing its bank accounts. One of the most prominent voices of the city's pro-democracy movement, National Security Police, arrested the paper's top editors last week. If funds remain frozen, a final print edition could be distributed this Saturday. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura, thank you. Laura Wright here in London. Now, Alphabet's CFO Ruth Porat says the company is excited about their investments and opportunity in Google's cloud business. She spoke exclusively to Bloomberg's Eric Schatzker about the company's future in the digital world at the Qatar Economic Forum.
There has been a dramatic acceleration in the digital transformation trends that were playing out over a number of years have really been telescoped in, and you can see it in commerce, you can see it in content, entertainment, education, you can see it in telehealth, you can see it even in the way we're having this conference today and the way we all work. And I think one of the important points for everyone is that we don't see the clock turning back. We do see that these trends will continue to endure, and I think it's really important for each one of us to consider how we can embrace digital tools and technology to support both revenue opportunities and efficiencies in our own business. So, for example, and to your question, when we look at small, medium businesses, which are the backbone of economies, what we saw during the pandemic is 1 in 3 small businesses said they would not have survived if they did not have digital skills, because it enabled them to immediately pivot and find their customers where they were in the online world, to get them the information they needed to talk about things like delivery or changed hours. And so these digital skills were absolutely imperative for survival.
The race, I would call it a race, to deepen relationships with customers and consumers is a fiercely competitive one. What is Google doing strategically or tactically, perhaps, that is different from what your competitors, the Microsofts, the Amazons, and the Facebooks are doing that you think ultimately is going to play to your advantage?
You know, one of the main things that we're focused on is how can we stay close to our users and customers and provide them with the tools and skills that they need to be most effective as the world continues to accelerate in this digital transformation. And our ability to leverage differentiated AI has been helpful for all of our customers, for users. You know, people don't even appreciate how often they're using AI in every day. So for those of you who are traveling around the world and opening up now to more travels, when you look at natural language translation, that benefits from AI. When you're asking the question of how do I get to find a store near me that's offering the services or products I want, again, we benefit from AI. So on the user side, really critical. On the enterprise side, what we're really excited about is the investments and opportunity in our cloud business. And our cloud business really is benefiting from extraordinary data analytics, the AI behind that, and then we've brought in talent to focus on very industry-specific solutions. So, for example, in financial services, my old home, one of the key pain points was always the manual intensity around risk and risk analytics. We can leverage things like Know Your Customer or anti-money laundering with AI and data tools. So those are important, and we go to customers and it's like, here's how we can help either with revenue upside or efficiencies leveraging the tools that we have. Same across retailers. They're looking at how can they ensure that they've got the best supply chain management when we've all lived through what we've seen. And so again, the benefit of AI. So we're looking across the board. I would say the other element of it is how can we be most supportive to the communities in which we operate? And part of that is ensuring that we're working around the globe to provide digital skills training to people so that everyone can participate in this rapid digital transformation.
That was the Alphabet CFO, Ruth Porat, speaking with our colleague Eric Schatzker, talking about the way that Google differentiates itself. Coming up then on this program, slow going. Global financial hubs are struggling to return to the office. We take a look at the situation in different cities around the world. I'm here in London, live shot of Singapore for you. How are businesses around the world in some of these global cities managing to get people back to the office, or not just yet? We'll track that story next. This is Bloomberg.
Bloomberg Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television. Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Welcome back to the European Market Open. 41 minutes through Tuesday's session. Modest losses for European equity markets this hour, down 0.1%. Here's a Bloomberg Business Flash. Here's Laura.
Thanks, Anna. Global Foundries is to build a $4 billion chip-making plant in Singapore, slated to start in 2023. Choosing Asia for the site of its latest expansion, the US-based company joins rivals in growing capacity to help address a persistent shortfall for chips for everything from cars to smartphones. The move comes despite Biden's administration calling to bring semiconductor manufacturing back to the US. ExxonMobil is said to be preparing to cull white-collar jobs at some US offices. Bloomberg has learned a performance evaluation system will be used to identify low performers and to cut 5 to 10% annually for the next 3 to 5 years. Exxon had 72,000 employees globally at the end of last year, 40% of them in the US. Global banks like HSBC and Standard Chartered are ramping up hiring ahead of the Wealth Connect link between China and Hong Kong. The scheme will allow investment across the border and could open up more than $460 million in annual fees for lenders. HSBC is set to hire up to 400 people in Hong Kong, while Standard Chartered is looking at hiring or promoting 3,000 Asia wealth managers. The company behind Soho House, a members club for creative industry executives, has filed for an IPO in New York. Membership Collective Group owns 28 clubs and 9 workspaces around the world, including the Ned, a vast hotel complex in the city of London. The company, which is yet to make a profit, says it plans to use the IPO proceeds to pay down some of its more than $800 million of debt. Anna, I think if Matt Miller is a customer, surely there's some chance of them making a profit in the future.
Yes, I'm sure that's some kind of indicator. I've never seen in such places. Laura, thank you very much. Laura Wright here in London with the Business Flash. Let's stay with the workplace theme and focus on how the global return to the office is looking. 15 months after the first lockdown, many of the world's key financial centres are still struggling to kickstart the comeback. From New York to Hong Kong, the picture really differs very widely. For more, Bloomberg's Charlotte Ryan joins us now. Charlotte, this is going to be a headache for global businesses, isn't it? Because they're seeing such different patterns, such different underlying conditions in various geographies. What are we seeing in this return to work then? What's the story?
Morning. Yeah, so we're seeing, as you say, quite a different picture in different areas of the world, and a lot of hurdles to getting people back to the office in large numbers, whether that's, as is the case in London, a lot of concern around using the public transport network and whether that's a risk for infection. And then in other areas, you've got slow vaccination ramp-ups, which are slowing everything down. And in other areas, such as San Francisco, you've got a bit of a change in mindset where companies are thinking, well, maybe we don't need to bring everyone back to the office. And so, yeah, as you say, this is quite difficult to grapple with as a global firm with a very different outlook in the different cities of the world.
Yes. Yeah, indeed. So the pattern varies, the picture varies depending on where in the world you are. What are the big obstacles then? What are the big barriers to bringing people back? I mean, here in London, we talk a lot about the Delta variant and looking at the way that is growing in other places. We might not be alone for after a while.
Yes, I think the main hurdles are basically the speed at which the vaccination campaigns are rolling out, and then increasing concerns about these new variants, and particularly the Delta variant. So in London's case, we were expecting to have this full reopening in June, but that has now been pushed back to July as a result of concerns over that variant.
And we've also done a focus. Obviously, you mentioned what's going on in London. We've looked at other European cities and other European countries. How quickly Germany is vaccinating, of course, will be crucial. How quickly many countries in Europe are vaccinating will be crucial in helping people get back to the office, should that be what businesses decide to do. So how quickly are we seeing vaccination ramp up?
Yeah, so there is, Europe generally is moving a bit more slowly than, for example, the UK, and we know there's a lot of controversy and politics behind that. In the case of Frankfurt, it's still quite a low vaccination rate at the moment, but they are expecting that to ramp up in the coming weeks. So certainly for Germany's financial centre, that vaccination rate is a significant hurdle at the moment. I think it's around 25% of people are fully vaccinated as it stands.
Charlotte, thanks very much. Bloomberg's Charlotte Ryan. And you can read the full story, the full article on your terminal. Type NI Big Take to get the latest Big Take story. And we bring you a new Big Take story every day. So keep across those. Coming up here on this programme, though, Treasury yields steady ahead of Fed Chairman Powell's testimony. More on that next. This is Bloomberg.
G7 today need to wake up and listen to the science. There isn't room for discussion on this. Scientific inevitability, and they need to act. They don't need to talk anymore. They need to just act.
Climate change has been on the agenda of the G7 since maybe 2003. So we need to see action, not just talk. And we've only got 9 years left to halve carbon emissions if we're going to stop dangerous climate change happening.
United, we'll never be defeated! The world is possible!
Valuations, particularly sort of technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the European market open. 50 minutes into a trading session that looks a little bit more sluggish than it did, down 0.2% on the Stoxx 600. Ray Dalio says he doesn't think the Fed can tighten more without a big negative effect. The Bridgewater Associates co-chairman and co-CIO spoke on Monday on a panel at the Qatar Economic Forum.
There's something like 10% of GDP stored in financial assets that's going to be coming out. And so it's likely that there's going to be a big pickup in demand, and that will probably raise prices significantly. And it also depends how you count for inflation, because like housing prices themselves are going up a lot, but rental prices are going down a lot. The big things I think are, and if you went to a 3% inflation rate or some bounce, that's not one of those things that gets me very nervous or very excited. The real issue is that we have a supply-demand issue of bonds, because we're going to have to sell a lot of bonds to those in the world who own bond inventories. And they have very low interest rates, negative real interest rates, and they're overweighted in U.S. bonds, and they're going to have to buy a lot more. And that is also coming at a time when Chinese capital markets, other capital markets are becoming more attractive. That creates a supply-demand issue that can create a monetary inflation, because there will not be enough demand to buy those bonds. And that means that it's likely that the Federal Reserve will not be able to taper or cut back, and might actually have to increase to prevent interest rates from going up. And that's a classic monetary inflation. So that's my bigger concern than just the spurt. I think for most of the world, the real question is, what are interest rates relative to inflation, and also what is happening with all this liquidity, because there's a huge amount of liquidity and negative real interest rates. And that means that it pays not to own any debt instruments, that pays not to own cash, certainly not cash, where you get no interest rate in an environment, like Larry says, of some amount of significant inflation. I think it'll be, let's say, in the vicinity of over 3%. So you get taxed at that rate in terms of buying power. And so when I look at that, I think you're going to see the continued inflation in other assets, and it pays to borrow a lot. I know, like to borrow houses right now, I mean, to buy, I'm seeing interest-only loans being made when there's basically no interest rate. In other words, you don't have to pay back your principal anytime soon. And the interest rates are so low, so there's a lot of money being thrown around that way. Those are the things that concern me more, because you build up a bubble. You saw the reaction in the markets when the Fed just even hinted at tightening. I don't think they can tighten a lot without having a big negative effect.
That was the Bridgewater Associates co-chairman and co-CIO Ray Dalio speaking yesterday at the Qatar Economic Forum, powered by Bloomberg. Interesting to get his reflections then on the extent to which the Fed can tighten and the extent to which the US government will have to raise more funds in debt markets. Venn Rahm, Bloomberg's Markets Live macro strategist, is with us. So, Venn, really nice to speak to you. It seems Ray Dalio concerned about what the Fed can do on tightening without spooking markets, concerned about how high inflation might go. He's worried about monetary inflation. We've certainly seen a lot of adjustments in fixed income markets, in bond markets, on the Treasury curve to shifting expectations over the last 24 hours. Do you think we've settled down now? So yesterday we were all talking about flattening. Today we seem to have adjusted our thinking. There's more of a steepening going on, but we're also just thinking about slightly higher interest rates more broadly. Have we reached any conclusion post-Fed, I suppose, is what I'm asking, on fixed income markets, Ben?
Morning, Anna. I think definitely a more coherent picture is forming in the bond markets, no question about it, compared to where we were this time yesterday when we spoke. I mean, the markets were all over the place yesterday, and there was a flight, there was risk aversion and all that. Now, the rates, sovereign rates are ticking higher, which is headed definitely in the right direction. And Ray Dalio says, as Ray Dalio says, there's a lot of monetary inflation, and that is bound to manifest itself on the curve. And I think that because real rates are kind of still very negative in the US, particularly at the longer end, I think that we need to be prepared for a shift in the curve So it's not going to be it's going to be a twist in the yield curve rather. And I think that, the long end of the curve will outperform the intermediate and the shorter end.
A twist then, not Operation Twist, not back to that one, Ven, but where does that twist leave us then?
That leaves us with higher rates at the front end and the intermediate part of the curve. So we are talking about 2-year yields and 5-year yields shooting up a lot higher. We have got the 5-year rate at 90 basis points, give or take. But I said earlier this week that it's going to go to 115, and I see that as a definite prospect. And over at the longer end, I think the 10-year yield is going to stay around where it is, because even though the Fed has sounded very hawkish, we haven't seen the follow-through transmission on real rates.
Okay, we'll keep an eye on that then. Ven, thanks very much. Thanks as ever for joining us. Ven Round, Bloomberg's Markets Live macro strategist, with us with his thoughts on the yield curve. You can read more of that on the Bloomberg terminal, of course. Ven and the Market Live team, MLI Vigo is the function to use. That is it for the European Market Open. Surveillance Early Edition is up next. European equity markets losing their steam just a little bit as we go through this session, down 0.3%. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
We still expect GDP growth of approximately 6.5% for this year. At this point, we're probably a little bit shy of other more aggressive projections.
Of course, there's transient inflation. The important question
is whether that is 6 percentage points of, for instance, inflation or 4 percentage points.
There's upside risk to inflation, could go higher than what I've outlined here. And we have to be ready on both sides.
You saw the reaction in the markets when the Fed just even hinted at tightening. I don't think they can tighten a lot without having a big negative effect.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. At ease on inflation, Jay Powell reiterates he sees price increases as transitory as the Fed chair gets ready to testify before the House today. While Brent touches $75 a barrel, equities continue to rebound. Alarm bells. The former U.S. Treasury Secretary Larry Summers says he doesn't see why policymakers are so calm on inflation, as Ray Dalio warns that he doesn't think the Fed can tighten without a big negative effect. And Bitcoin slips towards $30,000 as China continues to crack down on cryptocurrencies. Former U.S. Treasury Secretary Steve Mnuchin says virtual currencies should be more transparent. So let's get straight to our top story. Jay Powell will tell Congress the economy is growing at a healthy clip, but unevenly. Let's get straight to our top story now. Jerome Powell saying this today, so let's get straight to our Danny Berger, actually, with the very latest. So, Danny, what are you looking at?
It's definitely this chop in markets, this back and forth, this yo-yo. It really is a market that's trying to wrap its head around exactly what we're getting out of the Fed. And because we have so many speakers, not just yesterday, but throughout the rest of the week, there seems to be this dissonance among them, which makes it difficult to get a really good read. But we're starting to see the session turn more negative as we continue throughout the day. But within that negativity, there is a clear theme, and it is that unwind of the reflation trade hit pause and is now reversing more or less. You have some sellers still coming in at the 10-year. We have a yield flirting with 1.5%. It just hit that a moment ago as I was talking and is now back down. But in terms of stocks, you can see what's outperforming is the more cyclical ones in nature. We have a Dow Jones Future Index, which is trying so hard to be positive. So again, this is more those sort of reflationary stocks. Then, of course, we have Brent crude, which is dipping now under $75 a barrel after yesterday hitting that level, maintaining it for most of the morning. But as I say, we're getting more negative in terms of the tone in the market that's causing oil to fall.
Danny, we also get some, bullish calls on oil. What are analysts actually saying?
Yeah, it looks like a Benjamin per barrel is kind of the high watermark of what we're hearing from analysts. Yesterday, Francisco Bland out of Bank of America, he says $100 a barrel of an oil. This isn't the first person to say it, but it reached this level yesterday after some of the more hawkish comments coming out of Bullard. But a lot of this does have to do with supply, this really restraint we're seeing from the U.S. shale patch and OPEC. And because of that, this key spread, this is the 3-4 month spread in WTI contracts, is gone into extreme backwardation. Every single time it's hit this in the past, it has reached $100 a barrel. So it's not crazy to have that estimate. Trafigura is one of the trading houses that has that estimate. I talked to the chief economist earlier today who says he thinks that triple digits could be reached next year, Francine.
Danny, thanks so much. Danny, I know you're also coming back to talk about Bitcoin, and then I need to ask about Bumble, actually offering a week off for everyone. So that's a conversation Danny and I will have shortly. Joining us now to talk about the markets is Jane Foley, Rabobank head of FX strategy. Jane, what we're talking about Bumble is that actually they've given a week off to all of their employees to de-stress after COVID. So I don't know who needs it, but there are a couple of people in the newsroom that could also benefit from it. Jane, no matter, what are you looking at from Jay Powell today?
Well, I think it's quite likely that he's going to push back perhaps at some of the hawkish rhetoric or some of the hawkish tone or interpretations that we saw last week. So we've seen, his prepared remarks. I think he's going to go back to this theme of inflation being transitory. But, the cat is out of the bag. And, if I might borrow a phrase from the minutes of the RBA meeting last week, it talked about a considerable amount of uncertainty whilst supply chain disruptions ease. And I think this is really something that the markets have been taking on board, which central bankers now, certainly the Fed, have been taking on board. We know that a lot of inflation will be transitory, but semiconductor prices might come down eventually. But is it going to be 2 years, 3 years, 5 years? And this, of course, has the risk that it impacts inflation expectations, which central bankers really do have to be mindful of. So yes, we might have a lot of transitory elements in inflation, but actually before we get prices back to normal, central bankers might have to do a little bit of work to really keep a lid on inflation expectations. And I think Powell really does have to balance that in his comments today.
I mean, Jane, last week, of course, after the Fed decision, there was a huge repricing on the markets, really a lot of unwinding of the reflation trade. What's the next catalyst for example, dollar and some of these other currencies?
Well, I think one of the themes that we've seen really emerging is does the Fed now, and particularly the movement higher in the dollar, does that make it easier for other central bankers to also become a little bit more hawkish? Now, there are certain contenders for that. I think the RBA is one. People are talking about the Bank of England perhaps as another, because, of course, we had that recent print of 2.1% on CPI inflation, and maybe even the ECB, because a lot of these central banks are looking at their currencies. They don't necessarily want a big spike in the value of their currency. So with the dollar already gone higher, perhaps they could afford to be a little bit more hawkish without really rocking the boat in terms of too much currency appreciation. So that's going to be interesting. And with the Bank of England, I think it will be interesting to see if there's perhaps a little bit of a more hawkish take from some central bankers. Everyone knows, of course, Haldane is hawkish. I don't think the market is going to be surprised if he comes out with some hawkish remarks. But what about Fleha, for instance? Is he going to be a little bit more hawkish? He was a few weeks ago. What about other members? So I think over the summer, the markets are going to be really examining other G10 central banks more closely to see if there's been a shift in their degree of dovish versus hawkishness.
So what's your take on, is it actually sterling that you see the most value in at the moment, or what's your favorite G10 currency? Or favorite pair, I would say?
Well, to be honest, I suppose, to be honest, I have been waiting for the dollar to come back. I mean, it's gone a little bit faster than I had hoped, or had anticipated. A week ago, I would have told you my 1 month forecast was euro dollar was 120, and now we're at 119. My 6 month, I think I'll leave, it was 117. So I think the dollar strength will persist, even though I think we'll get some choppiness in the near term. I think the dollar strength will persist, certainly into Jackson Hole. I think the genie is out of the bottle with respect to the Fed now. The market is anticipating that they could be one of the first central banks, maybe to move interest rates potentially as soon as 2022. So I think the dollar remains pretty firm now against a variety of other currencies. Will the Aussie dollar come back? Will the RBA become a little bit more hawkish this year? That's, I think, one to watch. I think with sterling, to be honest, I think cable is going to be moving around because of the dollar. Euro sterling is still, really quite stable in a range here. So I think it's the central banks that have the potential to become a little bit more hawkish. I think it's those currencies that I'm going to be watching most.
Jane, Bitcoin also has slipped almost 10% over the past 3 days. Now, China's continued crackdown on cryptocurrencies is, of course, stoking fears of a deeper sell-off. Further regulation of the digital currencies will be a continuing litmus test for the industry. Now, we also spoke to the former Treasury Secretary, Steve Mnuchin, and he told David Weston at the Qatar Economic Forum that transaction should be more transparent. Here he is.
I believe that many of those industries should be in the regulated world. They should follow the same BSA, the Bank Secrecy Act requirements, the know your customer requirements, and these shouldn't be the equivalent of secret Swiss numbered bank accounts. So as long as we do a lot of work, and that was being done at the G7 and G20 as well, I think the idea is to make sure we crack down on financial terrorism so it can't be used for ransom attacks and other illicit activities.
So, Jane, if you look at Bitcoin, it's around the $30,000 mark. What happens to Bitcoin from here? Is it more regulation? And is it especially just about China cracking down?
Well, China cracking down certainly, but I think more regulation. I think that goes without saying. I mean, we can listen to Mnuchin and listen to what he's saying about cyber attacks and ransoms, etc. But I think there's another element here, and this is again coming back to inflation. Central banks like to have control of the money supply. They like to have control of credit creation via the commercial banks, etc. And if we move entirely to a crypto world, well, central banks lose control of that. Now, that's one of the reasons that crypto became popular in the aftermath of the global financial crisis. It was to move away from the banking sector. But central banks are unlikely to want that to happen, without their control. So from that point of view, I think regulation is inevitable.
Jane, what happens? Is there Ethereum or something else that actually comes to take the place of Bitcoin, or is it just not a category of cryptocurrencies that you want to be invested in right now? What is it actually?
I think that is something that is going to happen. I mean, I think we're going to have cryptocurrencies that are tied to other assets which central banks can have control of. I think this is probably the direction that we're going. But certainly, if we listen to or read the reports of the likes of, say, the Riksbank that this year, they don't want this to happen too fast. This could be an enormous disruptive impulse into the commercial banking sector, for instance, through DeFi, and that is something which could be a huge shock to the economy. So this is something which is going to, I think, which central banks are going to allow to happen relatively slowly. But I think we are looking at a huge shock to the financial sector.
Jane, thank you so much. Jane Foley there, Rabobank Head of FX Strategy. Now, coming up, we'll also be speaking to the New York Fed President, John Williams. Don't miss that exclusive interview at 2:30 p.m. UK time. It'll be really interesting to get his thoughts on inflation, transitory, and of course, maybe some of the inflation imported or not. From China, up next, though, we get to the Qatar Economic Forum and hear exclusively from Alphabet's Chief Financial Officer, Ruth Porat, about Google's cloud business and the use of AI. That's next. This is Bloomberg. Finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The U.S. says 150 million Americans, or over 45% of the population, have been fully vaccinated against COVID-19. However, study reports the highly contagious Delta variant is spreading in southern states, which have lower inoculation rates than the rest of the country. India, meanwhile, vaccinated 8.5 million people yesterday, a new record high. Now, the UK has formally started negotiations to join a trans-Pacific trading bloc as part of its bid to diversify its commerce after leaving the European Union. International Trade Secretary Liz Truss says membership of the group, whose 11 members include Canada, Japan, Mexico and Australia, would be a glittering post-Brexit prize. Hong Kong's Apple Daily newspaper may be forced to shut down this week, with parent company Next Digital blocked by police from accessing its bank accounts. One of the most prominent voices of the city's pro-democracy movement, National Security Police, arrested the paper's top editors last week. If funds do indeed remain frozen, a final print edition could be distributed this Saturday. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now let's return to the Qatar Economic Forum, and the pandemic has accelerated the digitization of industry and the workplace. We spoke to the Alphabet Chief Financial Officer, Ruth Porat, about how Google was taking advantage of this opportunity. Now she spoke exclusively to Bloomberg's Eric Schatzker.
There has been a dramatic acceleration in the digital transformation. Trends that were playing out over a number of years have really been telescoped in, and you can see it in commerce, you can see it in content, entertainment, education, you can see it in telehealth, you can see it even in the way we're having this conference today and the way we all work. And I think one of the important points for everyone is that we don't see the clock turning back. We do see that these trends will continue to endure, and I think it's really important for each one of us to consider how we can embrace digital tools and technology to support both revenue opportunities and efficiencies in our own business. So, for example, and to your question, when we look at small, medium businesses, which are the backbone of economies, what we saw during the pandemic is 1 in 3 small businesses said they would not have survived if they did not have digital skills, because it enabled them to immediately pivot and find their customers where they were in the online world, to get them the information they needed to talk about things like delivery or changed hours. And so these digital skills were absolutely imperative for survival.
The race, I would call it a race, to deepen relationships with customers and consumers is a fiercely competitive one. What is Google doing strategically or tactically, perhaps, that is different from what your competitors, the Microsofts, the Amazons, and the Facebooks are doing that you think ultimately is going to play to your advantage?
You know, one of the main things that we're focused on is how can we stay close to our users and customers and provide them with the tools and skills that they need to be most effective as the world continues to accelerate in this digital transformation. And our ability to leverage differentiated AI has been helpful for all of our customers, for users. You know, people don't even appreciate how often they're using AI in every day. So for those of you who are traveling around the world and opening up now to more travels, when you look at natural language translation, that benefits from AI. When you're asking the question of how do I get to find a store near me that's offering the services or products I want, again, we benefit from AI. So on the user side, really critical. On the enterprise side, what we're really excited about is the investments and opportunity in our cloud business. And our cloud business really is benefiting from extraordinary data analytics, the AI behind that, and then we've brought in talent to focus on very industry-specific solutions. So, for example, in financial services, my old home, one of the key pain points was always the manual intensity around risk and risk analytics. We can leverage things like Know Your Customer or anti-money laundering with AI and data tools. So those are important, and we go to customers and it's like, here's how we can help either with revenue upside or efficiencies, leveraging the tools that we have. Same across retailers. They're looking at how can they ensure that they've got the best supply chain management when we've all lived through what we've seen. And so again, the benefit of AI. So we're looking across the board. I would say the other element of it is how can we be most supportive to the communities in which we operate? And part of that is ensuring that we're working around the globe to provide digital skills training to people so that everyone can participate in this rapid digital transformation.
That was the Alphabet Chief Financial Officer, Ruth Porat, speaking at the Qatar Economic Forum. Stay tuned, of course, for much more from the QEF. We'll be speaking this evening with the Glencore Chief Executive Officer, Ivan Glasenberg. I'll be doing that interview. We'll be talking about, of course, the commodity super cycle. We'll talk also about greening the economy. It's likely to be one of his final interviews in the role as he leaves on June 27th. And actually, it's one of the rare interviews that he's ever given in his tenure at Glencore. Now, also coming up, slow going. Global financial hubs are struggling to return to the office. We take a look at the situation in different cities around the world. This is Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, let's focus on how the global return to the office is looking 15 months after the first lockdowns. Many of the world's key financial centers are struggling to kickstart the comeback. Now, from New York to Hong Kong, the picture, though, differs widely. With the details, Bloomberg's Stephen Ahrens joins us now from Frankfurt. Stephen, great to have you, and actually it's a great, wonderful quick take. So how quickly are workers returning to the office?
Well, not very quickly. I mean, obviously, it's still very hard. Management want people back because it's just shown that if you keep people in the home office for too long, they lose productivity at some point. So they really want them to come back. But of course, there's really health hazards still, especially in Germany, where there's still a law until the end of this month that's actually prohibiting people to come back unless they're essential. And so that will be lifted at the end of the month. And things could change rather quickly over here.
So what is the biggest obstacle? Is it really vaccinations that will, I guess, force people back? I mean, do companies want to force employees back to the office if they don't want to go, or do they risk losing talent because of it?
I think those are the trade-offs that they're weighing at the moment, because they don't really want to force the people to come back when they feel unsafe. But yeah, as I said, they want to make sure productivity picks up again. And vaccination has been a problem because Germany is still lagging. The effort has been picking up over the past weeks and months even, but it's still behind the UK and the US. So that's another big problem. And the Delta variant that's so contagious and potentially more dangerous than other variants is starting to spread in Germany as well. That could be another obstacle.
So is there a city, is there a financial center, Stephen, that is doing much better than the others in terms of getting people back to the office?
Well, I think in the U.S. it's been doing pretty well. We've heard from several U.S. banks that they're actually demanding their people to come back rather quickly. That has not happened in Germany, for example. And the UK was pretty much ahead too until recently, until the Delta variant kicked kicked in and hit the country pretty hard. There's now a delay, and a similar prospect may be facing Germany, actually.
Stephen, thanks so much. Stephen Ahrens there in Frankfurt. Now, you can read that full article on the Bloomberg terminal. Just type NI Big Take. I mean, one of the questions that we've been also trying to figure out in the newsroom, looking at various asset managers, for example, BlackRock. Yesterday, we were speaking to the chairman, and we were talking about the fact that they ask their employees actually to disclose whether they're vaccinated or not, to say whether they come back. Can a company force you to disclose whether you're vaccinated? I don't know the answer to that in different jurisdictions. So that's definitely something we'll dig deeper into. Coming up, some EU diplomats think there are too many British films and TV shows on the continent's streaming platforms. We'll be speaking to Heather Rabbatz, the chair of Garden Studios, a new film and TV studio space in London. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
On inflation, Jay Powell reiterates he sees price increases as transitory as the Fed chair gets ready to testify before the House today. Brent touches $75 a barrel. Equities continue to rebound. Alarm bells. Former U.S. Treasury Secretary Larry Summers says he doesn't see why policymakers are so calm on inflation, as Ray Dalio warns that he doesn't think the Fed can tighten without a big negative effect. And Bitcoin slips towards $30,000 as China continues to crack down on cryptocurrencies. The former U.S. Treasury Secretary Steve Mnuchin says virtual currencies should be more transparent. Well, good morning, everyone. I'm Francine Lacqua here in London. Welcome to Bloomberg Surveillance Early Edition on this Tuesday, the 22nd of June. Now, European equities are little changed this morning. Let's take a look at what's moving under the surface. Danny Berger has all of your stock market moves. So, Danny, what are you looking at?
I have a moving-related mover, if that makes sense. EasyJet. I'm trying to make this pun work. Going to force it through. EasyJet on the rise this morning, about 3% higher. The report out from the Times this morning saying that come Thursday, the UK government is likely to announce easing of some quarantine restrictions for British travelers who are fully vaccinated. I, for one, would love that, to be able to come back and not have to quarantine. British Land also rising today more than 4%. They're, of course, the real estate company. Reports on this one that they're selling off part of their Paddington Central lands. I realize I'm doing a very UK-focused one to start here with, but Paddington Central property, it's in the center of London. It's a mixed-use space. It's very nice. It has a pergola. It has a bridge there. But anyway, reports are that they'd sell 50% of it, so that has the share price moving higher. And finally, Grand Vision. Now, they were supposed to be acquired by Luxottica, the big Italian eyewear company. They'd put a bid in, but an arbitration said that Luxottica doesn't have to go through with that acquisition and won't face a fine. The Italian company has been rethinking it because of the hit that the space has taken during the pandemic, Francine.
Danny, so I came in this morning, and this is how it happens in the morning. You kind of read stories, and then that's one that actually caught my attention last night, which is that Bumble is offering its staff a week off. And I immediately thought, I want to see what Danny thinks of it. So this is to retain staff, I imagine, because they call it, COVID stress.
Yeah, I mean, okay, so my initial thought on this was like, okay, does Bumble shut down for a week? Is everyone who wants to online date going to be in absolute chaos? Of course it's not. But, it's all these companies trying to find ways to help with burnout. But at the end of the day, I feel like a lot of people just want to be paid more. Maybe perks aren't really what matters. Maybe it's not a week off. They just want a better pay, Francine.
Yeah, I mean, maybe it's multiple choice. You can have it. Because you've had a stressful year, you can, A, have a week off, to get a pay raise. What would you choose, Danny?
Can I get both? Is that an option? No.
There you go.
Well, what's kind of funny, Francine? Jefferies yesterday upgraded Bumble because more people are getting vaccinated. So more vaccination equals more dates equals more use of Bumble. I love that line of thinking.
Yeah, as well. And actually, if you invest in your employees, usually you get some good returns. That's, not something you learn at the CFA, but it seems like just common sense. Danny, thank you. Danny Berger there with the very latest on the markets and also talent retention. Now, some EU union diplomats are said to have decided there are too many British films and TV shows on the continent's streaming platforms, threatening another valuable UK export in the wake of Brexit. For now, British shows are still treated as European, but if lawmakers tried to change Britain's status, it would put popular shows such as Doctor Who and Top Gear in direct competition with other global media for the remaining non-quota portion of Europe's content. Well, joining us now is Heather Rabatz, chair of Garden Studios. Now, this is a new film and TV studio space in London. Heather is also the chair of Time's Up UK, which is a charity that insists on safe, fair and dignified work for everyone. So thank you so much for joining us today. Heather, I have a lot of questions, of course, on diversity and the much-needed diversity questions that are in film. But first, let's start with Brexit. How much of a damage would it be to UK film production if actually the rules change on the quotas?
Yes, of course it would be damaging, and our relationship with Europe has been historically very strong and very collaborative in terms of how films and television series have been developed. I think we're all trying to grapple with a sort of post-Brexit universe, as well as, of course, the impact of COVID, which is shifting so many paradigms across different markets. So I'm sure we will all engage in as constructive a conversation as possible. But I think we shouldn't lose sight of that this is a global industry, that in terms of Garden Studios, as we are engaging in many discussions, whether it be with Netflix or with others, there just is huge interest from around the world in making shows in this country, as well as the fantastic talent that is based here.
Yeah. Are we giving enough opportunity to emerging talent, to diversified talent, Heather? And actually, if we look at the last 14 months, has it made it easier or much more complicated for these, very important but different voices to come at the forefront?
I think ensuring that our industry is diverse and inclusive is our number one priority. At Garden Studios, we house a film school, which has a whole range of students from around the world, and diversity sits at the heart of our educational endeavour and what we want to see play out at Garden Studios. Harnessing the voice of women, people of color is crucial to this industry. And we've begun to see breakthroughs with some of the talent that is emerging both here and globally, ensuring that those stories reflect the stories that come from all parts of humanity. We have to, though, really focus on this. We have to make sure that we improve the education, the training, the support, but also open up our industry to these new voices. And there are many initiatives underway with broadcasters, with production companies, to try and ensure that we really capture those voices going forward.
Heather, has it made it worse or easier in COVID, actually? I mean, we've had a lot of discussion about diversity and inclusion in the last 14 months. Does it translate into real action, or is it still just talk?
I think it's increasingly translated into action, and you can see that through, I mean, if you just look at the recent BAFTA winner, I May Destroy You, by Michaela Cole, I think you can see some of that talent breaking through. And there's increasingly encouragement by the broadcasters. We work very closely with the broadcasters as they open up their commissioning, as I said, to new voices. Now, there's still a long way to go. We absolutely have to stay really focused and energized around what we are doing. So I do think it's more than talk, but there's absolutely no room for complacency at this moment in time. It's like we've got green shoots coming through, and we need to really drive that growth now.
So where would the growth come from, Heather? Is it, you know, who's actually commissioning a lot of these films? I guess you always need backing, you need money for productions, and you need producers. Who do you think has more to spend and that really supports and champions some of these causes?
I think what's been interesting is how across the industry, whether you're talking the streamers or the traditional broadcasters, how they've all been now thinking about what they need to do. There are more new writer initiatives. There are new writers being commissioned in ways that we didn't see before. We've seen the rise of somebody like Emerald Fennell here, who obviously recently has got global recognition for her work. So I think it's about really working at those talent pipelines and ensuring in the commissioning of films and of television series that when you look across the slate, you can see that range of voices. And as I said, I think everybody is now very mindful about this. They're thinking about it. And we just have to ensure that we all encourage each other to keep on pushing so that we do get to a position of equity. We are still a long way away from that.
Thank you so much, Heather Rabats-Flera, Garden Studios chair. Now, 500 million euros, that's how much Tikehau Capital's SPAC raised before listing in Amsterdam. It was the biggest such deal in Europe, and it had the support of Bernard Arnault and Jean-Pierre Mustier. Up next, we discuss with Tikehau's co-founder, Mathieu Chabran. If you have any questions for him, just IB plus TV Go. This is Bloomberg.
个人目标，可能会接下来会继续锻炼身体，会尝试去做7+2，再次感谢，曾经给我力量、给我能量的艾瑞克。
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's talk about the SPAC space with our next guest. He is Mathieu Chabran. He's Tikehau Capital co-founder. Earlier in the year, Tikehau launched a blank check company alongside the billionaire CEO of LVMH, Bernard Arnault, and the former UniCredit chief executive, Jean-Pierre Mustier. Now, the resulting company was named Pegasus Acquisition and raised 500 million euros, making it the biggest such deal in Europe since the SPAC boom took off last year. Well, Mathieu Chabran, Tikehau Capital co-founder, joins us now. Welcome to Bloomberg, Mathieu, and for once it's not in the middle of the night from New York, so I'm delighted for both you and me. Mathieu, when you look at the SPAC space and actually this big announcement that we talked about last time you were on, are you sooner to making an acquisition? How far away is that?
Yeah, thank you, Francine, for having us. Good morning. Pretty delighted, to update on this market, which, as you know, has been, fairly busy beginning of the year. Then, went a little bit quieter. There are a number of initiatives in the market, and looks like, the market is finding now its equilibrium. So as far as Pegasus is concerned, I would not comment much on, potential acquisition, but what I can say is that on the back of this successful launch and successful pricing a couple of months ago, that has drawn a significant amount of interest, because as you remember, Francine, this is the first of its kind in Europe that was issued and priced a couple of months ago, and it's a very innovative technology for many companies who might be looking to access and tap the capital market, the public equity market, without going through the traditional IPO route and getting the benefit of the SPAC. So it's very interesting and exciting, I should say, to be leading this initiative here. As you remember, Pegasus is focusing on financial services with specific verticals on asset management, insurance, diversified financials, and as you very well know, it's a pretty busy market out there for this industry. So very excited to be taking that to the next phase.
But Mathieu, can you give us an indication? I mean, the sector you've already chosen, you've highlighted, which is what you're. I mean, it's in financial services. Would that be fair?
Yes, absolutely. That's what we said when we went public. That Pegasus, as a publicly traded, blank check, as we called it, would be focusing on those a specific sub-segment of the financial services. Again, asset management, insurance, and insurtech, and diversified financials, which can be, SaaS, payment, distribution platforms. So very busy market out there, as I said, and it's a great alternative for many entrepreneurs, sometimes, sellers, spin-off from larger conglomerate, financial services conglomerate, or from time to time, some sponsors looking to exit.
Mathieu, where do you still see value in the public markets from a PE fund perspective?
That's an interesting question, Francine, in the context of the close to all-time high valuation on many, across asset classes, I should say, but looking specifically at the public market. I mean, we passed, the 100 trillion, market capitalization, for the first time. I mean, we see all-time high, multiple on a PE basis. Here again, when it comes to SPAC, it's fairly different, because what we do, remember, we're not buying a company. It's not a buyout, and we're not taking control. We're actually, giving access to the public market to a privately owned company. So the convergence of this private market and public market effectively aim at getting the best execution by removing any kind of contingency in terms of pricing, in terms of market timing, and by having some kind of certainty of execution. So it's a very interesting dynamic, Francine, where you can effectively move away from the pure price focus and valuation that you can have nowadays by offering a very differentiating, execution path and a runway, if I may say.
But so you extract value by a different execution path, which is, I mean, how different is it actually? Are there any specific things that you say, I take this company, sure, it's valued at very high, but I can extract value this way to give me maximum returns very quickly? Or is it much more dangerous than 4 or 5 years ago?
Well, I mean, if we step back a minute, for a privately owned company, going public, through a traditional IPO route, you effectively face, many risks, many uncertainties, and the first one is the price. We may want to start, looking at taking the company public today, mid-June, and that will take place, in December, 6 months down the road. So there is, uncertainty on pricing and execution. The investors may or may not be there, at the time, you take the company public. With the SPAC route, it's very different because the capital has been raised, so there is no uncertainty, on the capital. And as long as you agree on valuation with the entrepreneurs, the founder, again, I don't like to call them a seller because once again, they're not selling the company. Well, it's not a buyout transaction. It's effectively, converging and merging into the reverse merging into the listed entity. And that's where you can extract the value, Francine, because you're bringing, first class entrepreneurs, managers, leaders, the backing of some very high profile shareholders. You mentioned some of the few in the sponsors, but we raised this 500 million capital base with top tier institutional investors. And that's a very appealing differentiating proposal for the entrepreneurs. And then you can focus on extracting the value.
Mathieu, what's your take on asset management? So we've had so much consolidation actually in this space. Is it going to consolidate even more? Is there still going to be value created in Europe, or do you look elsewhere actually for asset managers to grow and consolidate further?
Yeah, I think we are, Francine, at a crossroad within the asset management world, and there is a defining moment between the traditional asset management and the alternative asset management. The traditional asset management is effectively all about scale. I mean, I would not name them. I mean, we all have them in mind. It's effectively about getting bigger, about, managing the cost base, fighting the compression, in margin and revenues. So it's a scale game. On the other hand, you've got the alternative asset management, which have been benefiting from massive structural tailwinds over the past 10 years. And it's a real, it's a secular opportunity where you've got all those private markets, alternative private equity, private debt, real assets, infrastructure, growing very strongly. And so I would really differentiate the traditional asset management space to the alternative. We tend to focus at Tikehau, and Pegasus might be more agnostic, in the way it looks at it, to the alternative space, which is not only a global opportunity as far as Europe, as you said, massive consolidation opportunities. Sometimes the regulation is also a challenge, and that creates some subscale platform looking at merging or joining forces with a larger platform. So we should see more consolidation effectively, Francine, and it's a very interesting play at this time in the cycle.
Mathieu, thank you so much. Mathieu Chabran, the Tikehau Capital co-founder, stays with us, and we'll talk a little bit about aerospace. We'll talk also a little bit about sustainability. Up next, we continue our conversation with Mathieu Chabran. If you have any questions for him, just IB plus TV Go. This is Bloomberg.
trading revenues coming in better than expected, everything. Cash, $1.4 trillion of cash, one of the most notable aspects of this report that was stellar.
We at Reliance have adopted this wholeheartedly and are transforming each one of our business lines to be sustainable, circular, recyclable, and with fully transparent environment, social, and governance standards. And I think that's a prerequisite for every business to survive as we go forward.
That was Reliance Chairman and Asia's wealthiest person, Mukesh Ambani, speaking at Bloomberg's Qatar Economic Forum. Now, stay tuned for much more from the QEF. We'll be speaking this evening with the Glencore Chief Executive, Ivan Glasenberg, in what's likely to be one of his final interviews in the role at Glencore as he steps down on June 27th. Now, my conversation actually with Ivan will really focus, and I know it will be pretty feisty and explosive, about the energy transition. So let's get back to Mathieu Chabran, Tikehau Capital co-founder, also to talk about the energy transition. Mathieu, when you look at the energy transition, I know you've actually been more involved in trying to find companies, I don't know whether it's technology or just that help with carbon offsets, but how do you see that developing, and is it one of the most exciting industries out there?
It is definitely exciting, Francine, if you let me paraphrase Mr. Ambani, what he just said, basically today, companies have to be sustainable to be profitable. And that is the new paradigm. You cannot escape that. All the stakeholders, be shareholders, lenders, investors, customers, states, there will be no place to hide. So, this opportunity is a once in a lifetime opportunity. There are some very ambitious goals that have been set by 2030. So very exciting. And, there's been many initiatives announced, launched since we last talked, Francine, on your show. There is, no shortage of capital. It's really about directing efficiently this capital. And this energy transition opportunity, is one that no one can shy away from.
But Mathieu, where exactly do you invest? So, we've all been learning a lot about these new technologies, about even battery storage. How do you find the right one that will then be adopted more than, some of the other solutions?
Low carbon mobility, is one effectively, and it goes beyond the EVs and the electrical batteries. It's about energy, building efficiencies. Bear in mind that, real estate, buildings are one of the largest GHG greenhouse gases emission cause. It's about obviously renewable production, but it's really about embedding technology to effectively get to these goals. Because keep in mind that if you want to meet the Paris Agreement goals, we have to come back to the emission level that was the 70s. And, we shouldn't be scared about that, because in the 70s, we didn't have all these technology elements that we can factor in, for all these challenges. So what we focus on through this fund, first in Europe, and now we announced a similar strategy for North America, for the US, is really the mid-cap profitable company that we want to take to the industrial phase. So we're not investing in early stage, in R&D or venture type of company. There is a proof of concept, and you need to take them, to scale. And that's a great opportunity in itself. Obviously, the U.S. administration have stated some very ambitious goals here. So it's great that, here, Europe, and hopefully with the France leadership and the Paris Agreement together with the U.S. are converging on this goal, which is, once again, a massive goal that collectively we should aim for.
Mathieu, thank you so much. We'll also get you back also to talk about your renewed commitment to some of the aerospace sector. Mathieu Chabran there, Tikehau Capital co-founder. Well, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me out of Berlin, Katie Lyons out of New York, and this is Bloomberg.
freedom delayed. 4 more weeks. That's the delay expected to be added to the lifting of all lockdown restrictions in the UK. It had been due to happen on June 21st, but UK Prime Minister Boris Johnson to address the nation later today and to push that date into July. It's all down to a surge in the Delta variant, and government ministers thought to want more people to have their second COVID vaccine before they ease all restrictions. How are markets responding? Well, they're largely taking it in their stride. The FTSE 100 actually gaining ground. Strategists saying that delay largely priced in, that we could see further weakness for travel and leisure and hospitality stocks. The pound falling against the dollar, though Nomura saying this weakness likely to be temporary. In fact, money markets largely bullish on sterling, given the pace at which economic gloom has been lifting here in the UK. Indeed, last week's GDP figures pointed to an economy that is recovering quickly, and later this week we'll get unemployment, inflation and retail sales data that should all further illuminate the economic recovery.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Bloomberg Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We still expect GDP growth of approximately 6.5% for this year. At this point, we're probably a little bit shy of other more aggressive projections.
There's upside risk to inflation. Could go higher than what I've outlined here. And we have to be ready on both sides.
You saw the reaction in the markets when the Fed just even hinted at tightening. I don't think they can tighten a lot without having a big negative effect.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Keely Lines.
It's 10 a.m. here in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on Tuesday, June the 22nd. Our top stories today. At ease on inflation, Jay Powell reiterates he sees price increases as transitory as the Fed chair gets ready to testify before the House today. Bitcoin slips towards $30,000 as China continues to crack down on cryptocurrencies. And return to the work, to work, the world's financial centers are struggling to get people back in the building. Kaylee, there's also this great story actually about Bumble giving a free week's holiday just because of COVID stress. So it'll be interesting to see this talent for, this war on talent with companies trying to figure out exactly what perks they can give people to retain them. But never matter, the markets are looking at Jay Powell and inflation.
Well, now I'm just standing here, Francine, wondering how I can get a free week off. But yes, you're exactly right. Focused on inflation, focused on all of the Fed speak we're getting this week, including Jerome Powell testifying in Congress today. Now, I would note in the Asian session, we did see a good deal of catching up to the gains we saw in the U.S. yesterday. Broadly positive, albeit the Hang Seng was slightly lower, down about 0.6 on the day. But Chinese equities were higher, and Japanese equities recovered almost all of their losses yesterday, down 3.3% in the Monday session, up 3.1% today. Speaking of Japanese assets, I would note that the yen is weaker against the U.S. dollar. It is above that 110 level still. And I wanted to note in the Asian bond market, investment-grade dollar bond spreads tightening for a 9th straight day as investors are looking for some safety there. We're now sitting just around 130 basis points. Also, I have to put on my Asia board again Bitcoin because it is concerns about a cryptocurrency crackdown in China that continue to weigh on that market. Bitcoin right now down below $32,000, getting closer and closer to that $30,000 level. As for what the picture looks like here in the U.S., we did see that rebound, that recovery in the reflation trade taking place yesterday. We aren't seeing really strong follow through on that today, though. Futures pointing to a bit of a weaker open. We're down about 5 points on S&P 500 E-minis at the moment. In the bond market, we saw a massive intraday move on the 10-year Treasury yield yesterday, swinging more than 10 basis points. It did end the day around 1.49%, and we're effectively unchanged at that level right now. It is a story of broad dollar strength today after weakness yesterday, and that dollar strength may be part of what is weighing on crude. WTI futures now down about 0.75%, still holding above $73 a barrel. And of course, Matt, that is after Brent crossed above $75 a barrel, though it is off those levels now.
Yeah, Brent, the global benchmark, and people are now calling for $100 barrels in the next 12 to 18 months. Let's take a look at European markets right now. We see a little bit of a mixed picture once again. The FTSE is doing well. The Continental Index is not so much. You can see very little change there in France, but Italy is down and Ireland is up. More interestingly, maybe we see a climb again in bonds. Right now, those negative yields are getting closer to zero, right around negative 15 basis points. You can see the pound also falling against the dollar. Everything's falling against the dollar, but the pound is a bigger fall in terms of standard deviation moves than the euro. I find it very interesting, this back and forth. You know, as the Fed takes a hawkish pivot, can other central banks demur and keep their currency advantage or increase their currency advantage to boost exports? It's something they don't usually talk about, but maybe they want to do. And then lean hogs, something that we haven't talked about, focused on too much, but I mentioned it a couple times in the past few sessions because this really shows that maybe inflation is rolling over. We're seeing prices for goods, especially goods that are vital to our lives, like pork is to me, come down a little bit. So it looks like maybe the Fed was right in terms of transitory. Francine?
Live hogs, I love it. But if you look at avocados, Matt, they went up like they quadrupled.
I don't eat avocados.
In the last 12 months. There you go. I don't want your diet, Matt, I think is
Problem
what I would say.
solved.
It's something that maybe we need to work on. We're watching inflation through
That's
Matt
what my
Miller's
wife
diet.
says.
It's not as high as every other diet in the world, especially at our age, Matt. We'll chat off air about that. Now look at what else is coming up this week, or today as well. New York City heads to the polls today to vote in the Democratic mayoral primary. Now election officials say it will be at least a week until the winner is known. So that's a big one. Lots of Fed speakers today as well. It kicks off with the Cleveland Fed President, Loretta Mester, discussing financial stability at 10:30 a.m. Eastern Time. San Francisco, Mary Daly speaks at 11 a.m. Then the key one to watch, the Fed Chair, Jay Powell, testifies to a congressional committee at 2 p.m. New York time. That's what Matt and I were just talking about. His prepared remarks are already catching attention. He's due to say that inflation has picked up but should move back towards the Fed's 2% targets. Now let's get more, of course, on what we've been hearing from the Federal Reserve with Bloomberg's Danny Berger. Danny, it's definitely, there's one game in town. It's the Fed and Jay Powell, and it's moved the markets for the last 7 days.
It really has, and it's a yo-yo market at this point now, really, because the market is trying to decide what is the narrative coming out of the Fed. Is it this hawkish pivot, or is it more like John Williams talked about yesterday, the need to proceed with more caution, that we're still not in the all clear? And that's certainly some of the commentary coming out of Powell's prepared remarks, continuing to hit that temporary inflation kind of drumbeat. But it also becomes difficult just to glob onto those when you also have speakers like Bullard and Kaplan, for example, again, sounding more hawkish, wanting to taper sooner. So this is what the market is confronted with. And we have more than a dozen speakers to go for the rest of the week. So this theme of dissonance among Fed members might be really the prevailing one. And as our colleague Mark Cudmore says, that might be what they want. They might want that dissonance, Matt, because it means that they have more flexibility in which direction they go if it's not necessarily a straight down-the-line communication. Exactly. They want that optionality.
Well, and Danny, of course, as we try to digest what each and every Fed speaker is saying, it's a lot of potential catalysts. What's it all going to mean for the bond market?
That is a fantastic question. Well, I think for the moment at the bond market, the big question lingering over it is whether that flattening trade is going to resume. Now, if you're JP Morgan, you look at this and you say what it means for the bond market is basically nothing, that nothing has changed post this FOMC. And because of those flattening trades we saw put on, because of that reflationary trade which backed off, it's a good opportunity to go back in and bet that that reflationary trade can continue.
Danny, thank you so much. So much going on with the Fed. All eyes on inflation. I feel like I've been saying that for the last 4 months. For the next 10 months, there'll still be all eyes on inflation. We'll be watching, of course, we'll be all over inflation with that Jay Powell testimony at 2 p.m. Eastern Time. Now, Bitcoin fluctuating today, the largest cryptocurrency continuing to be under pressure amid a crackdown in China on payment services and mining operations. Let's get more with Bloomberg's MLive managing editor, Mark Cudmore. Mark, is there a target, and I know this is a very controversial question, but is there a target that actually China wants to get Bitcoin to so it's no longer viable?
I don't think there's necessarily a specific target, and I do think that, as you kind of imply, any specific targets in Bitcoin are a little bit arbitrary. But I think there are two, facets to their attack on Bitcoin. One is we know they're very concerned about financial market risks, and obviously they want to be able to monitor Bitcoin payments, and they want to make sure that people aren't using cryptocurrencies to get money out of the country. So that's one facet of their targeting of Bitcoin. The other one is the fact that China set itself some very ambitious climate goals, and therefore, they have a quite nuanced perspective around this, but when they've got a certain industry which is using an exceptional amount of energy for no real economic gain for the country, it's an easy place to target. So I think the climate motive and the financial risks mean they're going to keep the pressure on Bitcoin for the foreseeable future.
By the way, I cut and pasted a piece of your macro view today, Mark. I thought it was fantastic when you pointed out that this allows, the Fed move allows other central banks to get more hawkish. And indeed, we've seen that, and that's going to be a marginal move higher or tighter in terms of global liquidity, and it's going to hurt maybe cryptos and meme stocks, although meme stocks, maybe they're immune to that kind of move. I want to ask, though, about oil. We see Brent touching 75, breaking through, coming back down, but I heard a call this morning that we could see $100 oil in 12 to 18 months. What do you think of this supply side issue?
So I think there's two kind of different dynamics here. One is I do find that the whole oil market has this default to just get super bullish oil at the highs. And I always get a little bit cynical when I hear these grandiose calls to the market, because there is an immense amount of supply out there that can come on the market very quickly, both from OPEC Plus and from shale suppliers who've been very restrained so far in terms of increasing their drilling. Now, the more the price goes up, the more the incentive is for them to actually increase supply. So I get a little bit worried about that. However, one thing I'll say is that I do think that the longer-term future of oil prices, and maybe I'm getting too far ahead of myself here, is going to be more similar to coal prices over the last decade. As we want to move to a greener future, we're going to invest less in kind of new supply, and that means we're going to get some really, really powerful spikes at times when the market can't react quickly enough. People thought that coal was a dying market 10, 15 years ago, but we continue to see coal just surging and having these crazy rallies every so often just because that supply doesn't react. And I can see that being the story for oil. Do we get to $100 a barrel later this year? Sounds punchy to me, given that shale supply can switch on very quickly. But I guess it looks like we're still going higher in the short term because those inventories are low.
All right, Bloomberg MLive managing editor Mark Cudmore with the short-term and long-term view for us. Thank you so much. Now, I do want to take a quick look at some stocks moving in pre-market trading in the U.S., and one of them is a tiny oil player, Torchlight Energy Resources. This is one of the latest in the craze of meme stocks. Already, as of yesterday's close, it was up 130% in a week, and we are adding to those gains this morning, up about 12.5% in early hours after getting touted on Reddit as a potential short squeeze. One of the older meme stocks, though, that seems to be falling out of favor is AMC. It looks set for a third consecutive day of losses, down 6% yesterday and off another 2% in early hours this morning. And another stock moving to the downside is Microvision after it announced a $140 million at-the-market equity facility after the bell yesterday. Investors not really liking that stock down about 9% before the bell, Francine.
Yeah, so much going on. Microvision, stock that we'll talk a lot more about during the day. Now, coming up next, Ian Shepherdson, Pantheon Macroeconomics chief economist, will talk not about copy and paste, although I want to quiz Matt Miller about his copy and paste things instead of doing screen grabs. But we'll talk about inflation with Ian. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Would be healthier, again, as we're making progress in weathering the pandemic and achieving our goals, to start adjusting these purchases, treasuries and mortgage-backed securities, sooner rather than later.
There's upside risk to inflation. Could go higher than what I've outlined here. And we have to be ready on both sides, I think, to be able to react to that.
Much of the consensus of professional economic forecasters in February was that we would have inflation just above 2% this year. We've already had more inflation than that in the first 5 months of the year.
It's easy to say that the Fed should tighten, and I think that they should. But I think you'll see a very sensitive market and a very sensitive economy because the duration of assets has gone very, very long.
There are a few voices calling for the Fed to be more attuned to inflation risks, including some from the Fed itself. Joining us now is Ian Shepardson, founder and chief economist at Pantheon Macroeconomics. Ian, we're headed in that direction, right? A body in motion stays in motion unless, I guess, countered by an opposing force. I can't remember the exact Newton quote, but it looks like we're on the road, right? So what do?
Well, we're going to stay on this road. The timing is everything, of course, in markets as well as comedy. And the problem is that markets, I think, are rather more impatient than Chair Powell is willing to be. What really struck me last week was how keen he was to point out the limits of his knowledge and the Fed's knowledge and all economists' knowledge and say, look, we don't know what's going to happen because we've got no precedent for anything like this. So we have to be patient. We have to wait and see how the labour market in particular evolves in response to this spike in inflation, whether it becomes embedded through faster wage growth. And if it does, then we can respond to it in due course. And markets for now seem willing to buy that idea. There are, as you just played earlier, a bunch of dissenting and more aggressive voices out there. But I think that I think Powell's approach for now is reasonable. That we just don't know. The unknowns are greater than the knowns. Having said that, I do buy the idea that we need to draw a distinction between the slowdown in asset purchases, the tapering, and the eventual rate hikes which have to come at some point in the future. Because I do think that almost regardless of the inflation picture in the next 6 to 12 months, tapering is necessary, because this economy, to me, doesn't need 120 billion of Fed money every month anymore. I think that time has passed.
Ian, are you really back at Pantheon Towers? Like, are you back in the office, and does that make people less productive?
Yes.
And does that matter to the Fed?
I'm more productive in the office, especially today because the piano tuner's at home. But yes, the move back into the office is I think, very significant. I'm expecting it to accelerate over the summer. Pretty much all the people I'm talking to, all my clients are talking about being fully back in over the summer and into the fall and good to go. And I think that's kind of a line that I would take for the whole economy as well, that the reopening is not complete yet. It's underway, and in some sectors it's really very, very rapid. But I think we're going to see a much more complete story by the end of the summer. And that will give us really critically important news on what happens in the labour market when the economy is fully reopened. Because nothing is more important than how many of the missing millions from the labour force come back in. Because if they don't, then we're going to have a wage inflation problem, and the Fed will be tightening not in 2023 but in 2022.
Right.
If those people do come back in and labour supply rises and it meets the demand, then we'll have a very different story. But I think what Chair Powell keeps telling us is, look, we have to wait because we don't know. And pretending that we know doesn't get us anywhere. We just have to wait.
Yeah, the question of how difficult it is going to be to get back to full employment certainly looms large. Aside from the Fed, what about other central banks? Has the Fed given them potentially more clearance to be hawkish?
Oh, I think so. I mean, the Fed actions give cover to pretty much everybody. That's kind of the way I would look at it from a UK-European perspective. From the perspective of emerging markets, it's not so much that the Fed gives you cover, it's that the Fed puts you under pressure. Because once the Fed starts talking about tightening policy or just becoming a bit less accommodative, then everybody starts to focus much more closely on what EM's doing and where the vulnerabilities are. So it kind of depends where you sit. If you're sat in an EM central bank, then the Fed's saying, hey, we're thinking about a change, that's bad news. But if you're in Europe or in the UK, it gives you a bit of breathing room. It allows you to talk a bit more hawkishly. But again, even in those other developed economies, this question about labour market uncertainty is going to become paramount within the next few months. And just like in the US, they don't know either. So there's no great rush anywhere to jump onto the tightening bandwagon or even onto the less accommodative bandwagon. But there's no question that there is now an opening in the door that wasn't there a couple of weeks ago.
Ian, thank you so much. We've opened a Pandora box. We're three anchors, Ian. One actually says he's more productive from home. It's the other from the office. So I don't know. We'll have to debate this. I don't know where I'm productive. Maybe I'm never productive, Ian. Is that, I'm like, I'm baffling to economists. Ian Shepherdson, founder and chief economist at Pantheon Macroeconomics. Now, coming up, we'll get the view on inflation from New York Fed President John Williams. That exclusive interview is at 9:30 a.m. in New York, 2:30 p.m. in London. And this is Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines in New York with Francine Lacqua in London and Matt Miller in Berlin. Now let's get the first word news. And the U.S. says 150 million Americans, or over 45% of the population, have been fully vaccinated against COVID-19. However, a study reports the highly contagious Delta variant is spreading in southern states, which have lower inoculation rates than the rest of the country. India, meanwhile, vaccinated 8.5 million people yesterday, a new record. The UK has formally started negotiations to join a trans-Pacific trading bloc as part of its bid to diversify its commerce after leaving the European Union. International Trade Secretary Liz Truss says membership of the group, whose 11 members include Canada, Japan, Mexico, and Australia, would be a glittering post-Brexit prize. With pandemic restrictions now being lifted across the country, companies are taking different approaches to retain staff and boost productivity. Some expect a full return to the office, while others are being flexible. Companies like Goldman Sachs and JP Morgan are requiring all vaccinated employees to be back at their desks this fall, whereas Apple and others plan a hybrid work-from-home strategy. Dating app Bumble temporarily closed this week, giving its workers a, quote, much-needed break to recover from COVID-19 burnout. And the company behind Soho House, a members club for creative industry executives, has filed for an IPO in New York. Membership Collective Group owns 28 clubs and 9 workspaces around the world, including the Ned, a vast hotel complex in the City of London. The company, which is yet to make a profit, says it plans to use the IPO proceeds to pay down some of its more than $800 million of debt. And I just found out I am officially the least cool member of Team Surveillance Early Edition, because both Matt and Francine are Soho House members, and I am not. Matt, can I get a referral?
Yeah.
Yeah, no, I mean, you would be a way cooler member than either one. Soho House would much prefer to have you as a member than either myself or Francine. So maybe we'll just transfer our memberships to you. You know, the cool thing is, so members can buy, or the uncool thing, members can buy shares, but they can't, but you can't if you're not in America. If you don't live in America or the UK, you can't buy shares, so I'm out. Yeah.
Speak for yourselves. You can transfer your membership. Kaylee and I will go. The problem, Kaylee, is that you can't find a table anywhere to the cool places. So actually, I hope their IPO is more successful than their booking system, is all I will say. Coming up, Thanos Papasavas from ABP. This is Bloomberg.
This morning was a bit of a historic day. It was the first time Indigenous designers showcased at Australian Fashion Week, and it was a full house of all Indigenous talent.
It made me so proud. Absolutely beautifully done. I mean, the designers, the pieces on there. I think just about every model or every second model was like, oh, I want that, I want that. So each of my pieces, we have our signature prints, which are each tell a story and is definitely a contemporary way of experiencing Aboriginal culture. And then each of my pieces are named after, inspiring Aboriginal and Torres Strait Islander women. So when the customer buys something, they're learning about the story, they're learning about women. I would hope that it isn't tokenistic, and I would hope that it's not done to tick a box. And so, you know, those things you have to be mindful about that. But yeah, I think it's incredible what's been achieved so far, but you know, there's always room for growth. I think the elevation of Aboriginal and Torres Strait Islander people in these spaces, it's long overdue, and it's a really powerful and incredible time, I think, and to be a part of that is really special.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Francine Lackman, London, Matt Miller in Berlin, Kaylee Lyons in New York. Now, a lot going on. We haven't even talked about Bumble, Matt, actually offering employees a week off because of the stress they've had to deal with in COVID. I don't know whether that's because they worried about, losing their employees, but we also have a big take, which is fantastic, looking at the different financial centers and what banks are trying to do to get people back in the office and retain talent.
Yeah, it wasn't very stressful for me, I have to say. I think I chose the perfect time to have a baby because I can't go out and do anything anyway. So I found it pretty relaxing.
Matt Miller.
Berlin's fairly empty. No one else is in the office.
Yeah, I've had to homeschool. Kaylee, I mean, you've been coping okay.
Yeah, and I've also been in the office pretty much the whole time, barring 2 weeks in April of last year. But Matt Miller always just more chill than I am, Francine, I have to say. Let's talk about the markets, though. Pivoting from this conversation, of course, we did see a rebound in the reflation trade yesterday. It does seem that maybe some of those reflation trades will be outperforming again today, but we aren't seeing that lift continuing in the broader equity markets. In Europe, the stock 600 down by about 1/10 of 1%. And here in the U.S., with about 4 hours to go until the opening bell, futures are in red territory. We're down less than 2 points on S&P E-minis, but still not a gain that we're looking at. In the bond market, we saw that wild swing yesterday, more than 10 basis points intraday on the U.S. 10-year yield. Right now, we're basically unchanged, just shy of the 1.49% level. And I have to note Brent as well, because earlier it was making headlines for crossing above $75 a barrel. It has dipped back below that now, trading at $74.42. A stronger dollar may have a little bit of something to do with that. Also, it didn't fit on my board, but Bitcoin is heading down toward $31,000 today. Concern about mining crackdowns in China, and that is weighing on some crypto-tied stocks in pre-market trading. Marathon Digital down about 2%, as is Riot Blockchain. And of course, we have to mention some meme stocks as well. The latest in the fad is Torchlight Energy, up 130% over the last week. Looking set to add to those gains come the opening bell. It's up about 14% in early hours. And Context Logic is higher by about 3.3%, Matt.
All right, well, we're watching Bitcoin very closely because it'll be interesting to see, Kaylee, if it hits 30,000 and bounces off or if it breaks through and that's then a trigger to sell. It's very technical and there's not a lot of fundamental. I'm not sure how much the Chinese mining crackdown really is moving it, and it's not just a little bit of a momentum issue. I have something that may play into a Bitcoin reflation, or certainly into risk asset reflation, from David Kostin and his team at Goldman Sachs. For those of you, I should say, listening on radio, typically I'm a radio listener. I much prefer it to television, but we have charts on television that you can't see on radio. And this one is really good. Dan Curtis put this together for me from our production team in New York, and as I said, it comes from data out of Goldman Sachs. The blue line here shows share buybacks in the S&P 500. Remember how big share buybacks were driving the market through 2018? And then they just kind of fell off, not a cliff, but rolled over a hill and really dropped down in terms of a market driver. The white line here is cash on the sidelines, and this is just amazing, climbing higher and higher, in this case represented by money market fund assets at more than $4.5 trillion. Kostin and Goldman Sachs say there's more than $5.5 trillion of cash on the sidelines, and that 500 billion of that is going to go back into risk assets, back into the stock market through year end. The majority of it, Goldman Sachs says, through corporate buybacks. So Thanos Papasavvas joins us, CIO and founder at AVP Invest. And Thanos, I just want to ask, is this enough to drive the market higher? Because so far, year to date, we've only had, less than 200 billion in corporate buybacks. If we get another $500 billion, does that mean we're off to the races again?
Well, I think the market will be, good morning, Matt, by the way. I think the market will be focusing a little bit more on any potential trajectory changes in the Fed and any potential risk of financial conditions tightening later on this year and early this year. So I think that will probably have priority in terms of the markets. And also, if we look at other levels of indications, such as margin debt or levels of margin debt and valuations, they still tend to be quite elevated. So I wouldn't be as positive as that.
So what do you think we're going to take from the Fed then? I mean, even if the tone turns a bit hawkish, they're still buying 120 billion a month, and that doesn't look to slow down anytime soon, regardless of what Kaplan has to say. Do the markets take solace in the fact that the Fed is still there, at least through 2022?
Yeah, I think what we saw since the Fed statement last week was a relief rally. In essence, the market felt relieved that the Fed is not stubborn, is aware, maybe a little bit behind the curve, but certainly there to take action as the underlying data changes. And our view, Matt, is that we are not in a temporary or a transitionary phase of inflation. We believe that inflation is here, is coming back. We're not going to have an inflationary crisis like back in the 1970s because we have the tools and the credibility to deal with that. But still, we're going to have elevated levels of inflation, especially in the US and then followed by the UK. So I think that the Fed will gradually start shifting its trajectory very close to the end of this year and early start of next year as all cylinders start working in the US economy in Q3, Q4.
But Thanos, are markets just buying time to see fundamentals? And so do they want to know what kind of inflation we're looking at, or they're just waiting for indication for the Fed of what they'll do next?
I think, hi Francine, I think the markets don't believe that we're going to be having an inflationary issue. I think the markets are basically saying, well, we had so much money being thrown at us after the global financial crisis. We have the same demographic issues. Technology prices go down. I don't think the markets believe in inflation. I think that's the reason.
But Thanos, there has been a pretty aggressive repricing over the last 7 days. So if they don't believe in the reflation story, what are they believing in?
No, I think they're seeing it more as a transitory, temporary, rather than a longer-term issue. Whereas in my view, Francine, is that we are going to see the yield starting to rise, but in a gradual trajectory. And I think this will be the driver for the Fed to see how does it move away from the 120 billion a month. So I think the Fed will be first seeing to see if the trajectory is gradual and an orderly increase in yields, then they'll be able to take some foot off the gas.
Well, of course, Thanos, one of the factors contributing to these inflationary pressures has been higher commodity prices, and that is a story that is starting to change. What do you make of that?
Well, hi Kelly. We have been positive on copper from last May 2020. And reflation story, strong growth story, stimulus, China, and also later on in the year, ESG factors, the infrastructure spend and the shifts towards sort of solar. But during the last month, we realized that everything that we had been calling for was already in the price, in the market. So we downgraded our view on copper. We moved it to neutral. We did the same with oil. So I believe that, yes, we are in a commodity sort of strengthening period, but I don't expect the same sort of rallies as we have seen recently. We are already expecting that. It's in the price.
Does that same thesis apply to other cyclical assets in the equity market, for example?
Well, in the equity markets, our view has been to be neutral in the U.S. and more positive outside of the U.S. So we like Europe from a valuation point of view. We like the UK. We continue to like China, an equity view we have held consistently since 2018. And within the US market, we recently wrote some analysis about a shift from growth to value, partly because of the higher yields we expect, partly because of the higher inflation, and also an uptick in terms of overall levels of growth. So I think all of these factors will be shifting growth towards value within the US market, but overall neutral US versus others, European and global.
Thoughts on the car makers, Thanos? Always interested to know what people think about Volkswagen, BMW, Ford, General Motors, v. Tesla.
No, unfortunately, I'll disappoint you on that. Unfortunately, Matt, no particular view on a bottom-up particular corporates themselves. But as a reflation, as a strengthening trade, I think that's important. Also, in my view, although there are Sino-US tensions which will continue, I think that the European relations with China will continue to be more constructive than what potentially President Biden would have liked. So I think this is unlikely to dampen the export-import relations between China and the Europe.
Thanos, what about tensions in cryptocurrencies? Are you fully invested in Bitcoin?
No, I'm not, Francine, for a very, very simple reason. It's that we would have liked to see what Bitcoin does over an economic cycle, over a business cycle, to see correlations, whether it's with growth, with inflation, with other asset classes. I can see why people choose to allocate some portion of their assets in that. It's on the back of price. But in terms of valuations and fundamentals, we have not seen it through a cycle. So we're sort of stepping back, waiting to see how that pans through and consider it over the next economic cycle or two.
All right, Thanos, thank you so much. I think Matt Miller was briefly a billionaire because of Bitcoin, but no longer. Thanos Papasavvas, their Chief Investment Officer and founder at ABP Invest. Now, coming up, global financial hubs are struggling to return to the office. We'll take a look at the situation in different cities around the world. That's coming up next, and this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
If you want to have sustainable growth, it must be inclusive growth. It's not just the right thing to do, but it supports economic growth for the long term. And so one of the areas that we've been very focused on, as I've already noted, is ensuring that everyone has equal access to the opportunities for jobs of the future, the jobs of today and the future. And those are going to be digital based.
That's the alphabet, Google. A lot of people still call it Google. Chief Financial Officer Ruth Porat speaking at the Qatar Economic Forum. Now, 15 months after lockdown to ward off COVID-19, some of the world's key financial centers are struggling to get employees back to the office. Well, with more on this wonderful big take story from Frankfurt is Bloomberg's Stephen Ahrens, who helped write the story. Stephen, Thank you for joining us. Now, we talk about this day in, day out. Different people are going to different speeds. There's a clear message from top chief executives saying, to preserve culture, I want people back in the office. Is it working?
Yeah, well, it's, as you said, it's working at different speeds. Clearly, executives want their staff back in the office, but they can't change the facts on the ground, the pandemic facts on the ground. If the pandemic is still there, then they have to contend with that. And so we've seen places like in Asia, Hong Kong and Singapore, which have been more successful returning people to the office than the US and certainly Europe, Germany, where I'm at present. It's been lagging.
It's interesting that there was a UBS study out showing that 88% of executives want their employees back in the office, but only 40% really think it's about preserving the culture. They just want to get those bodies back because they don't believe you're doing as much work at home. Isn't that the case, Stephen?
I don't think so, to be very honest. I do think people have been seeing that working from home does preserve productivity to a certain degree, but at some point, if people are only working from home, it does erode. So they want people to come back to spend some time together, just to, to feel the office culture. Also, I think it's important to actually see clients again. That's an important point. It's not just the office, it's traveling too, meeting clients, winning the pitch in person rather than by Zoom. Those are important considerations even for the executives.
What about the talent retention consideration? If you have one job potentially being offered to you that is going to allow you to be flexible to work from home, and the place you're working now says, no, you have to be in the office 5 days a week, doesn't that create a bit of an issue?
It's a tricky question. I guess when you're a junior, when you're, for example, a recent graduate and you're looking at your first job, I think you do want to spend some time in the office because it's very hard actually to get to meet people, even your own colleagues from home. It's very hard to learn about the office culture when you're working from home. So I think most graduates are actually quite eager to go to the office. Whether they're comfortable working there 5 days a week, that's another question. But I do think banks are trying, at least companies generally, banks are trying to offer a certain degree of flexibility. But I think they want people, especially junior ones, to come in.
By the way, a lot of banking stories today, Steve. Yesterday we saw HSBC wants to revamp its U.S. investment bank. They're hiring 50 new employees there. What's the story with HSBC coming back on the IB side in the U.S.? They just pulled out of consumer banking, right?
That's right. They're trying to sell a lot of retail business. They just offloaded the French retail business to Cerberus. They're also trying to figure out what to do with their U.S. retail business, but they are trying to maintain a strong investment bank. It's a bank under reconstruction. It's going through a big, ambitious turnaround program right now. I think the question what they will do with the investment bank and whether that effort will be successful is still to be answered.
Thanks so much, Stephen Aarons there on this great Big Take story. You can actually, if you're a Bloomberg Terminal customer, just go into NI Big Take and you can find this great story. Every day we put the spotlight on a wonderful story that we talk about often or not, but it's kind of fleshed out in full. Right, we have some breaking news out of the European Union. It's opened Google antitrust probe over some online ad tech. Now, they have investigated or looked into Google in the past. Remember, just I think 2 or 3 weeks ago, they were also looking at Facebook and the likes. We don't know yet exactly what they're targeting or how big the fine could be, but we understand right now that the EU is opening a Google antitrust probe that could frankly last for years over online ad technology. Coming up, more from Bloomberg's Qatar Economic Forum, rethinking the global economic landscape through the lens of the Middle East. Well, the focus, of course, will be on the Boeing chief executive, the Shell chief executive, the Glencore chief executive. I know I'm speaking to Ivan Glassenberg a little bit later on, a rare interview. He's usually pretty feisty, so I'm looking forward to it. This is Bloomberg.
G7 today need to wake up and listen to the science. There isn't room for discussion on this. Scientific inevitability, and they need to act. They don't need to talk anymore. They need to just act.
Climate change has been on the agenda of the G7 since maybe 2003. So we need to see action, not just talk. And we've only got 9 years left to halve carbon emissions if we're going to stop dangerous climate change happening.
United, we'll never be defeated! The world is possible!
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
I look at Bitcoin in particular as digital gold. And so if you're going to be long gold, Bitcoin's a better version because it's got the same macro tailwinds, but it's also very early in the adoption curve, right? People were scared of Bitcoin a few years ago. They've moved into the space, and now hedge funds are okay with it. Real money managers are okay with it. Insurance companies are okay with it. And so you're playing an adoption game and you're playing a macro game. And so I'm still a big buyer of Bitcoin.
Galaxy Investment Partners CEO Mike Novogratz talking his book there at the Qatar Economic Forum, Francine. So he says, I'm in, you should be in too.
Yes, we should be. I mean, Tom's fully invested in Bitcoin. I don't know whether he was on Reddit yesterday or not, day trading. Tom, you really got to stop that. Co-anchor of Bloomberg Surveillance joins us now. I know you're looking forward to, of course, hearing from Jay Powell, and you have great guests coming on.
Well, I'm waiting for Matt Miller to tell me Bitcoin's linked to Brent crude, because that probably makes as much sense as gold. We've got really important guests coming up. Julia Coronado will join us, and Francisco Blanch, not alone, but really assertive about $100 a barrel Brent. That's a long way from a 75 print this morning as well, and a Honda come by on the equity markets. Mr. Chad of Deutsche Bank as well. And the chart's real simple. You go up to 100, and then what's great, Francine, is you adjust back to $65 a barrel. Up you go to 100, slightly below the average price of 110-ish that we had a number of years ago. And then shale oil comes on, and Blanche makes clear I like this. It's transitory oil. Maybe someday we can have transitory Bitcoin.
Maybe transitory.
I think we've seen that.
What is transitory oil?
Transitory oil is supply and demand, has some real malleability here because of the technology of shale. Price goes up, and then shale comes on with a vengeance, boosting supply and bringing the price down to $65 a barrel. Blanche has a great phrase, work from car, which is why we're going to go up to $100 a barrel. Things have changed, Francine, and particularly in America, there's going to be a lot of people back in their cars. That's the Bank of America guesstimate this morning.
Yeah, we also spoke to the head of oil at Trafigura. And Tom, I have a great chart which needs the keen treatment, actually looking at Brent crude, the most expensive against the Middle Eastern oil in 21 months as we see the recovery, of course, increase. Tom, thank you so much. Arbitrage. Tom Keene, co-anchor of Bloomberg Surveillance. We have a packed day ahead. I know there's a lot, writing on, of course, politics, finance, and the economy. Kaylee, what's on your radar?
Politics, Francine. The New York City mayoral election primary is today. Voters heading to the polls. And of course, the primary is crucial because whoever emerges as the winning Democratic candidate, in all likelihood, will become the next mayor of the country's largest city, because this is a city that runs really deeply blue. Brooklyn Borough President Eric Adams could maybe be considered the front runner, but really it's still anyone's race, especially because there is this new system of ranked choice voting at play. So it allows people to select as many as 5 candidates in order of preference rather than just one. So it will be very, very interesting to see how these results shake out, Matt.
Can't be as blue as Washington, D.C., right? But I'm watching the nation's capital as Rob Portman, Republican from the great state of Ohio, goes in with a group of bipartisan Congress people to try and pass an infrastructure deal. We could hear as early as today whether the White House is down to clown or reaffirms its opposition to the group's plan. But we're talking about a much smaller package, less than $600 billion, I think 579. My eyes are glued to NICNG or NIEXE to watch and see if we actually make some ground today.
Yeah, and then NI, of course, US for any stories. You can IB us also on IB Plus TV Go. I like
NIUS is such a broad tent. You know, I like to narrow it down a little bit.
Yeah, it depends on who's watching us. Matt, this is what I'm watching. I'm actually watching 2 things. So first of all, the Qatar Economic Forum. I know there's a great live blog bringing us up to date with all the C-suite that we've been talking to. We've just heard from Michael Novogratz. Of course, Matt Miller brought us that interview, and he said he's still a buyer of Bitcoin and prefers the digital currency to buying gold. I think earlier we also spoke to the Binance Holding chief executive. We heard from Larry Summers, and then later today we hear from Shell about the energy transition. I'll be also speaking to Ivan Glassenberg of Glencore, one of the rare interviews, and maybe his final interview at Glencore since he's stepping down at the end of June. The other one, and of course, Matt and Kaylee, this is the one thing that we've been constantly talking about throughout the markets, is Treasury traders are really looking to Jay Powell to provide some calm after a volatile few sessions that have sent yields on what one bank described as a roller coaster ride. So investors are hoping to get a little bit more clarity when he testifies to the U.S. Congress on the pandemic response and the economy. I don't know if we'll get it, but certainly we've seen some written remarks prepared for the testimony where he was pretty cautious on inflation.
You know what else is very cool, Francine? Farrow is back in the chair. So the surveillance team is complete again. John Farrow returns to our airwaves today. I'm very much looking forward to that. I will be watching the next 3 hours of surveillance.
Just in time, for the UK football game this evening. I don't know if they're doing great, but I know Farrow will be on top of all football news as well. This is Bloomberg.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Public's hype over inflation had gotten too high. The Fed got spooked.
Looking ahead, I think we're going to have real issues deciphering this data.
We have an economy that's really strong. It's not normal to have rates at these low levels.
What the Fed is actually concerned about is that after 2023, you're going to see continued increases in inflation.
Given the rise in inflation, the hawks are more willing to show their hands.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Don't call it a comeback from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your equity price action is Tuesday morning. We're down about 0.1% on the S&P 500 TK. Chairman Powell up a little bit later this afternoon.
Yeah, Chairman Powell, some important comments. He'll be looking at Dow futures negative 34, 33,727 on the Dow, John. And John, to me, the number one statistic out there, which goes to Francisco Blanche later in the show, is we get a 75 print on Brent crude.
And Mr. Blanche of Bank of America throwing around a triple-digit number, Tom, 100. He's got to back that up a little bit later.
It's a well-written note. He makes no bones about it. We're going to go to 100 on demand, demand, demand. I love his phrase, work from car. But then we come back. You know, I think the time continuum here is so important. Whether it's transitory Powell or transitory Francisco Blanche, there's an ebb here. The media gets into a panic about a given trend. Blanche says up to 100, down to 65.
You throw shade at the media, Tom. Let's talk about the market participants as well
shade at you,
in the last couple of weeks. Can you believe that people are prepared to shift their outlook on a subtle shift over at the Federal Reserve?
Well,
are we really talking about a year out based on last week's price action?
It's a lot. You got a lot in there, John. And the answer is yes, there's been an overreaction, but there it is, and we adjust. And I would suggest without yesterday's adjustment up in equities, you're right. It was not good, but you know, it's ebbed and flowed over 2 or 3 days to maybe not stasis. We're not there yet, but we're getting there.
Big adjustment in the bond market as well, Lisa. Your 10-year 147.68.
Yeah, and perhaps it was an overreaction. Perhaps it was just a really good excuse for people to get out of certain positions, reset as they head into the second half of the year. To your point, though, I think that this is the key issue, the fact that there is more dispersion among the Fed members, but it doesn't necessarily mean the leadership's on board with a more hawkish tilt. In fact, they are doubling down on some of their more dovish rhetoric.
I'll catch up with President Williams a little bit later with Mike McKee. We'll do that at 9:30 Eastern. Got to remember how to do this on the S&P. Where are we? 4,200, exactly where we were 3 weeks ago when I left the building. Almost 4,200 on the S&P. Futures down about 0.1%. In the bond market, yields 147.68. Come and get a couple of basis points this morning. Ahead of Chairman Powell later.
Nothing's happened since you were gone.
And in foreign exchange, euro dollar 118.86. Lisa, stronger dollar through G10 this morning.
Okay, now the markets can actually get started. You're back, so we can actually see some direction, maybe. Today, we do have the New York City Democratic mayoral primary election. This really is basically the election, since the Democratic candidate usually does win. The key aspects here, number one, are that this is a ranked choice election. So when all the people are petitioning you on the street corners, they say, if you don't vote for our candidate for number one, vote for him for number two. And that's what you see. How will this work out to try to get a candidate that perhaps appeals to a broader swath of potential voters? Also facing New York City, the biggest city in the United States, how do you recover from a pandemic that's absolutely decimated the workplace culture as well as the population? 1 p.m., the U.S. is planning to sell $60 billion of 2-year notes. Tom Keene loves bond auctions, so I am going to go into detail.
God.
The reason why I care about this is because of the huge move that we saw upward in these yields in particular. You could see how it just climbed, surged up to the highest level since March on those more hawkish comments by a select few regional Fed presidents. How much will this turn into something that perhaps is a bit messier. 2 p.m., the Fed Chair Jay Powell will be testifying to a House subcommittee. The question that I have is, how much will he double down on a dovish tilt to emphasize that he and the likes of New York Fed President John Williams actually very much see this as transitory drink? There's the whole idea that they do expect inflation to come back down, as reiterated, frankly, in inflation expectations and break-even rates. And John, this to me is the question, this partition between the leadership of the Federal Reserve and the marginal players that perhaps don't even have voting rights that are going to try to throw some caution into markets.
John,
I think Tom's got something to say,
I look at
Lisa.
the angst out there, John.
I mean,
so. I look at the market angst over 3 weeks.
You know, and he interrupts and then starts talking anyway.
Yeah, but
sort of like what we're doing.
Look at the S&P drawdown. The drawdown is horrendous, 0.70%. I mean, equities have just really come back. They've corrected.
Go to
Tom,
cash.
There's a big difference between having a more balanced outlook on the economy and shift and reaction function. And I think the problem that the Federal Reserve has right now is when they start to do the former just a little bit, people start to question the latter. Isn't that what's happened in the last week?
I think we're making it up as we go, and I think this Fed comments here, you saw the separation from John Williams yesterday with Kaplan and the others. I mean, there's some really fresh debate out of the Fed as they stagger to the next meeting.
Let's bring in Julia Coronado, shall we? Macro Policy Perspectives President and Founder. Julia, great to catch up. The Chairman of the Federal Reserve in front of a House committee today. How important is that forum just in terms of what we might hear from Chair Powell?
Well, I think it's important to keep in mind that this is not an official FOMC hearing, so this isn't the semi-annual testimony. So Chair Powell isn't speaking for the entire committee. He's speaking more for himself and for the leadership that you were just referring to. So I do think that we'll hear a very flexible tone from Chair Powell. I don't think he wants to walk back the message of the June FOMC meeting. I do think that there is greater concerns about inflation, and they want to confirm that they're willing to act if it doesn't prove transitory. At the same time, Chair Powell at his core is a labor market dove, and he repeated over and over again, even in the press conference when he was speaking for the committee, that the key lesson on the labor market is how flexible it can be, how flexible labor supply can be. And we really need to give the economy the months of reopening, several more months of reopening, before we can read the tea leaves, and he believes the labor market will come back strong.
Julia, to John's comments there on where the market is versus where the Fed is, I mean, right now, and this goes to British economics, there's a short, there's a medium, and there's a long term. In America, folks, we partition out short term and long term. Is the confusion here about the Fed and the market has one definition of short, medium, and long term, and the Fed has a different one?
Yeah, I mean, I think the market has been very impatient to jump to the conclusions about inflation and labor supply, when in fact it's going to take a long time to sort through some of the frictions of the wildest swings in demand we've ever seen. Of course, the economy is experiencing some frictions. We rebooted the global economy, so there's going to be a lot of noise and a lot of, in both directions in the data. I think it's important to remember we've been seeing surprises on inflation in one direction that can easily surprise in the other in the latter half of the year. So there's just going to be a lot of swings, and the Fed is trying very hard to carve out room for patients to interpret that frictionful recovery, reopening, before jumping to conclusions and setting a course that will turn out to be wrong.
Julia, how problematic is it for the Federal Reserve that, for whatever reason, the market did respond so strongly to a number of hawkish dots, and that the response was lower break-even rates, lower expectations for inflation over the longer term, exactly what the Fed does not want to see? How much does this actually tie the Fed's hands?
Right. So I think, yeah, exactly. The reaction in inflation was probably not exactly what they intended. The flattening of the curve was not exactly what they're shooting for. But again, they are patient. This is a few days of market reaction. I think that they want to emphasize that this isn't a more hawkish reaction function. But in fact, if they do move later, it will be because the economy is so strong. And that will be good news that they're here to accommodate the recovery, not stop it in its tracks. So I think that may be some of the clarification that we hear from Powell through the course of the Q&A. Of course, we already have the testimony. It's very much sort of a repeat of the official opening of his press conference. So it'll be the nuances in the Q&A and how he really addresses some of the questions. Of course, lawmakers from each side will try to be pulling him over to their side. Don't we have enough fiscal? Don't we have not enough? And Chair Powell will meanwhile be, illuminating his views on the dynamics of the economy. And I think Powell is very optimistic that we are going to get a robust labor market recovery, that inflation will be contained, and that what we'll see is a faster and stronger recovery than we saw last time. And that's the ultimate objective here.
Julia, what would your top question be this afternoon?
My question would be around this debate on the tightness of the labor market. I think it's pretty wild to be calling a labor market with so many millions of people actively looking for work and very many other millions others on the cusp of the sidelines tight. I think we know that there's some repricing in certain occupations. So I'm on camp not tight, camp we can go a lot further. But I would like to hear where Powell comes down, because I do think a question like that would get at the heart of his dovishness on the labor market and really tell us where the leadership stands on that very critical issue. If you think inflation is not going to be transitory, it's because you think the labor market is tight and we've tapped out earlier than we might hope. And there are people on the committee that do believe that. We hear that view. We heard it from President Bullard yesterday, that the labor market is much tighter than you think. A lot of these people won't come back. This is what it is. And I would try to ask Powell where he thinks the labor market is and how tight does he think it's going to be.
Julia, thank you. Got to leave it there. Julia Coronado there of Macro Policy Perspectives. Lisa, when's that? 2 Eastern this afternoon?
2 p.m. Eastern. And this will be really interesting to see if there's any kind of market response to a more dovish tilt, or whether people have basically gotten this out of their system. They're reflating the reflation trade.
Look at this bond market. These moves. 135 at the lows in yesterday's session, Tom. 159 at the highs on Thursday. That's quite a range over a couple of days.
Yeah, the dynamics are extraordinary, and you see it in spread. I took a careful look today, John, at the real yield, because I know you're going to be back Friday doing the real yield. And, it's come in, but the real telltale sign here is, do we break through to a lesser negative, a higher real yield? And that really hasn't happened yet.
Your nominal yield right now, 147.51. I can see on this pillar in front of me, Tom, Dow Futures made a comeback.
That's what we did.
When I was away.
Roman, thank you.
Okay.
Roman read a memo of mine.
We'll see how long that lasts. America's benchmark.
We're going to embrace you,
500.
John, in the Dow.
Down not even
I'm getting you Dow pajamas.
a tenth of 1% at 42.14.
The Dow pajamas, John, have all the old Dow members.
You get me some PJs, Tom. I'll go back to bed. How's that?
You can wear them on Love Island.
From New York City. We'll talk about Love Island a little bit later, shall we, Tom? Is that making a comeback?
We shall.
You excited for that? Lovely. Good to be back Tuesday morning. Good morning. This is Bloomberg.
With the First Word News, I'm Ruchika Gupta. The U.S. says 150 million Americans have been fully vaccinated against COVID-19. That's more than 45% of the population, but cases are rising in several poorly vaccinated states, with more young people being admitted to hospitals. The highly contagious Delta variant, first identified in India, has been spreading in the south. Mercado Libre CEO Marcus Galperin says he sees a really enormous opportunity in fintech. He spoke exclusively to Bloomberg's Eric Schatzker last month about his company's growth prospects and opportunities in digital payments.
It's not like we need to replace the credit card system. We need to replace cash, and everybody wants to replace cash. So I think the opportunity in fintech is really enormous, and we look forward to capturing a small percentage of that really enormous opportunity in fintech.
Galperin also tells Bloomberg that he doesn't think anyone should, quote, have a considerable portion of their net worth in crypto, because it's still a very early stage and very volatile. Italy's health minister says the country will end its mandatory use of face masks in open spaces for its low-risk zones starting June 28th. Italy was the original European epicenter of the outbreak. The minister says the government will continue to follow medical expert guidelines on safety. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Bloomberg Surveillance puts global markets into perspective.
We're going to try to fold in economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television. Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
There's no question that the Fed needs to go into a period of normalizing rates and normalizing the portfolio. And I think the question is really how quickly they do that and how they do that in an effort to control inflation.
That was Stephen Mnuchin there, the former U.S. Treasury Secretary, speaking at the Qatar Economic Forum just yesterday. From New York City this morning, good morning, alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Tuesday morning price action shaping up as follows on the S&P. We're down a single point, off by not even 0.1% on the S&P 500 after a really tidy snapback in yesterday's session, breaking 4 straight days of losses on the S&P 500. Outside of that, into the bond market, yields lower by a basis point, 147.51, really volatile over the last couple of days. That's for sure. Big bounce back in yields at the back end of last week, Tom. And then the bid bounce up in treasuries rather, and then yields coming back again. Can't make this one up.
You're rusty.
At all, I know.
You need a couple
just
days
trying
here,
to get
John.
there,
Just
Tom.
you need
Work
to
out where we've been, where we're going. Get philosophical. Euro dollar 118.90 down 0.2 of 1%.
John, we do yield to 4 digits here. That's
Thank
all you got to
Tom.
remember.
I'm trying to remember that. Where are we now?
He's giving you some
147,
space.
17.
Okay,
147. 1
Did you do your expenses yet?
Yields in. You know what, Tom? I haven't. I actually called Jamie last week when I got my email shut off, and I said, Jamie, can you give me an extra week? And Jamie gave me an extra week, and my expenses are about this long. I'll
little
work that out
inside
later.
baseball
Did you do
there.
the training, the internal training?
No,
Get
I
that
did
done?
not.
I've got to do that too. But there you go.
Folks, it's a surveillance break exclusive. I have done all my internal training, and part of that is to leave John alone on the Dow Jones Futures -10 right now. Right now, we are voting in New York. Shelley Banjo will join us here, I believe, in the next hour. She's truly expert on New York City voting and ranked choice. Right now, Martin Schenker joins us. He's Bloomberg editor-at-large and in charge of most of our visibility in Washington. Marty, I would suggest this is 56th Street, is right where we're voting key here. And this is really historic. The Industrial Arts School of New York City, a really famed school. This goes back to the fashion designer Marc Jacobs, and farther back than that, more downtown, I believe, to great Tony Bennett, who is 94 today. So that's a landmark in New York with a landmark election. Martin Schenker, Washington. This is a week where red lines will be drawn. We can start with voting rights or anything else. The power play is going to begin to sort out, isn't it?
Yeah, it's not just voting rights bill, which they need a unified Democratic Party in the Senate to get passed, and even then, you still have the filibuster, so that bill is probably dead on arrival.
Okay, but there's other bills as well.
Yeah.
And what we're talking about here is the polarity of a united Republican group, I would suggest, and then different parts of the Democratic Party. Where's that dynamic going to be in August or September?
Well, I think this whole infrastructure bipartisan deal is going to tell a lot about where the politics goes from really through the rest of the Biden administration's first term. If they can get a deal, if they can figure out how to finance it without running afoul of Joe Biden's feelings about this, then I think that they can actually make some constructive progress. But, I do think it's quite possible if they can figure out how to fund it.
All right, $579 billion. We were talking about this yesterday, Marty.
Yeah.
A far cry from some of the previous proposals, and yet people are still talking about a multi-trillion-dollar fiscal stimulus from Joe Biden. What are the chances that we actually do get a significant size fiscal stimulus right now, given the emphasis on a bipartisan solution?
Well, as I just said, I do think it's quite possible if they can figure out a way to fund it, and it does look like the bipartisan group is trying is taking away this whole notion of an increase in the gas tax to find different ways of funding it, that they are moving towards an agreement on that. Now, $579 billion is actually not a small number, but these days it seems like that, which is pretty amazing when you think about it.
So just to dovetail, going back to what you were saying about the Voting Rights Act and the fact that Tom was mentioning that today during the New York City Democratic primary race, there's a question of whether ranked votership is going to get broader appeal beyond New York City and could even be the way of presidential elections. Is there any discussion about that? How closely are the New York races being scrutinized?
I think there's quite a bit of attention on the whole notion of ranked voting, and it's somewhat controversial. There are a lot of people who feel that, we should just vote for the person we want to be hold that office, and it's a very simple choice. I do think that a lot of people are going to go into the voting booths today and be really confused about what they're supposed to do. So you may see long lines, not because of participation, but because the amount of time it's going to take to fill in those ballots.
Marty, you got to swing back to Washington with this headline just out. White House says they may invite senators to infrastructure talks. That from Punchbowl this morning. Okay, they may invite senators to infrastructure talks. Is the Biden administration doing an end around of Senate leadership and House leadership?
Well, no, as I've said a few times, I really do think Joe Biden wants a bipartisan infrastructure deal. It's not just lip service.
Is Senator Schumer in support of a bipartisan group of senators meeting with the president?
I would think that Chuck Schumer would be supportive of anything Joe Biden wants to get done. And, they can move on to the bigger stimulus later.
One final question. Did you miss John?
Oh, I absolutely did.
Yeah, I know. We were tearing up.
Thanks, Marty. Appreciate that. I believe Marty. I don't believe you, TK.
Okay,
Marty Schenker there, Bloomberg editor-at-large. Tom, since I forgot whether Treasury's rallied or sold off last week.
4 digits, John.
Yeah,
But,
I've
John,
got to catch up.
okay.
Can you tell me what's going on with these infrastructure talks? Where are we?
Where we are is
change.
normal, healthy American politics. And as Mr. Schenker wisely said, the great American tradition, and this goes back to a canal in Georgetown and George Washington of a few years ago. John, this is when the colonies moved away from the motherland.
There was more that happened.
And John, it's just simple. We've argued about who's going to pay for this stuff since time began.
Lisa, I forgot that I should ask you and I shouldn't ask TK.
I don't know what you just got
Ancient
there.
American
That you got some kind of history there. Mayflower was brought into this. You did miss something. And
The
this is
Mayflower
a
is an
huge shift in
infrastructure bill.
tone with the infrastructure discussions, away from a headline of $1 trillion, $1.2 trillion. We're now down to $579 billion, with a question mark around whether anything else could get a follow-on from that. To me, that's a big shift. I mean, we're talking about a very big change in the headline number and, frankly, the awareness of paying for things.
Yeah, John, Lisa's so fully briefed. Why don't you continue with her? I'm going to look up and see what Padres Dodgers did last night.
Thank you, Tom. Treasury's rallied last week.
The right
Just
team
looking at
won.
the price action now, Lisa. Probably should have done this before the show. I did. Joking.
I
Just in
know.
case anyone takes me too seriously and
No,
thinks,
we
why has
would
he
never
come
do
back?
that.
Yeah.
Your 10-year, 143.81 at a close on Friday. Then, Lisa, we dropped to 135 in yesterday's session. And then we bounced back to 148.86 this morning, 147. What do you make of that? Just a positioning story last week. We cleared it out, cleaned things out a little bit, cleared the decks.
People are putting faith in the positioning story as well as the global disinflationary environment. The idea that because rates are so low internationally, you see a lot more foreign flows coming into the U.S. That said, there is a dissonance between risk assets rallying and the pretty negative message on the economy that the bond markets are sending.
Yeah.
What? Tom, you want to give us an update on the Padres?
Yeah, Dodgers 2, Padres 6. Machado just killed it. I mean, he's
good,
just
Tom.
on fire. He's
John's
batting
thrilled.
Good stuff.
500 Ball. There you go,
Do
John.
we do
This is
football?
baseball.
Are we still doing football?
No.
John,
No, that was I thought that was basketball.
Okay, we got to
That
do
got
soccer.
shoved
Well,
out.
we'll do soccer when we come back.
Okay.
We'll do soccer. It's called
Totally
soccer.
got
John.
excised.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
From New York City this morning, good morning. Here's some of the price action on the S&P after a big bounce back yesterday on the S&P 500. These cyclical parts of the market, energy, financials leading the gains. This morning, we're lower by not even 0.1% on the S&P. We're down about 2 points. On the Nasdaq, we're off by about 7. Again, down by not even 0.1%. And on the Russell there, the small caps, just a little bit softer, down 1/3%. Switch up the board and get to the bond market. 2s, 10s, and 30s in treasuries. Are we confusing just a subtle shift in the outlook from the Federal Reserve? A more balanced outlook with a shift in the reaction function. That was the take of a lot of people. Confusing the former with the latter, and the latter is far more significant than the former right now. Your yield on the 10-year, 147, huge range over the last couple of days. On a 30-year, back to about 2.1%. Yields coming in a couple of basis points, just a little bit of a flatter curve in today's session at least. Let's finish on this. Dollar strength the story through G10. Euro dollar right now. Euro dollar 118.91, down 0.2%, reflecting that stronger dollar story. But at 119, Tom, this isn't a massive change and a big move away from where people expect this currency pair to finish the year. In our survey, we're looking for about 122 year end. Right now, 118.90 on euro dollar.
Yeah, we'll do it later. JP Morgan really resets this morning to much weaker yen and much weaker euro against the dollar. They call it a watershed event. We'll get to that here in a moment. Right now in the equity markets, this is what is needed. Somebody with a long-term perspective who's been right about participating in the market. Steve Auth has a little bit of experience at Federated Hermes as their Chief Investment Officer for Equities, and he joins us right now. Steve, I want to look at the 12-month trailing of this unloved bull market, and it's real simple. Up 30%, up 36%, NASDAQ 100 up 40% as well. How unloved is this unloved bull market?
It's still pretty unloved, Tommy, as you know. I mean, that's sort of one of our several arguments for why we think we're in a long-term bull trend here. That, you start with a base of a lot of skepticism. A lot of people got burned in 07, 08, and even the bear market back in 2000. So we've got this kind of generation just starting to come back into equities. Stocks, in our view, are actually still pretty inexpensive. We've got the S&P earnings next year. We just increase them again at $250 a share next year. So the market's not that pricey. The key risk now, I think, and I'm using a lot of the old dogs, as you kind of politely called us, we're actually happy with the Fed Powell testimony last week. Is our concern is that the Fed makes a policy error here and reacts too slowly, causes a massive bubble, and then has to really slam the brakes. The whole thing ends in tears. So I think we can prolong this recovery and the market if they just start taking their feet off the pedal here.
Okay, I want to get this. This is a really important insight for radio and television. If you take the $250 of Federated and Mr. Auth, that gets you to a present price earnings ratio of the S&P 500 of 16.84, which is a number I think a huge number of listeners and watchers don't see that we're at right now. That's where Mr. Auth says we are in a relatively cheap market. Steve, I got to rip up the script. If we get a Fed that's Authian aggressive and they tighten up here sooner or later, should we fear what equities do?
I don't think so. I mean, I know Ray Dalio was mentioning that. I think...
well, talk about that. Is Ray Dalio wrong?
Well, I think he's right to think that the Fed, the risk here is that the Fed makes a mistake and waits too long. But I do think what I think he's a little bit wrong on is I think he's overreacting to the little bit of a pullback last week that happened when the Fed began to act. The market will always pull back initially when the Fed indicates, hey, the punch bowl might be getting withdrawn. But I think once cooler heads prevailed, I think the prevailing view, at least for me, is that if the Fed, they're not going to overreact here, clearly. I mean, they've got all these employment indicators that they're watching that are causing them to go slow. We have our whole set of dashboard of employment indicators we're watching and try to project what they're going to do next. But as long as they start doing something, even start thinking about thinking, which is what we got last week, and I kept telling my staff, just let's hope they start thinking again. And I think last week they announced that they're thinking. That's good.
Well, Steve, thank you for the update that they're thinking. I think they're talking about it too. Steve, I think what people want to know from you, sir, is what do you want to own in this environment? Is it growth equities or the cyclicals, the banks, or big tech? Which one is it?
I want to own the cyclicals. I'm still on this trade, John, since last September. I think they're going to power higher here. They've had a nice rest. I look at all my favorite names in commodities, energy, financials. They all had pullbacks in the last few weeks of 8 to even in one case 20%. So we've had a nice little correction here in those names. The Fed is not going to kill this recovery. We've got GDP growth this year and next, very, very strong. Inflation is going to be very high this year and probably above trend next year. That's going to help those stocks. And they're still cheap if you look at them relative to where they could trade, honestly. So I see them as heading higher and leading this recovery out. The tech stocks, look, those are the long-term growth stocks. They're going to grow their way into their earnings valuations eventually. But right now, they become almost inverse treasury yield plays. We saw that last week. That was the knee jerk when the 10-year came down into the low 140s.
Well, Steve, let's talk about that relationship between rates and what may or may not happen with the equity market. Does your cyclical call need the bond market to cooperate? Do you need higher yields?
Partly the financials for sure. I definitely need higher, a wider yield curve spread, but I certainly would help a lot to get the 10-year up to 2.5, which is where we think we're going to probably end the year. Maybe get into 3 next year, which the market can sustain that as long as we get there gradually. And you're right, the cyclical trade kind of needs those higher yields. And so if you think bonds have tapped out here, I think you do want to go long the growth stocks. We still own them in our portfolios. We never went underweight. We just took it down to neutral after being overweight a long time. But we think there's still time to get back into those names, probably 6 to 12 more months, frankly.
One thing that I was struck by in the price action over the past week is that risk assets were pretty unfazed by the idea of tapering bond purchases pretty quickly, potentially even as quickly as within 6 months if we got to that late 2022 projection from Jim Bullard. Why is that? Is there a dissonance here? Is this just basically risk assets shrugging this off and saying, not going to happen?
I don't know, Lisa. I think, there's different people have different views on this, but I think the folks with a little more experience where we lived through some of these big bubbles in the past, the Japan bubble in the 90s, the Southeast Asian bubble, even 73, 74, we know that the risk here is that the Fed does nothing, creates an inflationary bubble that, yes, they know they have the tools. They keep telling us they know how to deal with this, but the way to deal with it at that point is to cause a massive recession after you've already got everybody loaded up in stocks, and that's not a good outcome. So I think it's actually long-term bullish, maybe short-term choppy as we digest the idea that the Fed is going to start pulling back. I think this idea that they're introducing of late 2023 as their first Fed funds hike is probably unrealistic. But at least they're starting to talk about it. My guess is we get the first hike either late this year or early next year.
Wait, seriously? Late this year or early next year, meaning the taper has to start sooner. The reason why I'm harping on this idea of the dissonance between bond markets and stock markets is because it seems like the bond market is not comforted by a sooner taper, by the idea of curtailing some of the froth in markets. Because frankly, the message from the bond market is a narrower yield curve. is lower long-term inflation expectations. That's the opposite of the Fed acting prudently to get ahead of inflation and not having to abruptly stop a rally and abruptly poke some bubbles. There is a question here about how long this dissonance can last, especially if you see rate hikes as soon as later this year.
Right. Well, I would, later this year, I might have gotten a little carried away there, but let's at least say sometime in the first half of 2023, I think probably is likely.
Steve, you can't do that. You can't say later this year, then go maybe the first half of 23.
I said later this year, early next year, something like that. But later this year might be a little. I might have got a little excited, but certainly by later this year, being forward 6 months looking, by later this year, I think most people will digest the idea that there's going to be a hike in the first half of 2023.
Okay.
And to me, I'm always like 6 months ahead of where the puck is heading. I think that's where the market price is. So that's kind of what I'm thinking.
The puck, John, is ice hockey.
Thanks for that, Tom. Steve, I'm feeling rusty, so I'm feeling kind as well. So you run. Stephen Orth, Federated Hermes Chief Investment Officer for Equities. Did we settle on that, Lisa? Is it early next year, 23?
Late this year, next year. I think he's saying first half of 2023. Markets are trading ahead of that. I think. Yes, Tom?
I wasn't convinced of an entry point there. The last 10 years per year for the Standard & Poor's 500, John, 15.95% per year. I think we can round that up to 16% a year.
And Steve Orth has been bullish.
It's a single digit.
Through much of that bull
you can't
market.
make money in stocks.
I'm sorry. I don't see how stocks can keep rallying if they taper within 6 months the entirety of each monthly $120 billion of purchases. John, do you buy that? You could see risk assets continue to rally.
Not for me to buy, not for me to sell. I think it's a question worth asking. Can risk assets do well
we just get into these
with reduction of asset purchases? I'm not in a position to say whether you should buy or sell the market based on a reduction of asset purchases. Did the equity market do okay last time around? When did it really start to suffer? Really started to suffer when they started to reduce the balance sheet, when they started to push rates through what most people consider to be neutral. That's when things got really dicey in this market last time around.
John, we're making jokes about it, but like Zero Hedge features Michael Wilson over at Morgan Stanley talking about if you see an M2 reduction, he understands it's debatable and that. This goes back to Tony Dwyer. Is there a recession? No. Own stocks. That's sophisticated Dwyer analysis. Well, John, what it goes to me, and this goes to the dynamics of the market, it's the pendulum of taper.
The pendulum of taper. That Mike Wilson of Morgan Stanley, I think, makes a good point.
That was a theme.
Thanks,
But remember, we're not talking about the reduction of the balance sheet.
Yeah.
No,
we're talking about the reduction of monthly purchases.
The pendulum of taper was season 5, Game of Thrones, I think episode 4.
Coming up, I've missed this.
Have you?
No. Dr. Amish Adalja, Johns Hopkins Center for House Security Senior Scholar. Your equity market down about 2 points on the S&P from New York City. For our audience worldwide, alongside Tom Keene, Lisa Abramowitz.
That's New York City, John. On radio, it's a beautiful, beautiful
clean streets.
This is Bloomberg.
And that's the Empire State Building.
With the First Word News, I'm Rishika Gupta. The bipartisan group of senators working on an infrastructure deal say they're getting closer to an agreement, but they say they're still trying to figure out how to pay for the plan, considering White House opposition to indexing the gas tax to inflation. The lawmakers are set to meet White House officials today and plan to draw up a framework for a proposal this week. ExxonMobil is said to be preparing to cut some jobs at its U.S. offices, Bloomberg's learned. An evaluation system will be used to identify low performers and to cut 5 to 10% annually for the next 3 to 5 years. Exxon had 72,000 employees globally at the end of last year, 40% of them in the U.S. An NFL player, Carl Nassib, has announced that he's gay, making him the first active player in the league to come out. The Las Vegas Raiders player revealed the news on Instagram, saying he's pretty private, but hopes that his coming out would mean other people would not have to make similar videos in the future. He added he's donating $100,000 to a non-profit that works to prevent suicide among LGBTQ+ youth. Global banks like HSBC and Standard Chartered are ramping up hiring ahead of the so-called Wealth Connect link between Hong Kong and China. The plan will allow investment across the border and could open up more than $460 million in annual fees for lenders. HSBC is set to hire up to 400 people in Hong Kong, while Standard Chartered is looking at hiring or promoting 3,000 Asia wealth managers. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Kingdom is pretty highly vaccinated, but is also now seeing an increase in infections, and overwhelmingly these infections are the Delta variant. So this is sort of the next chapter of the COVID pandemic, and just reminds us that for every move that humans make, the virus has another one, and we just have to continue to press the case against the pandemic.
It's the never-ending pandemic with Joshua Schaffstein there, the Johns Hopkins Bloomberg School of Public Health Vice Dean. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Tuesday morning, price action as follows. Slightly positive on the S&P 500, 4214 on the S&P 500. About as exciting as I make it out to be. Yields coming in a couple of basis points, 146.83. Euro dollar with a break of 119. Some dollar strength out there through G10, Tom. 118.97. Euro dollar coming down about 0.2%.
An important conversation, John Farrell. Maybe you've got some update on this with your travels over the last 3 weeks. There's a lot of effort to open up economies. I believe I saw in Italy they're really making an effort to open up. And then in the FT 2 days ago, John Byrne Murdoch said, wait a minute, Italy's one of the biggest headaches. I'm lost. So are you. Let's get smarter. Amesh Adalja joins us now from Johns Hopkins. Dr. Adalja, which is it right now? Is it an economies and societies that can open up, or because of the India Delta variant, they cannot? Which is it?
It all depends upon the state of vaccination in your country. If you are a country that's highly vaccinated, like the U.S. is, where your high-risk population, the majority of which is now vaccinated, the Delta variant is going to cause problems, but it's not going to put you into crisis. But if you're a country where there's not enough of your elderly population vaccinated, the Delta variant could put your hospitals back to where they were in the very beginning of this pandemic. So that's really what's going to gauge how the Delta variant affects a country, is how much of their population is vaccinated, especially that high-risk portion.
Is there value for Americans to study the dynamics out of England? Is there value to really looking precinct to precinct and whatever in England at how the variant's working? Does that come right over to the United States?
I do think there's value because England is a highly vaccinated country, a country in which their high-risk population has largely been vaccinated. And what you're seeing there is the Delta variant increasing in cases, coming to dominate, but not necessarily translating into hospitals in crisis or a high level of deaths. So this is that concept I talked about before, of the decoupling of cases from hospitalizations and deaths. That's what's happening in England. That's what will happen in other places where the Delta variant appears and the high-risk population is vaccinated. So to me, I think it's very important to be aggressive with the Delta variant, but it's not something that has the capacity to put our hospitals in crisis. It's going to be a very different flavor than prior increases in cases. But it's inevitable that we'll see upticks in places where there are not enough vaccinated people.
Dr. Adalja, is the sense that the Delta variant is more virulent, that it has longer lasting implications for people who are not vaccinated? What is the distinction of the Delta?
The distinction is that it's more contagious. It seems to be more contagious than any of the other variants that we've seen, and obviously more contagious than the original version of the virus. There is some mixed data on whether or not it's more or less deadly than the other versions of this virus, but that sometimes is something that doesn't pan out when you actually look at the data. But this is something that can take off in an unvaccinated population, and that's why where we have pockets of unvaccinated individuals, it's really important for them to get vaccinated, because the more we're vaccinated in this country, the less we have to worry about the Delta variant or really any other variant.
This has been the message from health officials, business officials, and community leaders across the board. There is a question, though, of how we are recording who has gotten vaccinated and the ongoing honor system that the United States is following. Do you think the honor system is the way to go, or should there be a more formal process of tracking those who've been vaccinated and those who have not been?
Well, it's important to remember that when you get vaccinated, your state, there's an immunization registry, so that's all recorded. That's where the CDC gets its numbers. So those numbers are correct, but there's nothing on your person that you have that really tells people that you're vaccinated. You have these flimsy cards that are really not anything that can be considered an official document. I do think that this was an opportunity early on that the government should have thought about. Is there a way just to have an app on people's phone that tells them their vaccination status so people can trust it? New York State did something called the Excelsior Pass, but it really didn't take off. So I think that this is something we really should see private industry innovating to put your vaccination records in an app. Not just COVID-19, but all of them, I think would be really good.
Yeah, Amish, I think a huge body of our viewers and listeners agree, Amish, with what you just said. And to me, the 2-minute drill is who's going to drive this forward. Are you telling me American Airlines is going to set public policy for America?
I do think it's probably going to come from the private sector, because the Biden administration has said that they don't want to do anything like this. You might see some states do it. The International Association of Travel Agents has been working on some apps. So I do think you're going to see one of those companies come out with an app where they can verify it, and then that kind of becomes the standard.
Lisa, let's go to our other guest here this morning. Jonathan Ferro's been traveling recently. John, forget about it. You're living it. What's it like on an airplane or getting on and off where you don't know if the guy next to you is vaccinated? Full disclosure, folks, Ferro is vaccinated.
Look, I think, personally, Tom, I think it's an absolute disgrace that we still haven't sorted out the travel corridor between London and New York. I think it's ridiculous. You mentioned the private solution. I'm sure the likes of American Airlines, United, Delta would love to source something out like that from London to New York. The fact of the matter is we're still shut down. It was really interesting to see the president go with his delegation and a bunch of journalists over to London, over to Cornwall the other week, wasn't it? And then go over to Geneva. And then we had the theatre of the mask and the elbow bumps in the UK, and then over to Geneva without a mask and the handshakes. I've got to say, Doctor, for a lot of people, it's incredibly frustrating. And I don't want to get too personal about the matter right now, but I do want your opinion on why on earth we haven't addressed this travel situation.
It's really mind-boggling. I think now with fully vaccinated individuals, they can go back to their pre-pandemic life. They should be able to travel freely without testing, without quarantine. That needs to be the standard. It's just that these countries are on different timescales, and a lot of them are reticent. Just look at Canada. They will not let Americans in that are fully vaccinated. It really makes no sense to me, and I think we have to start moving past this pandemic, this acute phase of the pandemic, because if you're why did you get fully vaccinated if you actually don't get the ability to kind of have your ability to move around the world back? So I think this is something we need to address, and I know they're working hard to figure this out, but it's going to take some time.
Doctor, got to run. Thank you. Yeah. Dr. Amish Adalja, Johns Hopkins Centre for Health Security Senior Scholar. That's something, Tom, that is not going to get addressed anytime soon.
John, I still can't believe we're not doing Heathrow to New York. I mean, you've been leading on this for a year and a half. Now, John, we got to go through this cycle here because I've had a lot of mail on this and people are thrilled you're back, blah, blah, blah. We failed last week, John. We're on radio. And, folks, dead silence on radio is a failure. I asked Romain Bostic about soccer, and there was complete...
Just got nothing back.
He didn't even fake it like me. I mean, Romain's just like...
Who is the failure on,
dead.
Tom?
Romain is just like complete...
Yes, exactly.
Total silence. Now, John, let's go to Euro 2020. Today's a big day. The only reason Pharaoh's back is to go out to the Bohemian Bar, Hall, I should say, at 3 p.m. and watch Czech England and all that. But the issue, John, is the uproar. Is Harry Kane
Does he play
fit?
or not?
Is he
fit?
Does he
play or not?
Well, I'm asking.
I don't know. I have to say, you know the difference between England and Italy?
Yeah.
Is that Italy always has a philosophy, a team, a strategy. And England just tries to play its best players at all times.
Exactly.
And it never works
we
out.
miss this, Lisa. We miss this. He thinks we're serious.
The pendulum of football.
Coming up, Hanahan.
You can tell when
Wells
someone's
Fargo.
fit.
Thanks, Tom. The S&P 4213 from New York City.
I think Harry Kane.
What's my out? The 56th minute.
Yeah.
Come on, we're almost there.
You got this.
There we go.
Really?
This is Bloomberg.
Being excluded from the workplace, especially when you've got skills and motivation and things to give, can have a really detrimental effect on people's well-being. They can become isolated, of course have the financial stress of not being able to support themselves. That might be their first entry into the broader community where you're building relationships with workmates, and so that's your exposure to culture and you're starting to feel like you belong.
Some people might need to practice their English more, they might just need just some practical experience in an Australian kitchen.
I have not from Australian friend. Now back in the kitchen, I have many friends.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Public's hype over inflation had gotten too high. The Fed got spooked.
Looking ahead, I think we're going to have real issues deciphering this data.
We have an economy that's really strong. It's not normal to have rates at these low levels.
What the Fed is actually concerned about is that after 2023, you're going to see continued increases in inflation.
Given the rise of inflation, the hawks are more willing to show their hands.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures unchanged on the S&P 500, 42.13. A little bit later this afternoon, Tom, Chairman Powell going down to Capitol Hill to testify.
He's got a lot to say, and of course, all these different officials that we have to cover up the damage of the last number of days. And the message, John, is a time continuum. And I think really what's important with Powell is to see, is he focused on 21? No. Is he focused on 22 or even out to 23, 24? John, while you were gone in your sabbatical, David Folkert's Landau had the courage to go out to 2024, and they see higher inflation.
I'm not sure anyone's calling it a sabbatical, but thank you, Tom.
That's okay.
S&P 42.15 on the S&P 500. I'll let that go. Don't worry. You talk about the damage done to this market, Tom. What damage? Where is it?
Well, the damage, exactly. The drawdown in the S&P 500 is less than 1%. There's a lot of people saying death of the bull market. Steve Auth in the last hour, I thought was great on that. There's a raging debate. I don't know what to do with Anna Hahn here in a minute, but the bottom line is if you're not in the game, you can't play.
Yeah, and we're always focused on the dumpster fire, aren't we?
Yeah,
so
exactly.
Dumpster fire for about 5 minutes in the equity market. What happened in credit? Lisa, what happened in credit?
Absolutely nothing. Basically wide open. It was completely calm. Rallied, spreads tightened right back after a brief moment of, I wonder what's going on. When Tom talks about damage control, I have been wondering this. Where was the damage? Why aren't Fed officials cheering the response? A little bit of froth taken off the top, a bit of skepticism around how long the Fed will keep the pedal to the metal. This is a good thing for the Fed. But that said, the fact that longer-term inflation expectations came down is not good. Yeah. And if they're going to do damage control, John, that's where they're going to do it.
John, Liz Ann Saunders was just out on Twitter. 95% of SPX went up yesterday. 95%.
Damage control.
That was a jump condition sea change.
If I was concerned about one thing over at the Fed, it would be how quickly some people, and I emphasize some people, believe that the Federal Reserve had somehow shifted the reaction function on a very, very nuanced, subtle move in last week's news conference and in the summary of economic projections, and that's not what happened. And if they've spent more than a year on this, Tom, more than a year talking about this shift in this reaction function, for how people question it off the back of one news conference, one decision, that's probably not good news for them.
I know we got to do data and brief and get to Anna Hahn, but one of her great themes here is the economy will deliver for Chairman Powell. That's different than a lot of other worry that's out there.
Let's turn to this market right now. 42.14 on the S&P 500. Futures largely unchanged. In a bond market, there was a rally in the Treasury market last week. 147.34 is where we are. Yields coming in about a basis point or two on a 10-year. And in foreign exchange, dollar strength the story right now. Euro dollar 118.93. Lisa down 0.2%.
Yeah, really, really dramatic market here to greet you, John. Not a lot going on. Markets trying to refine some sort of level after that drama that Tom was talking about last week. All right, today, New York City is holding their Democratic mayoral primary election. Key questions here, in addition to crime, safety, and the ranked voting, is how do the biggest cities recover from the pandemic? How do we get back to an office culture? What does that look like in a more remote working environment? Then at 1 p.m., the U.S. is planning to sell 60
$60 billion of 2-year notes. Interesting to see after yields on those securities rose to the highest level since March. If people are forecasting an early 2023 rate hike, what does that look like for the 2-year, and how messy is this auction? And then at 2 p.m., the Fed Chair Jay Powell is testifying to the House. Interested to see what damage he sees to control. So sort of the discussion we were having earlier, what he emphasizes, how much he plans to emphasize transitory, and also the dispersion of views on the Federal Reserve. Should this give the market some confidence in some ways, John, that at least the Fed is recognizing the inflationary risks and they're not going to necessarily let things get over their skis and then have to come in with force, raising rates and committing a policy error?
So, Lisa, which one is it? Has the balance of risks around the outlook changed, or has the outlook changed? Is that the same thing?
The issue here is that suddenly the Fed seems more concerned about inflation, and the dual mandate between employment and inflation seem to be weighed much more heavily to employment, with the Fed basically shrugging off inflation, saying it did not pick up over the longer term. We are hearing more true concern about inflation now, and if the dual mandate more heavily weights inflation, John, all of a sudden people think the Fed is going to have a swifter reaction function and will come in and hike earlier.
Quick word, Tom.
I just think they're making it up as they go. I really take issue with all this navel gazing about, what the Fed is going to do. Is that, John, they're making it up as they go.
Tom, anyone with any confidence, any conviction about the outlook here is a charlatan. Let's be clear about that.
I'm going back to, I interviewed Richard Timberlake in our Washington, D.C. office, the giant of the Georgia School, and he was just magisterial. You know what? They put their pants on one leg at a time. It looks like everybody else, and they're making it up as they go.
Talking about making
Anna
it
Han
up.
joins us now. Wells Fargo equity strategist.
They do. Anna puts her pants on one leg at a time. They're making it up as they go.
Going?
TK, you want to go there? I don't. Anna, I'm going to keep things down the middle with you.
Markets.
All right? Let's get to that equity market. Anna, has anything about your outlook shifted in the last week?
There has been some shifts, especially in the last week. What you did see is that more people on the Fed are expecting a little bit of a sooner rate hike. But, that move, as much as it was a bit surprising, wasn't all that mind-blowing. You saw go from 2023 to maybe a hike at 2022. That probability distribution has been pulled forward in a time frame. But that's not the biggest move to us. I think more surprising in the market was hearing taper talks start. But, when is tapering actually going to begin? We don't think that's going to happen until the end of this year.
Anna, your note is brilliant. And the way you dovetail GDP in is great. I've been harping on this for a week and a half. I'm putting my pants on one leg at a time, Anna. I want you to tell me right now what Jerome Powell, putting his pants on one leg at a time, what we do with 11.3% nominal GDP. Your new statistic up 7.3% plus 4% inflation. I think that math is 11.3%. Anna, that's a boom economy. Stocks go up.
Yeah, when you looked historically, equities can go higher even as rates are moving higher. And that's because it's the level at which they're coming off of, where we're listing off of. Mind you, look at where the 10-year is. But with these kind of changes to our projection, the big driver there is going to be consumer expenditure. What may be a risk to our outlook, we're keeping a very close eye on, especially with upcoming earnings, is going to be how the supply chain and inventories hold up.
Anna, you talked about the surprise of potential tapering. What would the implication be? What's the reaction of equities should the Fed start to taper their bond purchases sooner?
Well, they're buying $120 billion a day. And I think rather than being a crutch at this point, it's just something like we've gotten so used to it. We've come dependent on it, having that liquidity. As they taper that back, I think that risk appetite will be pared back a bit. And that's natural. When you have accommodation coming off the table, people are going to have to adjust their risk outlook and see what kind of cyclical exposure they want. But that doesn't mean necessarily it's time to head for defensives. In fact, the macro theme in play still remains reflation, recovery here. It's just a bit of a little shift, and it's different mentality than we saw from a year ago.
So if you had to own one sector into year end, Anna, would it be the financials or would it be big tech?
I would go with financials. The millennial in me still believes that tech has more upside to go. But, the outperformer here, especially in the back half of this year, of the next 6 months, I put my money on banks and financials, John.
Anna, how much is this a bet on a steepening yield curve?
that steepening yield curve has been, it's been a headwind for banks and financials in the last quarter. You saw what happens when the back came down. You saw what happened last week when that yield curve has been flattening. And it can be a challenge, but I think that's something that the market is going to get through. I think that's something that's going to see that trend return to a steepening as you see more data come out. But one of the things we got to watch out for as well is, how long is that inflation going to be marred, or when can it continue? Can the supply chain really slow it down and keep that suppressed for the next market? We look as a signal for that.
Anna, always great. Thank you. Anna Han there of Wells Fargo. Your equity market at about 7:09 Eastern time, bouncing back a little bit, up 5-6 points on the S&P 500, advancing a little more than a tenth of 1%. So the Nasdaq 100 futures here, a quarter of 1%. Big bounce back in financials and energy yesterday. The bank's up by more than 2% in yesterday's session. Energy up by more than 4%. The question of the moment, Tom, really the question of the year. What do you want to own? Benchmark the index. Do you want to own the financials, which have done well so far, or pivot back to big growth?
I mean, and I don't have a strong belief here, John, but I do appreciate I'd also point out, John, just in the last 4 or 5 years, 17.52 on the VIX right now. A VIX of 16 completely refutes the angst of the last 2
in this equity market, will the Fed move to choke off growth, and will that shift you back towards the big growth names, the big tech names?
And actually cut off growth. I mean, that's actually something that's a big question at this point, based on your point earlier, that if they're not reducing their balance sheet, how big of an impact will this really actually have? They still are stimulating the economy by holding their balance sheet above $8 trillion.
TK mentioned Mike Wilson and Morgan Stanley a little bit earlier. What's the most powerful force at play? Lisa, the move away.
Strongly agree with this. I can't say enough about the linkage here into GDP. John, a research note that underscores that optimism this morning. It's a wonderful note from Paul Megacy over at JP Morgan. And John, you and I love when somebody says, I was wrong. Megacy nails that now. He went weak dollar and he said it's wrong. We lost patience with a patient Fed. Our timing was poor. He goes out the yen weaker, 107 to 112. And he looks again at the real yields. John, the real yield Friday, I believe, afternoon.
Thanks. I'm just sitting here in shock that you actually did something serious for a moment. I was expecting something else.
Oh, no.
Thank you.
This is serious. This is my one moment of the
4 on the S&P. We advance a tenth of 1%. From New York City this morning, live on TV and radio. This is Bloomberg.
I got to brush up on Love Island.
With the First Word News, I'm Ruchika Gupta. The U.S. says 150 million Americans have been fully vaccinated against COVID-19. That's more than 45% of the population. But cases are rising in several poorly vaccinated states, with more young people being admitted to hospitals. The highly contagious Delta variant, first identified in India, has been spreading in the south. And with pandemic restrictions now being lifted across the country, companies are taking different approaches to retain staff and boost productivity. Some expect a full return to the office, while others are being a bit more flexible. Companies like Goldman Sachs and JP Morgan are requiring all vaccinated employees to be back at their desks this fall, whereas Apple and others plan a hybrid work-from-home strategy. Dating app Bumble temporarily closed this week, giving its workers, quote, a much-needed break to recover from COVID-19 burnout. In the Philippines, President Rodrigo Duterte is threatening to jail those who refuse COVID-19 vaccines. It comes as the nation ramps up inoculations to prevent the spread of the Delta variant, first identified in India. The country's Justice Secretary has countered Duterte's remarks, saying in a statement that there's no law compelling citizens to get vaccinated, and his own spokesman says vaccinations are voluntary. Several large Chinese banks are said to be restricting credit to China Evergrande Group amid mounting concerns about the developer's financial health. 3 banks with billions of dollars in combined credit exposure have reportedly decided not to renew its loans when they mature this year. In response to questions from Bloomberg, they denied lenders were curbing access to funding. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ruchika Gupta. This is Bloomberg.
个人目标，可能会接下来会继续锻炼身体，会尝试去做7+2，再次感谢，曾经给我力量、给我能量的艾瑞克。
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between governments and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
There's upside risk to inflation. Could go higher than what I've outlined here. And we have to be ready on both sides, I think, to be able to react to that, to be state contingent, to be nimble. Just as nimble coming out of the pandemic as I think we had to be going into the pandemic.
The loudest voice in the room getting all the attention, that was Jim Bullard,
Yes,
the
well
St.
said.
Louis Fed Bank president. We're catching up with the New York Fed president, Mr. Williams, a little bit later on this morning. From New York City this morning, good morning, alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Equities 42.17 on the S&P. We advance 0.1% there. In the bond market, yields basically unchanged, come in almost a basis point at 148. When you're buying a home in America, you might not be competing for that house with someone in the next town over. Maybe from someone out of state. You might be competing with the likes of Blackstone. Here's one for you guys. Blackstone Group agreeing to buy a company that buys and rents single-family homes in a $6 billion deal. The giant investment firm reaching a deal to acquire Home Partners of America, according to people familiar with the matter. The Wall Street Journal wrote a lovely article about this, I think back in spring, Lisa, about the competition for single-family homes in America. And your new competition, I say new, let's just say the competitor is over on Wall Street.
Yeah, the idea here that it's mass purchases, sight unseen, and they're going to come in with a bid beyond what you as an individual could potentially buy. Wall Street increasingly owning Main Street homes, raising questions about rents going forward, raising questions about affordability at a time when the average home price in major metropolitan areas rose 13.2% in the year through March. Just to give you a sense of how much there has been this powerhouse behind prices
Lisa,
of homes.
Raising questions about the social warrior status
Yes.
of the Federal Reserve, Tom. Are these the kind of things they want to see happen? I doubt it.
I think they're going to become overcome by events on this, and it's hugely regional. There's huge dynamics here in rentals. We're all, inured to the New York City landscape where there's a real theory of rent versus buy. But a lot of other areas are different, and the crowding out thing here, John, is tangible. There's a lot of research going on about what big institutional money means for crowding out and moving up prices.
And Tom, when it comes to the Federal Reserve and the asset purchase program, I know this is just one example, but more broadly, this is a story. Do you think this puts pressure on the Fed to remove the accommodation they're providing to the mortgage market?
You're
through
right
MBS?
that it should, but no, I don't think
Hold
it's
on a second.
tangential.
Actually, one of the main things that stemmed from last week's meeting was that the first way that they would start to taper would be to reduce their mortgage purchases, that they would actually focus the adjustment on that level. And the mortgage market has actually underperformed pretty significantly since there. So perhaps, John, exactly to your point, the Fed is taking stock of what's going on in housing.
An example of why they might have to move, Tom.
Yes.
Another example this morning, Blackstone betting $6 billion on buying and renting homes. And let's be clear here, this is not Blackstone's fault. This is the fact, Tom, that you can't get a yield anywhere else.
Oh, we'll have to see. Right now, joining us, someone who has been extremely busy within the tri-state area, and particularly the 5 boroughs of New York City, and that is our New York City Bureau Chief, Shelley Banjo. She joins us too briefly here this morning. Shelley, if you were to provide a distinction today on this election, what is it? To me, it has been the ascent of crime, the ascent of what are we going to do about safety in the city. But what is the Shelley Banjo distinction of this vote today?
Thanks, Tom. It's a real vote on how you want the city to recover. So early on in the election cycle, you saw a rise of a candidate like Andrew Yang, who was saying, you know, I want to bring hope and cheerfulness back to a city that's still in lockdown. Over the few months, everyone's kind of come out of their homes and realized, well, actually, maybe some of the more quality of life issues like crime, like trash on the streets, maybe some of those things are a little bit more important right now to me than some of the more ideological battles that were fought over the last 8 years in New York.
Shelley, Tom's been talking a lot about turnout, that typically with primaries, there isn't that big of a number of individuals that actually go out and vote. Do we have a sense of what turnout will be like this year?
I think that is the most important question that is on everybody's minds, because there's so many different variables this time around. So already about 200,000 people voted early in the elections. It's hard to compare it because last time around there wasn't early voting. But during the presidential, 1.1 million people came out. That's always the case, that there's more people for a presidential election, especially one like 2020. But it's really hard to know. Also, new things, ranked choice voting, the primary in June when it's usually in September. Just a whole bunch of changes this time around that make it harder to kind of figure out and game what's going to happen.
Traditionally, Shelley, New York City has been pretty progressive, and we see a roster of pretty progressive candidates. They are not in the lead, and in the lead is the issue of crime. Can you give us a sense how the increase in crime in New York City has readjusted, completely reshaped the landscape for politics in New York?
Yeah, politicians like to say that it's not just the crime numbers, but it's also the perception of crime that matters to people in New York, because if you perceive that things are bad, it doesn't really necessarily matter the numbers. You still don't want to go out and take the subway. You still don't want to go out to the museums. And so basically it's all tied together. There's no economic recovery until you get the crime rates down. There's no tourism. There's no jobs, there's no, any of those things until you get the crime rates down. And so that's why everything focused on crime, because people are looking around saying our unemployment is still double the country. We depend on tourism here. We depend on getting life back, Broadway, whatnot. And if you have shootings in Times Square, you can't do any of that. And so that's why crime really became such a hot topic during, and continues to persist during this campaign.
As it should do. Shelley Banjo, thank you. Bloomberg, New York City Bureau Chief. Looking at this market, Tom, 42.18 on the S&P, pushing 42.19. We advance a little more than 1/10% in the equity market.
It's the way we're advancing, John, and this goes back to strategic notes, whether they're out 6 months or a year or they're out 6 hours. This idea of a grind higher, which you see on the Bloomberg terminal when you look across equities, bonds, currencies, commodities. I mean, just in oil, you've seen the same. This grind nature is back in vogue, particularly in equities.
That grind is back, Lisa, after a big bounce in yesterday's session.
Yeah, I'm struck by George Saravelos of Deutsche Bank. He put out a note this morning, basically talking about bond yields being low, equity prices being high, and how this basically is being back to secular stagnation 2.0, and that is what markets are currently pricing in. My question is, how far can equities continue to churn higher in secular stagnation 2.0?
Secular stagnation, 148.35. Do you think that is screaming something bad in the bond market right now? Lisa, do you think that bond market screams anything bad, anything sinister, anything to worry about?
The messaging, I think, has gotten a bit muddied, and not necessarily by the Fed's bond purchases, that certainly, but globally, the central bank's reaction function, the fact that there's so much money and that you've got foreign investors coming in because on a relative basis, the U.S. is pretty high yielding.
Are we really questioning the Fed's reaction function after last week? Is that what's been happening, Tom?
I'm not. I'm real clear on this. It's been, it's been a roller coaster coming off of the Fed show, John. 201, things just lit up, and we lit up, down, whichever series you're looking at. But the end result here are officials calming the markets. And are we going to see that?
Yeah.
I'm going to say it, John. This John Williams interview today with you and Michael McKee is without question the interview of the day. I don't know what else to say.
I think that was a sincere promo.
It was.
Of 9:30 Eastern.
No, I mean, John, this is serious stuff.
Thank you, TK.
The theoretical construct of our start is a huge deal.
From New York, this is Bloomberg.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
From New York, live on TV and radio, here's the price action this Tuesday morning. Good morning to you all. Equity futures advancing a little more than 0.1% on the S&P. 42.20 in sight on the S&P 500 after a nice snapback in yesterday's session following 4 straight days of declines. Energy and financials leading the gains. Speaking of the banks, the financials, can you get a nice bid into the banks if the yield curve doesn't cooperate? So let's talk about the yield curve. 5 versus 30, switch up the board. A chart that topped out back in late February, just north of 160 basis points. Right now, about 121. A severe correction last week and just a small bounce in the last 24 hours. We had Steve Orth, the Federated, on a little bit earlier this morning, talking about sticking with that long bank story, but he needs the yield curve to come with him for the ride. And so far, we have not threatened to take out those highs from late February, late March. That's the bond market. Let's finish on crude. WTI and Brent. A little bit later this morning, in about 45 minutes' time, we'll catch up with Francisco Blanch of Bank of America, talking up triple-digit crude next year. $100 a barrel, maybe. Right now, TK, on Brent, 74.52. We had a little look at 75. We've come back. On WTI, 73.15 and down about 0.7% there as well. But that's the call from Bank of America. And it's a big one.
Well, it's a big call based on GDP, John. And then to be clear, 2 years out, they come back to $65 a barrel because shock, microeconomics works, supply comes on, and down comes price.
That gets your attention in the equity market, too. Let's talk about some movers and say good morning to Taylor Riggs. Hey, Taylor.
John, we tried to get Francisco on the show yesterday. They told us you stole him for the morning show, but that's really where I wanted to start. That call at $100 a barrel. Right. You have B of A, you have Trafigura, you have Goldman sort of all making these calls of $100 a barrel is in reach. You're getting a lot of upgrades on some individual stocks, but you're not seeing the follow through as we turn unch to negative on some of the best performing stocks that we had earlier within that oil space. So let's look at a place where we are seeing some action. Norwegian Cruise Lines. This is getting an upgrade at Wolf on improving booking momentum, but that doesn't help the stock. Delta, we know that we're coming off of a really strong weekend within the travel space. They are now trying to hire about 1,000 pilots. You cannot get these people back to work fast enough. And finally, we shift to perhaps maybe some of the meme stocks. We do this just for Tom as we talk about fundamentals, trying to register an additional share sale. RBC saying that they need more cash. Not enough right now for Nikola. And finally, let's take a look at MicroStrategy. What happens when you sell debt to buy Bitcoin, an average of about 37,000 a Bitcoin? Bitcoin falls to 32,000. You have a $77 million write-down, John, on the balance sheet.
Taylor, thank you. I think TK's got something to say about this.
No, just, the whole Bitcoin thing. I mean, Novogratz was on with some really important comments from our Qatar Economic Forum. And John, there it is. It's critical support. A 29,000 print is a huge deal for Bitcoin.
And TK, Taylor got up early. Promo the show.
Yeah.
You going to do that? No,
yeah,
don't fancy
so.
it? Taylor,
thank
you.
This afternoon, probably with
the
guests.
Close starts at 2 p.m., we're told. A little bit later this afternoon, every weekday.
Oh, very good, John.
Thank you, John.
All right.
Being polite.
Insert the real yield there, and
that's the price we pay for an appearance, isn't it?
Yeah,
the promo.
Absolutely.
Okay, some of our contestants stay at the Essex House. Thank you. Right now, and this is really important. This is the interview of the day that links Chairman Powell to President Biden to all the politics of this nation. If you are ever so lucky at Wellesley College, long ago and far away, you studied the Cobb-Douglas production function with Carl Case, and that was a special thing. Betsy Stevenson of Wellesley and Harvard joins us now at Michigan, holding court on labor share. Betsy, labor share is a stunning trend from World War II. It's because of technology. It's because of productivity, this, that, and the other thing. Are we finally seeing a stasis or shift in labor share where they get back on board the economic pie?
Well, I mean, I don't know whether we're going to see the labor share start to climb up, but I do know that what we're starting to see is a return to workers having some bargaining power, particularly at the bottom end of the income distribution. Their services are in demand all over the shop. Those are those help wanted signs you're seeing. And we're telling these workers, not only are your services wanted today, but they're probably going to be wanted just as much or more next month. So take your time, pick your employer, start listing your demands. And they're definitely doing that. That's why we're seeing wages getting pushed up at the bottom. We're seeing people quit jobs. We saw more people quit retail jobs in the month of April than at any other time in the series history over the last 20 years. So workers definitely have some oomph in them right now, and they're using it to find a better place for themselves.
Wells Fargo was just on looking at nominal GDP over 11%, 7.3% plus like a 4% inflation rate. And I get that's an outlier call and on that. But Betsy, the bottom line is when the fiscal stimulus drifts away, when nominal GDP comes in as well, do you have a confidence that labor share increases can continue?
Well, I mean, I think that we're in the midst of a pretty great reckoning with how we've treated workers and how we've let inequality explode. I'm not at all confident that the market's going to solve that problem all on its own and that we're going to see all of a sudden a rebound of the labor share of income. I'm not confident of that. I think we're going to need policy change to actually see some permanent, real change done. But I think we are seeing what happens when we give workers some more power.
Betsy, one of the reasons why you're so brilliant, and I love speaking with you about economics, is because you dovetail the human behavior into it, that basically the choices that we make determine these broad macroeconomic changes. And as we talk about the labor market shifts, what kind of fundamental changes in behavior do you observe post-pandemic about people's choices about where to work, how many hours to work? What are we seeing so far?
So, you know, normally when we come out of a recession, everybody is worried that there's not going to be enough jobs. And so when you get offered a job, you just take whatever you get because you don't know if there's going to be a job coming down the pipeline. This pandemic is completely different because we see that the economy is opening up and there's going to be job growth all over. So I think you see a lot of people being willing to take their time. That's very unusual in a recovery. But I think there's something that is deeper than that that's going on, which is we've all had a really, really weird and in many ways bad year and a half. And I think all sorts of people are stopping and asking themselves, should I be doing something different? I think that happens in everybody's life at some point, but I've never seen it happen to a nation all at once. And so we're seeing a great rethinking underway. And we're going to see that in the macro data because we're doing it as a macro group because we all had this correlated shock, which is the pandemic has caused us to question what we're doing with our lives.
And how does that read through to the discretionary spending, to whether people go out to eat versus eat home the way that they have been during the pandemic? I mean, all of these types of broad macro shifts, what other lifestyle changes are you observing in the data?
Well, you know what? I think that it's too soon to see what's going to be permanent and what's not. And you're certainly seeing lots of people with things fully opening up, ready to get back out there and, you know, party like it's 1999. But there's a bunch of people who are still nervous and people who don't want to take their masks off, people who don't want to be in crowds. And I do think that there are a lot of people who psychologically, it's just going to take a little bit to get them comfortable again being in a crowd. And that's going to change their spending preferences. Look, for sure, we're seeing people finally buying clothing again. You know, they've got those weddings that they are going to go to this summer, so maybe they should buy something new to wear. But I don't know that we're going to go back to spending in the same way. I don't know that we'll go back to buying the same kinds of things. And certainly, I think the technology shock, really the adoption of technology shock that happened over the last year, that is for sure going to stick with us. And we're not going back to the mall, to stores, to shop in the same way. I think people are trying to figure out how much are they going to continue to do remotely versus what are they going to go back and do in person? And, you know, almost everybody I know hasn't fully figured that out yet. They have a bunch of activities that they're continuing to do remotely that they used to do in person that they're just not ready to go back to doing in person, or maybe they don't think the value proposition is there for doing it in person. So I don't think we're seeing business travel coming zooming back anytime soon.
Betsy, we've got to go. We've got some breaking news. Got to leave it there. Thank you. Betsy Stevenson there. Getting some breaking news on Dr. Catherine Mann, formerly of Citigroup and, of course, the OECD as well. Catherine Mann being named to the Monetary Policy Committee over at the Bank of England, a 3-year term which will begin on the 1st of September 2021, Tom. The doctor, Catherine Mann, replacing Gertan Vliega, who has served on the MPC since September 2015.
This is an inspired selection, John, and this goes to the Prime Minister at the G7 meetings as well. Catherine Mann, not only with her recent tenure at Citigroup, but also her academics, her profoundly important monograph, John, of a number of years ago, Is the Trade Deficit Sustainable? And then she did what is so rare in economic research. She topped it. Her definitive discussion of the codependencies of China and the United States will be of huge service to the Bank of England. This is truly an international choice for the England. You don't see this, John, at the Fed.
I think we should see a lot more of it. Chancellor Rishi Sunak of the UK saying, I'm very happy to announce the appointment of Dr. Catherine Mann. Her breadth of experience, Lisa, across policy research and the private sector will be immensely useful to the MPC.
I wonder if it was sort of tea leaves that she had a big map behind her head whenever she came on Bloomberg Surveillance, that was her backdrop, was a global map, and perhaps that's the view she brings as monetary policy becomes increasingly international.
Well, it does, isn't that the story? We've got a more international outlook, and we need one for the Federal Reserve as well.
Well, that's what the Prime Minister says, John. I mean, the Prime Minister didn't mince words about it. He is looking for global Britain, and this is something, I'll be blunt, the United Kingdom does this better than the United States.
To attract the right
active
talent.
outside
Are you
members
just
coming
trying
in.
to make John feel comfortable?
I think he is.
No, I'm serious here. They had Adam Posen on the board.
You guys do this better than we do.
No, they had Adam Posen on the board and the rest of it.
There's a history of this, I think is what you're trying to get at, Tom. Yeah,
there is. I mean, this is really a big announcement for the internationalization of the Bank of England.
Is this how people make me feel comfortable? Your central bank's better than ours.
Seriously, this is flattering.
Not
surveillance
my view,
style.
because I'll be catching up with the New York Fed President, Mr. John Williams, a little bit later this morning. Michael McKee, of course, helping us lead that interview. That'll take place at 9:30 Eastern Time, there and thereabouts. Your S&P 500, 42.18 on the S&P. We advanced a little more than 1/10%. From New York City this morning, good morning, live on TV and radio. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. The bipartisan group of senators working on an infrastructure deal say they're getting closer to an agreement, but they say they're still trying to figure out how to pay for the plan, considering White House opposition to indexing the gas tax to inflation. The lawmakers are set to meet White House officials today and plan to draw up a framework for a proposal this week. GameStop climbed in pre-market trading today after announcing that it completed an at-the-market offering program by selling 5 million shares for a total of more than $1.1 billion. Shares of the video game retailer surged as much as 11%, trading after the announcement. The company says it will use net proceeds from the offering for investing in growth initiatives and maintaining a strong balance sheet. Blackstone Group has agreed to buy a company that buys and rents single-family homes in a $6 billion deal, according to Dow Jones. It's a sign Wall Street believes the U.S. housing market is going to stay hot. The investment firm is said to have reached a deal to acquire Home Partners of America. That company owns more than 17,000 houses, which it rents out, and offers its tenants the chance to eventually buy. An NFL player, Karl Nassib, has announced that he's gay, making him the first active player in the league to come out. The Las Vegas Raiders player revealed the news on Instagram, saying he's pretty private, but hopes that his coming out would mean other people would not have to make similar videos in the future. He added he's donating $100,000 to a non-profit that works to prevent suicide amongst LGBTQ+ youth. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
The British financial system has to do business in Asia as a whole, in China in particular, and of course that includes Hong Kong. And naturally, we don't make the laws in those countries in Asia, and certainly not in China or Hong Kong. We have to abide by the laws that are locally made, even if there are many aspects of them with which we disagree.
And apparently there are many. That was Lord Mandelson there, the Global Council Chairman, speaking to Tom Keene at the Qatar Economic Forum. From New York City this morning, good morning, alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Your equity market looks like this on the S&P 500. We add a little bit of weight to the S&P, up a little more than 4 points, advancing 4 points, up almost 0.1%. Outside of that, into the FX market, euro-dollar back with a 119 handle, some dollar strength early this morning. We give some of that up. Euro-dollar now down to 119.01 and off by 0.15%. And just quickly, Tom, your 10-year back with a 149 handle. Your yield coming in just a little bit earlier on this morning. Again, that move kind of fades as this session grows older, back to 149.03 on a 10-year yield.
And look where the calendar is ending here in June 30, end of the second quarter, and then we begin the earnings soiree. There's no one at Bloomberg who does earnings better than David Wilson. And David, Steve Auth, the Federated, said they've done their recalibration out front of David Wilson, $250 on S&P earnings, and you fold that into price earnings ratio to try to figure out where the market is.
Indeed, and it's something that Keith Parker at UBS did in a research report the other day, really looking at the forward price earnings ratio on the S&P 500. So you're talking about earnings estimates 12 months out and using that as a basis for valuation, and then comparing that with what's going on in the bond market, specifically the real yield, inflation adjusted on the 10-year Treasury.
Continue.
Absolutely. So what we've seen is that the forward PE on the S&P 500 has come down because earnings estimates have been going up. That's how you get that $250 number as an example. And at the same time, if you look at the past few weeks or so, that real yield has kind of hung in there. So the way that Parker's looking at things, even if you were to see that real yield move up, in other words, bond yields rising and inflation adjustment as well, then, stocks would be in a position to handle that.
And the only way to really understand this relationship is to watch the real yield at 2 p.m. on Friday.
1 p.m.
Oh, excuse me, 1 p.m. I'm sorry, I was thinking Nova Scotia time.
Yeah, well, yeah, absolutely.
John's back, David. It's that bad.
I see that.
Yeah, I see
Welcome
that.
back, John.
Lisa, save us.
Thank you, Dave. Appreciate it.
Okay, honestly, Dave, there is a question implicit in your chart here, which is something that John and Tom were talking about earlier. How important is it for us to not be at peak growth, for us not to be at peak earnings acceleration in order to keep this rally going? How much does that have to continue to make the current valuations worth it?
Well, there's no doubt that it has to continue, if only because there is so much optimism kind of built into estimates at this point. You look at the second quarter for the S&P 500, we put together the individual company projections. Analysts are anticipating earnings growth of more than 60%. Now, you can argue that number is skewed because of, last year and the pandemic really affecting a whole lot of businesses. But at the same time, you look at the shift that's gone on, people going back to some extent to the areas of growth in the stock market and backing away.
So you're observing a growth tendency here, away from value?
I mean, when you look at technology, when you look at energy, there's some of that. And at the same time, look at the economically sensitive areas of the market, finance, materials, they've suffered a bit. So, the question is, does growth kind of pick up from here? And does that bear out in terms of earnings?
David Wilson, thank you so much. Greatly appreciate it. And John, that gets over to, what's going to be growthy out there. And there's different kinds of growthy as well. All this, frankly, within the social moment that we're in is wrapped around John Amazon Prime Day, I think it's called. I've never bought anything on Amazon Prime Day. I really don't get it.
Let's try and make it really simple. If the Federal Reserve moves earlier than you anticipated, and you do believe, some people do, that they might choke off growth prematurely, then growth equities become a little bit more expensive because growth becomes scarcer. That's what I think we saw last week,
But
Tom.
Anna Hahn and Steve Auth told us
they disagree.
There's another way to go here, which is, and John Writing's been great on this at Bear Stearns and at Breen Capital now, you can have a good economic and markets rate rise.
Yeah.
That's
Hahn
not in the zeitgeist
wants to stick with
now.
the banks, the financials. Steve Auth, the Federated, wants to stick with the banks, the financials. Lisa, Steve Auth, though, also acknowledging that for that to develop in the way that he anticipates, he needs the bond market to come with him.
What's been shocking is that stocks have moved pretty much sideways for a while now, but the rotation under the surface, we keep talking about the various rotations, it's been pretty dramatic, and this is something that Dave Wilson actually pointed out, that over the past month, real estate has gained 6.4% in the S&P 500. Materials down 5.2%. John, incredible sell-off, a sort of retracement in commodities that have been completely overblown and inflated over the past 12 months. There is a question here of how long-lasting this can be. Will the Fed, for example, curtail their mortgage bond purchases and then try to take some of the wind out of the sails of real estate and give it back into other areas? So in other words, how do they nuance this in order to affect markets in a way that they see prudent?
You mentioned real estate. Should we go back to the story of the last hour from Dow Jones, that Blackstone has agreed to buy a company that buys and rents single-family homes, a $6 billion deal to acquire Home Partners of America. Lisa, this was controversial earlier this year. It's getting even more controversial as the year progresses.
And this has been a trend that has really started off in the aftermath of the 2008 housing crisis. This idea that big Wall Street firms went in and bought mom and pop Main Street homes in bulk and then rented them out. It raises a policy question about how high rents can go. It raises a question of barriers to access for the individual to really own homes, especially at a time of such low interest rates.
Well, let's talk about the policy question. TK, the Federal Reserve has been very clear about this social warrior side of their mandate that Chairman Powell increasingly has taken on. This clearly is one of the downsides of the policy, that you start to get Wall Street getting involved in home ownership in America in a much more prominent fashion.
I'm sure they would push back and say their financialization of it provides a benefit, and as they say on their website, a path to home ownership. What I would suggest, John, is they're going to focus on the mathematics of John Williams. The R-squared debate right now is front and center, and John, this comes back to the reaffirmation of potential GDP. We had Ferroli at JP Morgan tell us he stands by their low statistic, and Jan Hatzius sat in our studios, 6 days ago, and said we're going back sub 3% GDP. They're way more focused on that.
So, TK, how much daylight do you think, and I imagine you believe there's some daylight, between the likes of Bullard Kaplan and the likes of Williams?
Oh, I think there's daylight, but they're supposed to be. That's what they did in 1917 and up to McChesney Martin and the independence of the Fed. They're supposed to argue. And it's normal to be that way. I think we do the world-class best interviews of central bankers worldwide and in the United States. But this interview with John Williams is going to be intense this morning. He has to re-justify their math.
Mike McKee helping to lead that interview at 9:30 Eastern, coming up a little bit later on. this morning on The Open. Coming up on this program, Binky Chowder, Deutsche Bank Chief Global Strategist. Looking forward to that conversation with your S&P 500 approaching 4220. On the S&P, we advance a little more than 1/10%. Your bond market is unchanged on a 10-year maturity. Your yield is 148.86. Euro dollar back down to 118.99. From New York City, live on TV and radio for our audience worldwide. This is Bloomberg Surveillance.
Freedom delayed. 4 more weeks. That's the delay expected to be added to the lifting of all lockdown restrictions in the UK. It had been due to happen on June 21st, but UK Prime Minister Boris Johnson to address the nation later today and to push that date into July. It's all down to a surge in the Delta variant, and government ministers thought to want more people to have their second COVID vaccine before they ease all restrictions. How are markets responding? Well, they're largely taking it in their stride. The FTSE 100 actually gaining ground. Strategists saying that delay largely priced in, that we could see further weakness for travel and leisure and hospitality stocks. The pound falling against the dollar, though Nomura saying this weakness likely to be temporary. In fact, money markets largely bullish on sterling, given the pace at which economic gloom has been lifting here in the UK. Indeed, last week's GDP figures pointed to an economy that is recovering quickly, and later this week we'll get unemployment, inflation and retail sales data that should all further illuminate the economic recovery.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The Fed is not going to kill this recovery.
Public's hype over inflation had gotten too high. The Fed got spooked.
Looking ahead, I think we're going to have real issues deciphering this data.
Given the rise of inflation, the hawks are more willing to show their hands.
If you think inflation is not going to be transitory, it's because you think the labor market is tight
and we've tapped out earlier than we might hope.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene is simulcast. Bloomberg Radio, Bloomberg Television, and news breaking here, there, and everywhere. And John, the elephant in the room to your important interview with John Williams today. We see that in about an hour, maybe 2 hours. John, there's a Hungarian central bank wanting to raise rates. That permeates this discussion and what it means for the markets.
There's another central bank in the mix. Another headline I want to get to as well, Tom, is China selling 20,000 tons of copper from state reserves July 5th to July 6th. The copper price in London correcting just a little bit, still positive on the session, Tom, at 41.94, up on the day by a little more than 1/10 of 1%.
Well, the cross currents are there, and of course, it all comes to the volatility we see, including a Dow up 500 points. You've got to be in the markets, and our guest here to start the hour has said you've got to be in the markets. John, your observation right now with a VIX 20 in seconds into 17.42.
Look, my observation is something someone close to me recalls as kindergarten macro. Kindergarten macro is when you use last week's price action to project things out several years.
I like that.
And in the bond market, that's what we saw last week, Tom, with a big correction. Then all of a sudden, people coming out and changing their views about several years out, based on a price action of a single week and a very subtle shift from the Federal Reserve.
And, of course, a lot of Fed speak we'll get today. And, of course, we're celebrating Catherine Mann being picked up by the Bank of England as a new member. That's exciting. Lisa Abramowitz, I look at it, and you have to fold it into the bond market and the observation of that deep market. Which part of the bond market, Lisa Abramowitz, matters to you right now?
Everybody's watching the yield curve to see whether it continues to flatten or whether they get a re-steepening, a sort of acceleration in longer-term growth expectations. I do just want to build on one thing, this headline about China selling copper from its state reserves. This is the first time that China has done this in a long time, in years. And it basically is a reflection of how they are concerned that high commodity prices will curtail their recovery. This is the concern. At what point will the inflation that we've seen in commodities, in certain assets, actually hamper growth, lead to the stagflationary environment that George Saravelos of Deutsche Bank was talking about in his note this morning?
That's too much linkage for me. All I know is they're unloading a lot of copper, and we'll see from that. That's out a couple weeks, actually, that they'll do that. The market's move. The VIX comes in with a vengeance, 16.80 in a full stick right now. John, the percentage changes matter. The NASDAQ 100 leading the way, a little bit up and elevated. John, what do you see?
Looking at a bond market that's just had a huge intraday trading range over the last couple of days. Yesterday was amazing, 135 at the lows. The high is pushing 150 right now, 148.69.
Yeah, and then oil, 70. John, we had a 75 print on oil.
I know.
We talked about it earlier with Bank of America.
10 minutes.
$100
10
a
minutes
barrel.
time, Bank of America. And triple-digit crude maybe next year.
We'll see that with Francisco Blanch. Right now, and this is a joy, to bring in Bikram Chadha of Deutsche Bank, their chief global strategist. Tons to talk about in a 3-hour conversation with Binky Chadha. We'll bring it a little tight. And Binky, I want to first shout out the invention of modern Deutsche Bank strategy and economics. You guys are on fire. David Folkerts Landau is looking out 3 and 4 years to inflation. Your colleague, George Saravelos, is near term, maybe going the other way. Are you caught in the middle between DFL and Saravelos?
No, I think I wouldn't describe it as being caught in the middle. I mean, I think, if you take an issue like inflation, which we really haven't had for 50 years now, it's the most reasonable outcome is that reasonable people will have very different views, and I think that's exactly where we are. We've got a baseline view that inflation is a risk, and just that, a risk, but I think the risk, the tails are pretty fat, and I think that's the key point here.
Binky, we've had Wells Fargo on this morning, Federated on this morning, and when they are confronted the question whether you want to be long banks or big tech, they're going with the banks. Are you?
I'm long the financials and the banks. I'm also long energy. I think one of the dynamics that one needs to keep in mind over the last 18 months or so is that this is not a market that has, except for the very early part, trended very nicely. It's been a series of step functions. And so, when I look at the S&P 500 and I ask myself what's not priced in, and I would argue, it's oil prices. I would argue there's plenty of upside on, the global recovery continuing, especially if the dollar falls. Keep in mind that, you need 3% down on the trade-weighted dollar to get 10% in oil prices. So I think it's very, very reasonable that we will see $80 oil by the end of the year. And the other thing that's not priced in, and that's completely out of whack, are rates. And so you want to be long, basically, the financials. Other than that, I would be pretty careful here, and I would say, we continue basically to look for, a sizable pullback, not the mini version that we had on Friday. And that's going to hurt both the financials and energy, but we can have independent moves, oil prices and rates, simply because of, where we are relative to where we can
Well, let's build on that, Binky. You went on a tour of the asset classes there. Can that bank's call happen independent of what happens in rates, or is it dependent on what happens in rates?
I think it is dependent on rates because, if you just look at the last 18 months, financials have been trading, very, very closely with the U.S. 10-year yield. And so the pullback is in the financials relative to the market is, very easily explained by simply what's happened to the 10-year yield coming off its highs.
Binky, at the core here, there is a tension between growth and inflation. Two different things that are often conflated. And we're seeing inflation as you see oil prices heading toward $80 a barrel at the end of the year, and we see it in certain commodities, which possibly is what China is responding to with selling from its strategic reserves of copper. But we're wondering how much this is asset price inflation, whether this is inflation of key goods that leads to stagflation, as your colleague George Saravelos seems to suggest. When do we have a sense of that?
I would say, stagflation really has two parts to it. So the first being growth. I think the key issue and point here is that, growth generally peaks, about a year into the recovery. That's kind of where we are. If you look at our house economics forecast, if you look at the consensus economics forecast, growth rates are meant to peak in the second quarter. And the stronger the second quarter is, the more likely, the sharper the peak is going to be. And I think that, there are always differences in every cycle. And the market has so far sort of diminished the peak or ignored and shrugged off basically the peak growth thesis. And that's because, we have this big gap between goods and services right now. But I think anybody's investment thesis at this stage, needs to confront a very simple chart. You have a retail sales growing for 5 years, a 4% trend rate. It's nominal, purchases of goods. And if you ask, where are we today? We are 10 percentage points above the trend line. And that strongly argues for, not only slower, but very likely slow growth on the goods side. So the big question is, what's going to happen on the services side? And sure, there will be an expansion, but services don't tend to go on the other side of the trend line. And so that, on the whole, basically argues for a slow growth. On the inflation side, I would argue, this summer, yes, it is important. But remember that inflation, generally lags. So this problem's not going away. I mean, if you look at historically how inflation's behaved relative to, when people talk unemployment, the output gap, it's next year that's going to be the problem.
The great missed call of the decade or 2 decades has been the certitude of single-digit equity returns. Mm-hmm. Wrong. SPX 16% per year for the last 10 years, I think. Are we going back to a single-digit structure? I mean, everyone's predicted it, and yet you and the other optimists have said, no, you got to play. You got to be in the game.
So I would keep in mind that total returns S&P 500 last 100 years, since you did bring it up, is about 11%. It's a very, very clear trend channel.
And the Gloom crew is saying it's single-digit.
Yeah, so I would say, given what's happened last year and this year, we have brought forward some of that return. So single digits, next few years is not unreasonable.
Binky Chandler in the studio. from Deutsche Bank, the chief global strategist. The chief global strategist at Deutsche Bank is allowed about 6 feet away from TK. Yep. Lisa and I.
But this is, John, what I opened with there. John, what Steve Roach at Morgan Stanley did this, and DFL did this as well. This Binky's writing about this. This intellectual diversity thing that's okay within a shop, John, to argue. Arguing is normal. Well, you say that, but Binky and I remembered when everybody, if they weren't on the same page, they were shot.
No, you can argue behind closed doors, Tom. You just can't argue publicly.
Steve Roach and others like David Folkers Landau said, no, we're going to do it visibly and open.
1836.
And that's great.
Coming up, Francisco Blanch,
I'm
Bank
serious.
of America
This is a
Securities
big
Head of
deal.
Global Commodities and Derivatives Research. Just reading, it's the one thing I read, the
You're
thesis.
just going to keep going.
Yeah.
Honestly, that'll be a really interesting conversation, and I'm wondering how much pushback he has from others in Bank of America. How about that?
Triple-digit
credit.
Nailed that, Lisa.
Thanks, I'm trying.
Here's the price action. I've no idea what's just happened. 42.19 on the S&P. We advance a little more than 0.1% on the S&P 500. Yields unchanged on a 10-year, 148.86. Just remarkable to see 135 at one point yesterday. Where did that come from? Then a huge unwind of that move as well.
It came before the Fed people talked.
Euro dollar 118.95.
They spoke.
And one of those
your
Fed
interview,
people,
John, your interview with
President
John Williams is going to move the market.
Fed person.
President Williams coming up at 9:30 Eastern. Mike McKee happened to lead that interview. Really looking forward to catching up with the New York Fed president a little bit later on Bloomberg. Live on TV and radio for our audience worldwide, pushing 42.20 on the S&P 500. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. The U.S. says 150 million Americans have been fully vaccinated against COVID-19. That's more than 45% of the population, but cases are rising in several poorly vaccinated states, with more young people being admitted to hospitals. The highly contagious Delta variant, first identified in India, has been spreading in the south. And India gave out more than 8.6 million vaccine doses in the last 24 hours. That's a daily record for the nation. New cases in the hard-hit country have dropped to the lowest level since March. However, less than 5% of the country's population is fully vaccinated. Some experts are warning that a third wave as the economy reopens from lockdowns. And coronavirus infections surged to a record in South Africa's industrial hub, prompting warnings about hospital capacity and calls for tighter restrictions. 1 in 4 South Africans live in the province, where Johannesburg, the country's biggest city, and Pretoria, the capital, are located. ExxonMobil is said to be preparing to cut some jobs at its U.S. offices. Bloomberg's learned an evaluation system will be used to identify low performers and to cut 5 to 10% annually for the next 3 to 5 years. Exxon had 72,000 employees globally at the end of last year, 40% of them within the U.S. And Netflix has signed director Steven Spielberg to a multi-year deal to create content. The streaming service secured an agreement with Spielberg's production company, Amblin Partners, in a deal that builds on an existing relationship. The two have teamed up before on last year's The Trial of Chicago 7 and another project that's currently in pre-production. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
we're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
It is something where you will quite quickly, I think, run out of spare capacity as that demand recovers back to pre-pandemic levels. So, given the conditions that we are seeing, given how quickly, frankly, we've come from $35 back up to $70, up to $75, this is something that you could see in the next maybe 12 to 18 months.
That was Sandra Rahim there, the Trafigura chief economist from New York City this morning. Good morning, alongside Tom Keene, Lisa Abramowitz. I'm Jonathan Ferro. Tuesday morning shaping up as follows as we count you down to the opening bell. 1 hour and 12 minutes away. Your S&P 500, 42.20 there and thereabouts, advancing a little more than 1/10%. The story of the commodity market. WTI crude with a 73 handle. Brent crude had a little look at life north of $75 a barrel this morning, Tom, at 75.30. Right now, 74.58.
It is the way it has gotten there. And of course, this is all about the microeconomics and the underpinning of supply and demand. Someone expert on this and consistent in well-written thought is Francisco Blanch of Bank of America Securities, head of global commodities and derivative research. I want to go right away, Francisco, to what is less talked about, and that is the demand dynamic. What do you envision to be the demand dynamic that gets you to your acclaimed $100 a barrel?
Hey, Tom. Hey, thanks for having me. So 3 things are key here. First, there's a lot of pent-up demand. We've all been locked up in our living rooms, in my case, but really with very little movement, whether it's business or personal. There's a huge amount of pent-up demand that we're already seeing in the U.S. The rest of the world is going to join soon. Europe is maybe a couple months behind, and emerging markets are between 6 and 12 months behind the U.S. They're the big laggards, but we think they're going to come back in a huge way over the next 12 months as vaccines get distributed. Second reason, Tom, is really around what we call the avoidance of mass transit. People are going to be using more private vehicles, avoid subways and buses for an extended period of time. Third reason really is what we call the new work from home, or as we put it, work from a car situation. People are going to be working remotely 1 or 2 days a week in the future, and that's going to lead to more driving, not less driving, in our view. Again, we are basing this opinion on estimates pre-pandemic and studies pre-pandemic that suggested that 1 or 2 days of work from home eventually leads to more, not less driving. Those are the three main reasons on the demand side, Tom.
Of course, on the flip side, when it comes to the demand picture, business travel not coming back as quickly, with a lot of companies saying that they are going to return to just small fractions of what they used to do. How much does that factor into your estimates?
Well, so business travel is a big factor for airlines, but let me just give you one data point. In 2019, average travel was roughly 2.3 million passengers per day going through TSA checkpoints. We are back at 2 million, and we still don't have any business travel going on. So clearly, I think the pent-up demand story seems to me is going to overwhelm the business travel story, at least over the course of the next 12 to 18 months.
Yeah.
I'm not claiming this will last forever, but I think there's going to be a huge surge here over the next few quarters.
On the flip side, the supply picture, we have this morning a story about how Russia is arguing potentially for an OPEC plus supply increase, a boost based on this increase in demand. You're starting to hear about shale producers eyeing what it would look like to bring a little bit more production online. How much do you expect that to accelerate? How does that affect the $100 a barrel call?
Right. So it certainly does. My expectation with regards to shale is that we're going to see producers lagging for the most part. Remember, there's three elements of this that on the non-OPEC side that are going to hold back supply. Number one is the fact that government policies are going to pressure companies to invest less. Right? We are seeing that with International Energy Agency calling for an end to oil and gas investments to meet Paris climate goals. Second reason is we are seeing investors pressuring companies, whether it's for financial reasons to see more cash flows coming back, or for ESG reasons to reduce investment. And the third element really is the judiciary. We now seen with the case of Shell that the judiciary can also get involved and force you legally to reduce your emissions. With regards to OPEC, it's the big risk in our call. Does OPEC discipline hold? My guess, it probably will. Remember, we've only averaged $64 a barrel so far this year. The average OPEC budget is at 70, so they want to make up what they lost last year in terms of ground.
Francisco, as we speak, Bitcoin breaks down. Brad, maybe we've got an intraday chart of Bitcoin to help us out here. We've had people on Bloomberg talking up Bitcoin, its stability. Francisco, I want to cut to the chase. A grizzled pro like you, is Bitcoin linked to gold? Is there a compare and contrast, a correlation, a relationship of Bitcoin to gold?
Okay, so let me cut to the chase. You know, I put a pretty negative piece on Bitcoin back in March entitled "Bitcoin's Dirty Little Secrets," where I argued that Bitcoin had serious environmental issues, and obviously there was a big U-turn in Tesla.
China agrees with you.
And China agrees with us too, as well, of course, because they are burning a huge amount of coal to produce those Bitcoin, to mine those Bitcoin. This is my take on Bitcoin. Bitcoin, it was completely uncorrelated to other asset classes. It became more of a risk asset in the past 12 months. It was highly correlated to equities, to Mexican peso, to copper. And gold is a safe asset. It's typically correlated to 10-year treasuries, to Japanese yen. So to your question, are Bitcoin and gold linked? In a way, they are, because one is a risk asset, the other one is a safe asset. So they're very different characteristics. Now, what is going to be the long run story for Bitcoin? I don't know. What I know now is that it's a risk asset and gold's a safe asset. And gold's been a safe asset for a very, very long period of time. So I'm pretty confident gold stays a safe asset. Bitcoin could keep changing, but for now, they're inversely correlated, quite inversely correlated.
Francisco, you're making such a good point, and I want to finish on this. You can have a risk-on asset and a risk-off asset, both in inflationary environments. So you can be risk-on in an inflationary environment, and the likes of Bitcoin does well, and risk-off in an inflationary environment, and the likes of gold should do well. Is that what you're saying, Francisco?
Not quite. I guess not quite what I'm saying. I mean, I'm not sure I see Bitcoin as an inflationary asset.
Okay.
I think Bitcoin, if you look at the correlations to five-year forwards, if you look at correlations to 10-year inflation, if you look at correlations to CPI, there is not much there. I think what Bitcoin is good for is that it's creating a new ecosystem of value transfer. It's creating a new economic organization based on the stakeholder economy as opposed to the shareholder economy that we have today. And again, Bitcoin is the base of that. built on Ethereum, built on the rest of other coins that are coming behind it. That's what I think is ultimately going to shape up. It's basically communities of people that transfer value using these cryptocurrencies, which is why the IRS is so interested in taxing this, because they realize there is a lot of economic activity, real economic activity, not just criminal gangs. It's also a lot of people that are actually transferring, whether it's music or videos or anything they produce via the digital asset world.
It's a good job I got you to clarify, isn't it? Francisco, thank you, sir. It's good to see you, as always. Francisco Blanch, thank you, sir, from Bank of America. It's day 2 of the Qatar Economic Forum. Right now, a conversation on the future of post-pandemic air travel with our good friend Guy Johnson and the CEOs from Boeing, Qatar Air and IAG. Bloomberg Terminal subscribers can watch on Live Go from New York City this morning, with Bitcoin dropping below 30K for the first time since January. This is Bloomberg.
This morning was a bit of a historic day. It was the first time Indigenous designers showcased at Australian Fashion Week, and it was a full house of all Indigenous talent.
It made me so proud. Absolutely beautifully done. I mean, the designers, the pieces on there, I think just about every model or every second model, I was like, oh, I want that, I want that. So each of my pieces, we have our signature prints, which are each tell a story and is definitely a contemporary way of experiencing Aboriginal culture. And then each of my pieces are named after, inspiring Aboriginal and Torres Strait Islander women. So when the customer buys something, they're learning about the story, they're learning about women. I would hope that it isn't tokenistic, and I would hope that it's not done to tick a box. And so, those things you have to be mindful about that. But I think it's incredible what's been achieved so far, but there's always room for growth. I think the elevation of Aboriginal and Torres Strait Islander people in these spaces, it's long overdue, and it's a really powerful and incredible time, I think, and to be a part of that is really special.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
From New York City for our audience worldwide, live on TV and radio, this is Bloomberg Surveillance alongside Tom Keene, Lisa Brabitz. I'm Jonathan Ferro. Your equity market 60 minutes away from the opening bell, shaping up as follows. The S&P just short of 42.20 on the S&P 500. We advanced a little more than 0.1%. Yields are basically unchanged, just south of 150 at 149.37. 149.37, Tom, after a huge roller coaster of a ride over the last several sessions.
Yeah, it's been just that, a roller coaster ride, but I would just watch what happens today. And, John, that will be wrapped around Fed Speak.
We'll be catching up with President Williams alongside Michael McKee at 9:30 Eastern Time. Mike joining us now for a preview of that. Mike McKee, we've had the likes of President Bullard and President Kaplan really set the stage on this. They've made a lot of noise. Mike, what's the pushback going to sound like in 60 minutes?
Well, I think we got a hint of that from John Williams yesterday when he said we're still a long way from making the substantial progress that he thinks is necessary to start changing monetary policy. The question we have for him, of course, is what constitutes substantial progress? You've got Bullard and Kaplan saying that the rapid drop in unemployment and the rise in inflation suggests that maybe we're getting close to that. Does John think we're close to it, or we still are going to be many months away?
Mike, I want to go back 10 years to John Williams putting in the research work at San Francisco on R-Star. And the paper was, have we underestimated the likelihood of severe zero-bound events? Well, 10 years on, we have lived it, Mike McKee. What is he going to say about a theory? And let's be clear, folks, Williams could win a Nobel Prize for this. There's no question about this. But Mike McKee, the path from Knut Wicksell to John Maynard Keynes, and I mean seriously, to John Williams, what's he going to say of the validity of R-Star?
Well, R-Star, of course, relates to the potential growth of an economy, and his work showed that it moves around. It's not a static number. And so I think he's going to be still defending that, but there are times when you get close to the zero bound, they have said, where it doesn't really come into play. It doesn't move all that much because your interest rates are so low, and that also means your economy is not moving very quickly. So it's something to keep an eye on, is whether or not potential growth rises. Now, the Fed's forecast that they put out last week with the Survey of Economic Projections is that the economy will drop back. It will grow very quickly this year, and then it will drop back to around 1.92% 2 years from now. So R-Star doesn't move very much, and we can ask him why.
There's also why the market seems to be so concerned that R-Star could move even lower should the Fed move away from their stimulus too early. And this idea that a lot of people were raising after the market response to the Fed's meeting last week, that inflation expectations over the longer term went lower. How much do you expect him to push back on that?
Well, I think he's not going to push back on the idea of lower inflation expectations, because that would mean the Fed is doing its job. If inflation expectations come down, they have the credibility that people think that they are going to act on inflation if it gets out of control. The question is, does it get out of control? Does it accelerate too fast? And both Kaplan and Bullard and Williams have all made the case that there is this big debate and there's this great uncertainty about what's going to happen. And to give you a good example of the uncertainty, you got Ray Dalio, who founded Bridgewater, saying we're going to have runaway inflation. And you've got Bob Prince, who runs Bridgewater today for Ray Dalio, saying we're not. And that's the same company.
That's what Tom likes to see play out publicly. Mike, looking forward to the conversation, and thanks for all the hard work you put into these interviews. We'll be carrying that interview on TV and radio, 9:30 Eastern Time. So, TK, in about 56 minutes.
Yeah, it's incredibly important interview. I can't say enough about this, folks. We partition economics. John Williams out of Berkeley, and then he went across the pond after LSE to Stanford. John Ferro, John Williams is truly one of our original academic theorists. The only one I can think of in the modern sense in Fed is Clarida.
And part of the core of the Federal Reserve. You mentioned Vice Chair Clarida along with Chair Powell, the three of them there, Tom. You're likely to hear some pushback from what we've heard from Bullard and Kaplan over the last week.
major pushback, and the huge mystery here, and this goes back again to another paper on the unknown. We get a briefing now on this to prepare for our conversation with, I say Professor Williams, Dr. Williams, with Neil Shearing of Capital Economics. Neil Shearing, from where you visit in the wonderful global economics of capital economics, do you believe in our star? Do you believe it's a countable and useful number?
Well, I believe in our star, but I think you hit the nub of the issue there. Is it a useful number? It's like all these concepts we have in economics. Output gaps is another one. They're useful theoretical concepts. Measuring them in practice is difficult. Measuring them in real time, anticipating shifts in them in real time is fraught with difficulty, and I think can lead to policy mistakes. So it's I think it falls into that bucket of analytical tools, a bit like output gaps. Like I say, useful to have, useful framework for thinking, but we have to be very careful when we then translate that into what it means for policy.
Does capital economics suggest that the Fed is making a policy error?
Well, I think again it comes back to what is the stated aims of policy, and this gets to the heart of the issue. I think with the flexible average inflation target regime is it can be interpreted in different ways by different policymakers, and we've seen that play out in the response to the FOMC meeting and subsequently last week and in subsequent days. It's being interpreted in different ways by different people. Now, if you're asking me, do I think we're going to have double-digit inflation in the US? And that constitutes a policy error? No, I don't. Do I think that core inflation is going to be allowed to run sustainably higher than 2% over the next 3, 4, 5 years? Yes, I think it probably will. And do I think that's a mistake? The real question is, does it then accelerate beyond that, I think? And once the inflation genie's out of the bottle, do they struggle to kind of keep it at 2, 3, 4%, or does it go beyond that? Don't forget that in the 50s and 60s, we had those types of rates of inflation, 2, 3, 4%. That was instrumental in getting government debt ratios back down after the Second World War. And it wouldn't surprise me if that's what we're trying to head towards today.
Neil, there's higher than expected inflation, and then there's a question of growth. Do you think that we've reached peak growth already, or do you think that we will see it in the months to come?
We've reached peak growth, but that's really only because the supersized rates of growth, turbocharged rates of growth that we had in the first quarter of this year, back end of last year, is all about the burst of activity coming back on after economies reopen. So really that's just unwinding the falls in output that we saw during the pandemic. So the US economy now, on our measures, is pretty much back to the same size it was before the pandemic struck. So it's no surprise that growth is really slowing, I don't think. What to my mind is interesting is what's the trend rate of growth in the economy? Has there been permanent damage to the supply potential of the US economy and other economies as a result of the pandemic? And then from there, of course, it's an easy jump to how loose should policy be allowed to run, and when does that start to generate inflation pressures? Now, the bet in the market is that there has been some permanent damage to supply potential. That's what most central banks are saying. I think that actually there hasn't been permanent damage to supply potential. You can probably allow economies to run hotter for longer before we start to generate meaningful inflation pressure.
What data points are you looking for, Neil, for some sort of compass for how to project the future here?
Well, I think there's two things I'm paying really, really close attention to. Labour markets is the obvious one when it comes to inflation. We're seeing huge friction, I think, in labour markets across the globe, particularly in the US. It was never likely that the 25 million people that lost their jobs during the pandemic in the US were going to get put back to work quickly and easily. And we're starting to see shortages appear. The question is, how quickly do those work through? So I'm looking at things like the MFIB, jobs hard to fill indices. They're I think critical to shedding some light on how transitory or not these labour market problems are. On the other side of the world, pay close attention to what's happening to Asian exports, because they're levelling off in levels terms in recent months. There's some signs that export orders are starting to level off too, and that might be the first indication that this huge transition that we had in spending in the developed world away from services and towards goods during the pandemic is starting to unwind, and maybe that's going to start to weigh on economies in the emerging world, particularly in Asia. So they're the two things I would pay close attention to over the coming months.
Neil, I've been away from the microphone for the last couple of weeks. Tom says I'm a little bit rusty. In about 50 minutes, we'll catch up with President Williams. Can you give us a question? What's the number one for you at the moment?
Well, I think I'd be looking for some clarity really around the flexible average inflation target. How are they interpreting that? And it's all very well us saying that we're allowing inflation to run a bit hot. Exactly what does that mean? That's what I'm looking for.
We need some quantitative guidance, don't we? Neil, thank you. Neil Shearing, Capital Economics Group Chief Economist. We haven't seen that progress that some of these officials want to see, Tom. We're just not clear on how much progress they want to see.
There's massive unknown. Of course, unknown and expectations is one of the great parts of John Williams' research. And John, the unknown right now, somebody yesterday had a wonderful research note where they talked about the uncertainty right now is just off the chart. Yes, it is.
One key variable, I think, Lisa, and I think a lot of people agree as well, is the participation rate in the labour market. What happens with it over the next 12, 18 months?
And even beyond, right? I mean, we've seen a declining participation rate over the past few decades. How much does this have to do with the automation and the technological shifts? How much does this have to do with the skills or lack thereof that certain people have to fill the roles? This is a huge question. It's got some serious policy questions around it as well. I mean, I'm talking about UBI, the idea of some sort of supplemental income on a regular basis.
That's what's coming up, a conversation on The Open with the Federal Reserve Bank of New York President John Williams alongside myself and Michael McKee, taking place on Bloomberg Radio and on Bloomberg TV. That's taking place in about 50 minutes' time, Tom, after we've heard so much from Presidents Bullard, Presidents Kaplan. The core of the Fed begins to push back with a little bit more might.
Well, I'll agree. It could be market moving, but same can be said for Czech English football. I mean, you're going to move, John, right on from your 9 o'clock hour to 3 p.m. this afternoon. Can England, leave the Euro thingy if they lose?
No. They go through to the next round regardless, I think, now.
Oh, okay.
Tom, this is about topping the group and who you play in the knockout round. Did we do a bracket? Did a bracket happen?
No, I didn't.
No, there were no brackets.
John,
that's what we're calling it.
John, if you're not here, we have no interest. 0-0, Scotland, England, ties.
Thank you, Tom. Do we still have that Simpsons
opening
opening skit?
I did it out on Twitter when you were...
We should play that.
John, it's good to have you back.
Hey, TK, it's great to be back with you.
Maybe your data check tomorrow will be better.
Thank you. I'll practice tonight.
Thank you.
That was the most authentic moment of the last 3 hours.
He sits in a bar with chamomile tea and practices.
Tom Key, Lisa Abramowitz, Jonathan Ferro. Live on TV and radio from New York City, this is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. Google is facing a European Union investigation into its advertising technology. The European Commission says its case will assess whether the search giant breaches competition rules by favoring its own online display advertising technologies over rivals, according to a statement today. The probe will also look into whether Google blocks rivals' access to user data. Blackstone Group has agreed to buy a company that buys and rents single-family homes in a $6 billion deal. It's a sign Wall Street believes the U.S. housing market is going to stay hot. The investment firm is said to have reached a deal to acquire Home Partners of America. That company owns more than 17,000 houses, which it rents out and offers its tenants the chance to eventually buy. And GameStop climbed in pre-market trading today after announcing that it completed an at-the-market offering program by selling 5 million shares for a total of more than $1.1 billion. Shares of the video game retailer surged as much as 11% in pre-market trading after the announcement. The company says it will use net proceeds from the offering for investing in growth initiatives and maintaining a strong balance sheet. NFL player Carl Nassib has announced that he's gay, making him the first active player in the league to come out. The Las Vegas Raiders player revealed the news on Instagram, saying he's pretty private but hopes that his coming out would mean other people would not have to make similar videos in the future. He added he's donating $100,000 to a non-profit that works to prevent suicide amongst LGBTQ+ youth. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
People from all around the world should be able to travel to one another's countries. And I think that is the way it will develop, but we've got to get a little less politics involved and a little more science, because these vaccines are in fact effective.
The gentleman from Boeing, David Calhoun, speaking there, their chief executive officer. This, of course, at the Qatar Economic Forum, powered by Bloomberg. We're thrilled that he could join us for those important comments. Right now, Lisa Abramowitz and I are going to have a 4-hour conversation with Barry Ritholtz, because that's how much there is to talk about. But Barry, to be honest, I got to rip it up, and I've got to look at Bitcoin trying to find a 28,000 level. Barry, I took Bitcoin to logs, and one of my support levels is 7,000, down way below where we are right now. How do you explain to your clientele what support is on any given asset?
Well, it depends on the asset class. So when we're talking about bonds, it's yield relative to inflation and national growth rate. When we talk about equities, it's earnings and growth rate and a whole number of other factors. When we look at Bitcoin, and arguably you could make the argument, the same claim about any currency, it's just the collective delusion of what everybody agrees a currency is worth. And when I say delusion, I'm not dissing fiat currency or crypto. The fact that we can exchange little green pieces of paper with long dead presidents on it and get goods and services in exchange for it, can the crypto folks argue is also a collective delusion, albeit one backed by a standing military and a very, very robust legal enforcement mechanism to collect taxes. Crypto doesn't have that second part. And so while it certainly is a consensus sentiment trade and a momentum trade and a narrative trade, it lacks some of the teeth that traditional fiat currency has.
And this goes, Barry, to your writing, which is about how narratives have taken over the market. What's the Bitcoin narrative to Barry Ritholtz?
Well, the Bitcoin narrative is the great financial crisis led to a massive group of ill-advised government interventions. Since then, central banks around the world have been printing. I love the meme, printer goes brr. And therefore, all of these fiat currencies are going to become worthless. Your choice is either buy crypto and drive Lambos, or hold on to your fiat currency, which will soon be worthless. And P.S., as a public service, I like to tell people, send me all of your worthless U.S. fiat currency, and I promise to dispose of it properly.
Well, Barry, there's another narrative that actually has gained some steam among the hedge fund industry, among institutional investors, the likes of Troy Gajewski of Skybridge coming on and saying that it's actually the determining factor in your outperformance because it's a macro bet on the basically worthlessness, increasing worthlessness of fiat currency, but also the money printing that we've seen, the money printer go burr. And there's a question of whether there are forced sales or whether that narrative gets reversed when you start seeing Bitcoin have its worst two-day plunge since March of 2020. And when you start looking at levels that we saw 50% below the highs this year.
Right, right. So in the battle between China and Elon Musk, China is winning, at least when it comes to crypto. But, you know, here's the way I really think about Bitcoin and the rest of the blockchain universe, which is something complete. The technology is very different than the tradable asset. Bitcoin was about $1 trillion and change, smaller than Microsoft, Apple, bigger than Home Depot or Chase. And so it captures an immense amount of mind share. But if you think of this as a really successful company who's had a great run up in stock price, puts it in a little different context. I think there's been the fear of missing out on the next new thing. A lot of people plowed into this maybe a little late, and watching anything get cut in half is always painful if you're long and wrong, especially if you were anywhere near the top of that. But I don't think we would talk about Bitcoin the same way if we really thought of this as like an individual company. Now, lots of folks are forecasting Tesla going to 5,000 and Bitcoin going to 100,000. And there are all these crazy forecasts. And for the most part, those wild outliers don't work well for investors. But keep in mind, this has yet to come up with a solid use function. Hold aside, you know, kidnapping and ransomware and other illegalities. We're still waiting for the use case for this. There are lots of signs that blockchain is going to do some really interesting things, but it has yet, after 15 years, it has yet to really change the nature of our financial economy.
Barry, we're out of time. Thanks. Wonderful to catch you here with Bitcoin 30,000 down to 29 level. We're looking for 28,000. We're not there yet as well. Mr. Ritholtz writing for Bloomberg Opinion. Lisa, I guess we could sit on Bitcoin, but let's get back to the rest of the market right now. And I'm sorry, it is about Fed speak, and this interview with Dr. Williams of the New York Fed is a big deal.
Right now, you're seeing a reflation of the reflation trade, at least when you take a look on the margins at bond markets. Interesting to see that equities are kind of range bound here. But yes, very much looking to see what Fed Chair Jay Powell tries to walk back from the more hawkish tone that the central bank gave off last week. Again, Tom, they shouldn't be that unhappy with the reaction. It was not some sort of taper tantrum. There wasn't a disproportionate response. But there are some concerns that are sort of baked into the market response, and that is a decline in longer-term inflation expectations.
You bring up a really important point. And, folks, the way I gauge the pendulum of taper is to look at the VIX. And, you know, I know it's hackneyed, but the fact is I look at the VIX, and it got out 2021 level. I haven't even looked. I don't have time to look now, Lisa, because I'm watching BitDog. But the bottom line is the VIX didn't get out to 30.
Yeah.
It didn't get out to 42, and that's your tantrum.
Yeah, right now it's 1769, just to give you a sense of where we are. But you saw the exact same kind of muted action in the implied volatility in Treasury yields, the MOVE index of Bank of America Merrill Lynch. Also not showing a huge spike up in implied volatility going forward. This should be a positive for the Fed. This should give them confidence that they can start to signal possibly tapering or raising rates, save for the inflation expectations. And that, I think, is really the sort of the needle they have to thread right now.
Well, this is a headline that we've got to bring to you because this will be the talk of global Wall Street, and we like to be the talk of global Wall Street. A small German bank has a minority investor with a great interest because their minority investment is a great investment. That would be from Qatar. And I'm not sure this is at the Bloomberg Forum, but I would say, Lisa, Deutsche Bank's top Qatari holder
Yeah.
says time is right for mergers.
Yeah. Remember?
I've never seen that headline before.
No, and this sort of speaks to the consolidation among the
Yeah.
European banking system that
Or
people have
maybe
been calling for.
the initial catalyst.
For
The
a
news
long
flow is actually quite extraordinary.
Yeah, it's picking up.
John Williams with our Michael McKee and our John Farrow. Look for that. That's an important interview. Futures, well, we've gone a little fractionally red. It's an optimistic red
Fractionally.
on the screen.
Optimistic.
Stay with us. This is Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. From New York City for our audience worldwide, good morning, good morning. 30 minutes away from the opening bell in New York City this morning with futures totally unchanged and counting down to testimony from Chairman Powell. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
From New York, we begin with the big issue. Markets turning to Chair Powell for clarity.
Market players need to focus on what matters.
Chair Powell.
What matters is what comes out of Powell's mouth.
Is the Fed actually committed to average inflation targeting?
The market was looking for an excuse to unwind a lot of crowded trades.
Market participants have to tune out the white noise.
I don't think he wants to walk back the message of the June FOMC meeting.
I don't think the story has necessarily changed.
The tapering discussion and the liftoff discussion
is just an adjustment in timing.
Getting the market to realize that they won't just let inflation run forever.
It was totally naive to ever think that the Fed was going to let inflation get out of control.
What's happening is just a repricing of the pace of the tightening.
Reprice this hawkish outcome.
We are moving away from super easy policy.
Joining us now, Priya Misra of TD Securities and Tom Titsouris of Strategas. Priya, I want to start with a basic one. Are we confusing a shift in the outlook with a shift in the reaction function?
Exactly. I think that's sort of what's happened. I think the market saw the dot plot and saw unchanged economic forecasts and said this is a shift in the reaction function. It's a more hawkish reaction function. It's a policy mistake. We literally went from the market saying that the Fed is behind the curve on inflation to the Fed is ahead of the curve and they're going to trigger a recession. I think this was really a case of positioning the big reflation trade, unwind, and then trying to find a narrative to fit price action. I think the Fed, in my mind, this was a risk management approach. They tried to get the narrative back to saying, no, we won't let inflation run out of control. I think that's what we'll be watching from Fed officials, that they are more optimistic about the outlook. They have probably more confidence in the outlook. They probably see an upside risk. And then in that scenario, they can withdraw accommodation without the market going through a tantrum. I think that's what I'll be watching from Chair Powell, that the commitment to the average inflation targeting, that is not wavering, that they are not suddenly terrified about inflation running out of control.
Tom, you heard the basic argument there. We're confusing a shift in the outlook with a shift in the reaction function. Do you agree with that, Tom?
Yeah, I think I would even go so far as to say it's really a shift in the communication. The outlook hasn't really changed, in my opinion. I do believe that most Fed voters, if you would ask them in private, do you really think you can hold off till tightening until, say, 2024? They would have said no. I think they're just communicating now what we all see, that the U.S. economy is improving. And so there's really no change in the reaction function or the policy. It's just a change in the communication. But with that said, there's three things that I would be concerned about if I were Fed Chair Powell. And those things would make me want to do a little bit of a walking back of what was discussed last week. Those three things are that the dollar was up about, we'll call it round up 2% from just this change in communication. You also saw, even though the Fed dots pulled forward rate hike expectations to 2023 in two of them in 2023, the market also pulled forward its own rate hike expectations, which continues to be well ahead of the Fed. So the market went from roughly December 2022 to June 2022, really a serious overreaction to what the Fed is saying. And then last but not least, that curve continues to flatten. And we're always concerned about flattening yield curves. And we think anything below 100 basis point 2s, 10s is a very clear warning sign to Powell, and we think Powell was aware of that as well.
Right now, 2s, 10s at 126. Chairman Powell going in front of a House committee today. In the testimony, sticking to script, he says the following: inflation has increased notably in recent months. As transitory supply effects abate, inflation is expected to drop back towards our longer-run goal. Looking at this a little bit later today, Michael McKee, our international economics and policy correspondent. Mike, good morning.
Good morning, John. I think that Tom nailed it. It is a communications challenge for the Fed chairman today, because there are 18 members of the Open Market Committee, and it is clear the economy is growing faster. Inflation is rising faster than their forecasts a couple of months ago. But they want you to know that they're still on the job and it hasn't changed much. The problem for the Fed is that, while we're not getting a taper tantrum yet, the baby is rattling the crib. And they need to make sure that people are reassured that they are not going to let inflation get out of control, or that they are not going to choke off the recovery. And that's a communications issue. You have some Fed officials who are at this point out ahead of the others in terms of we should talk about tapering, but they haven't called for tapering yet. And that leaves a sort of a vacuum out there. The Fed leadership Chairman Powell, John Williams, who will be with us in a few moments, talking about we're not close to that yet. So for Powell today, it's kind of let's square the circle. Let's try to bring people back to the center point and not have them worry so much about what we're going to do.
That interview with Mr. Williams, President Williams of the New York Fed, Mike, taking place in about 25 minutes' time. Michael McKee helping me to lead that interview. A little bit later, 9:30 Eastern Time, the New York Fed President John Williams with Michael McKee and myself. Priya, I want to turn back to you. Mike said it, Tom said it, communication issue. Wasn't even a shift in the outlook. It was a shift in the balance of risks around the outlook, and it engineered just a massive repricing in the Treasury market, Priya. What did that tell you?
So I think that tells you that positioning was extremely crowded. The reflation trade has been the winning trade really since late last year. Since we got the vaccine news, we saw the flexible average inflation targeting regime being unveiled. These trades have worked for almost a year. I think there was a massive exit. But I do think, there's a couple of issues here. The committee is a little divided. I think there are members on the committee who think that the Fed should be probably tapering soon and hiking next year. Meanwhile, others don't. So we've got a divided committee, which makes communication a challenge. I also think the Fed is trying to retain flexibility, which is a good thing. But when you've got data which is hard to read, data is extremely noisy. I think the data is going to be reopening impacted all the way from now until the end of September. So how does the Fed, that flexibility which can work for them in terms of discretionary policy, can actually create more of that communication challenge? Because what if we get 1 million payrolls next week, in a holiday shortened week? Does the market then say, wow, tapering would be announced in Jackson Hole, and the Fed really wants to retain that flexibility? So it is a communication challenge, but I think if we hear clear commitment to the FAIT policy still there, that this is a risk management exercise rather than a reaction function shift, I think it'll come, and I think positioning is much cleaner. So we actually put on steepeners yesterday for short duration. I think the reflation trade unwound almost too much.
You're back on a steepener. Priya, right now, 2s, 10s, 126. What are you looking for?
Well, we have more of a 530 steepener because that, the very front end is extremely anchored. If the Fed is not hiking for another 2-3 years, we think it's only late 2023, then that 5 year is going to be extremely anchored. And the market, I would agree with Tom, has moved the first hike into late next year, which is way too early. They have to first communicate a tapering well in advance. Then they have to finish tapering, which is, in our view, a 10-11 month process, and then hike. So we're talking about 2023 on hike. So I'm looking for 530s to go back to 150, 170, significantly steeper than here.
530s right now, 126. They peaked at about 160-ish back in late February. And Tom, my question would be, before we even had this shift in the balance of risk around the outlook, not the reaction function, the shift in the balance of risk around the outlook from the Federal Reserve, we already topped out on a 10-year nominal yield at the end of March. We already topped out in parts of this yield curve at the end of February, end of March. What's to say that we don't get mid to late cycle dynamics start to grip this Treasury market before these guys even hike?
Well, if that's the case, then they shouldn't be talking about hiking. Because simply put, if this curve can't steepen out to 200 basis points, 2s, 10s, then that would be a very clear warning sign to me that the bond market is saying there's not enough long-term sustainable nominal growth for them to be considering tightening anytime before 2023. And I think that's important. But I think another important point here is that the bond market, I absolutely agree with Priya's comments earlier. The bond market is basically looking through the tapering issue here and also overpricing the risk of tightening. So we think basically here the curve has got to steepen back out as the Fed is going to shift more of its communication towards tapering as the primary exit mechanism in the early going versus tightening. And that should be a catalyst for steepening. Are you comfortable positioning for that now, Tom? Absolutely. So we still forecast a 2s, 10 spread. We like to focus on 2s, 10s, but this would certainly be analogous to 5s, 30s as well. We forecast a 2s, 10 spread of about 170 by the end of this year. So we still see 50 basis points of steepening. And we do see a Treasury market in the notes part of the curve, we'll call it the 5, 7, 10-year part of the curve, that is looking overbought to us right now. Let me put you both on the spot and finish on this one, just in this part of the conversation. Do you think tapering is a dynamic that leads to higher or lower long-end yields, Priya? Which one is it?
I think it's higher. And this is because I think the Fed is not in a rush to taper. They want to be absolutely sure that the COVID impacts on the economy are sort of we've made substantial progress, as they've put it. So I think real rates can start to rise while keeping inflation expectations and risk premium unchanged. So as those real rates rise, we have a $3 trillion deficit, tons of, there are auctions 3 weeks in a month. As we have to find a marginal buyer, private market buyer of treasuries, I think that puts upward pressure on real rates in the long end, while break-evens can stay unchanged, and that can actually make nominal rates rise. So I would argue it's higher rates.
Tom, just quickly, same question to you.
Yeah, absolutely agree, 100%. I hate to say this time is different, but what made it the situation in the last decade so that tapering led to eventually lower yields was because you had a fragile economy and you really could not sustain much higher real interest rates without pushing break-even inflations lower. This time you see a much more robust and expanding economy. So for the time being, we can push real rates drastically higher and presume that break-even inflations are going to stay stable. And so therefore tapering should this time lead to higher interest rates, whereas that was not the playbook in the last decade.
Tom Priya on this bond market ahead of Chairman Powell a little bit later this afternoon. 149.90 on a 10-year, just south of 150 on a 30-year, 214. Need to get you some stock moves as well in this equity market ahead of the opening bell. Here's Abby.
John, let's start out with Bitcoin because we, of course, have Bitcoin flipping above and below $30,000 per Bitcoin, dropping below that $30,000 mark for the first time since January. Now down more than 50% from its all-time high. China recently really cracking down. But perhaps you can also bring the Fed into this conversation, that extra liquidity, seeking a home too far, too fast, maybe for not a good reason. So, of course, Bitcoin getting hit and right now back below $30,000 per Bitcoin. Not surprisingly, hitting the crypto space. Lots of the crypto movers down sharply, including Coinbase, which is now 10% below its direct listing pricing. And then finally, to bring some positive news into the report here, let's take a look at some movers to the upside. GameStop up 7.3%, popping on a $1.1 billion at the market stock sale. Sanderson Farms, the egg producer, exploring a sale. JP Morgan saying this company, the shares worth $200 within a sale. So some upside potential there potentially. And then Splunk up 9% on a $1 billion investment from Silver Lake, John.
There we go. Avi, thank you. Equity futures unchanged. Coming up, White House officials heading to Capitol Hill for another round of infrastructure talks. That conversation up next with TD's Priya Misra and Tom Titsouris of Strategas from New York City with about 18 minutes to go until the opening bell. Equity futures on the S&P marginally higher, 20 minutes away from catching up with President Williams of New York. From New York, this is Bloomberg.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
president has proposed a range of ways to pay for this package, including ways that would not violate the red lines the Republicans have put forward. The president's pledge was not to raise taxes on Americans making less than $400,000 a year. And the proposed gas tax or vehicle mileage tax would do exactly that. So that is a non-starter for him.
Infrastructure talks stalling with partisan sticking points blocking progress. Negotiations continuing on the Hill today with a group of senators efforting a compromise ahead of the July 4th recess. Senator Mitt Romney striking an optimistic tone, saying, quote, there are a number of pay-fors that we've been able to add to the list, and I think we're going to get there. For more, let's bring in Bloomberg's Emily Wilkins. Morning, Emily.
Morning, Jonathan. Yeah, we are hearing a lot of optimism from senators on the Hill, both Democrats and Republicans, saying that they think that they can get to yes on this. Key question is, what does President Biden think? His advisors are heading up to the White House, to the Congress today, rather, to meet with senators and discuss the plan. Big sticking point right now is the pay-fors. How does this get paid? Where does the money come from? Senators have put forward the idea of a gas tax. President Biden said, no way. That offer now seems to be off the table. What President Biden would like to see was a bolstering of the IRS, which would allow it to really do more thorough audits of companies and wealthier individuals. That's something that the president has put forward. It hasn't gotten a very warm reception from the senators yet. But at the same point, President Biden is still under increasing pressure from progressives in his party to go ahead and move on their own. You have Democrats in the Senate putting together a $6 trillion package, which includes infrastructure, child care, child tax credit. And that is being ready to move should these bipartisan negotiations fall apart. At this point, there's a lot of questions about whether some Democratic senators would sign on to this bipartisan package. Some have said that they would not, and that will cause issues in getting this through. So a lot of things to negotiate, and we're coming up on a 2-week recess this Friday. Senate, House, they leave town, and that makes it even longer of a time frame to actually get something done.
Emily, I dislike the concept of deadlines. I was told it was days, not weeks. That was 3 weeks ago. I've been away, and seemingly we're in the same position. What exactly is going to guide this administration as to whether they should move away and go it alone?
The Biden administration is trying to balance two things here. Number one, President Biden ran as a bipartisan president. He thinks that that is key to the Democrats being able to keep their majority in 2022. But at the same point, Democrats have said, look, we need to pass a big package. We need to meet the needs of voters. I think one key thing to really look for today, Jonathan, is there an agreement on the pay-fors? And is there an agreement that if they do move with this bipartisan package, there can be another Democrat-only package that can hit on some of those other Biden administration initiatives. If those things can be done, the path forward for a bipartisan deal looks better.
Emily Wilkins down in D.C. Emily, thank you. Just how important is the outlook for the next fiscal step for this market? This was Peter Chiv of Academy Securities, who wrote the following. Much of what is driving the market can be linked to doubt about the size and effectiveness of fiscal stimulus. Less fiscal stimulus would reduce future bond supply and at the same time reduce growth prospects. This increasing concern, or the lack thereof, will act as a headwind for markets. Some final thoughts now with TD's Priya Misra and Tom Titsouris of Strategas. Now, both of you are on the same page around the direction of the yield curve. You both want a position for a steeper curve. Now, Priya, is that dependent on or independent of what happens in Washington?
We are looking for a pretty big package to pass, so that would certainly help the steepener in my mind. I don't think the market's pricing in this deal. I mean, they've been back and forth, whether they'll get, we've just seen it's a bit like world peace we all wanted. The details are where everyone gets stuck. So I don't think the market has priced it in. And if it does look likely that the Democrats are going alone, I don't think it has much of a Treasury supply implication, because I think there will be pay-fors, there will be the tax increases. The issue is it positive for growth in the long term? Does it mean that the Fed terminal rate, which has actually declined, market's only pricing in the endpoint of the hiking cycle at 1.5% in 3 years, does that move higher? Because infrastructure should help productivity, should help long-term growth potential. I think it puts upward bias to rates if it passes. But I would say it's not really see how difficult it is to get any bipartisan agreement done anytime soon.
Yeah, Tom, I'd like to put the same question to you as well. You, like Priya, positioning for a steeper yield curve. Is it dependent on or independent of what happens in Washington?
Yeah, it's absolutely dependent on what happens in Washington. And I'd even go one step further and say the fiscal picture could be one major qualifier in our view for a steeper curve. because it really does depend on how you pay for that fiscal spending plan. So let's just really quickly look at what infrastructure spending does. Infrastructure spending boosts growth as well as productivity, but here's the catch. How many shovel-ready projects are there in the U.S. right now? Probably not enough that we could boost growth now. More likely what we'll see is a great backlog of different projects in different phases of planning cycle, which could mean that you get a growth boost sometime in the middle portion of this decade. So that's important because you have supply coming in, yes, but if you're going to pay for this infrastructure spending with a round of tax increases, particularly income tax increases that hit, we'll say, I don't know, January 1st, then you have immediate fiscal drag, which the bond market has to consider. So it's a real big question mark. And in my opinion, it's probably the biggest question mark right now, aside from Fed Chair Powell's status as Fed Chairman in the next year. Those are the two big question marks the bond market has to deal with. Right now, I think it's a coin toss whether or not we have pay-fors or this is debt financed, and if the pay-fors are so restrictive themselves that they actually create substantial fiscal drag next year. And that's one of the things I do think the bond market is kind of tussling with and doesn't know the answer as of right now.
You mentioned a second dynamic, so let's finish there, Tom. The prospect of a second term or not for Chairman Powell. Why is that so important when we've just had this huge shift in the framework, the reaction function of the Federal Reserve? Surely that endures whether Chairman Powell sits there for another term or not.
Yeah, my opinion is the bond market in particular is going to see through any removal of Powell as entirely. And when you consider the enormous respect the markets have for Powell, and not just the markets, but other central bankers, this is different from Bernanke in 2013 when the market was really not, the economy really wasn't growing. And so there really wasn't a lot of pressure on treasuries. This time around, there could be a lot of pressure on treasuries and the dollar. And so removal of Powell would be interpreted, in my view, would be interpreted as a political decision. And this would be the absolute worst time to be making Powell a political casualty when he has so much respect to the markets. And it's such a critical time for U.S. monetary policy.
Priya, why is that different to what we saw from Yellen to Powell?
Sure. So I think there has been this framework review, and it's a new policy. It's untested. And I think that's creating some question in the market's mind that if you have a change in leadership, and it's not just Chair Powell, it's also Vice Chair Clarida. There's a bunch of changes at the committee. I think the question will be who's next? And is it considered a political appointee, in which case the market starts to lose some faith in the independence of the Fed? And I think that's a problem, particularly for long and inflation expectations. But, if it is Governor Brainerd or somebody else, who seems to be very much in line with Fed Chair Powell, I think then the market can actually look through this as just being a political shift.
Or New York Fed President John Williams, who will be joining us in about 10 minutes' time. Priya, we've got to leave it there. Priya Misra, Tom Titsouras. Guys, great to catch up. Appreciate it, as always. Coming up, the morning calls, and later, the reflation trade in focus on the heels of the Fed's very, very subtle pivot in the last week or so. Still ahead, Tor Backen's Michael Purvis, plus our exclusive conversation with the New York Fed President John Williams and Michael McKee helping to lead that conversation from New York. This is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Five minutes away from the opening bell in New York City. Futures price action pretty muted, unchanged on the S&P. Some underperformance on the Russell, down by about 0.25%. That's the price action. Here are the morning calls. First up, we begin with Raymond James, raising its price target on Nvidia to a street high 900. The analyst calling the company best positioned for long-term growth. Next up, Stifel, upgrading CrowdStrike with a street high $300 price target, citing improving customer demand trends and a likely path to expanding margins. And finally, Cowen naming Lionsgate Entertainment a best idea. The analyst highlighting the company's success with streaming video. That stock up by a little more than 2%. Coming up, Michael Purvis of Toolback, and plus an exclusive conversation with New York Fed President John Williams and Michael McKee from New York City. This is Bloomberg.
The G7 today they need to wake up and listen to the science. There isn't room for discussion on this. It's scientific inevitability, and they need to act. They don't need to talk anymore. They need to just act.
Climate change has been on the agenda of the G7 since maybe 2003. So we need to see action, not just talk. And we've only got 9 years left to halve carbon emissions if we're going to stop dangerous climate change happening.
United, we'll never be defeated! The world is possible!
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
24 seconds away from the opening bell in New York City this morning. Good morning to you all. As we inch towards that open, equity futures basically unchanged over the last couple of hours. On the S&P, we're down not even 0.1% on both the Nasdaq and on the S&P. On a Russell, we're off for about 0.25% after a big bounce back in yesterday's session following 4 straight days of declines. That's the equity market. Switch on the board and get to the bond market. Your 10-year yield shaping up as follows. After a really whippy couple of sessions on a 10-year, 135 at the lows in yesterday's session. Now back
back to 150.55 on a 10-year and up a basis point or two. In the FX market, we saw a morning of dollar strength. We give some of that up. Euro dollar 119.08 and down about 0.1%. Crude 73.47 on WTI. Had a little look at life north of 75 on Brent. WTI is down by about 0.25%. That's the cross-asset story this Tuesday morning with your movers at the market desk. Here's Abby.
John, well, stocks may be basically flat. The futures, the indexes here on the open after yesterday's big rebound rally after Friday's fall. But let's start out where we have real action. That, of course, is in the crypto space. If we take a look at Bitcoin and Ethereum themselves, we are seeing a big plunge. And, of course, Bitcoin below $30,000 for the first time since January, down more than 50% from its peak. The China crackdown, plus perhaps the question of too far, too fast. It is taking the crypto space with it. Coinbase, of course, below its direct listing price by about 10%. And MicroStrategy, not so long ago, offered $500 million worth of bonds to buy Bitcoin. That stock really not doing very well on that strategy. And then finally, the heart of the market, big tech. We take a look at the likes of Apple, Microsoft, Amazon, Alphabet. After yesterday, a respectable rally, even with yields higher. Today, basically flat, trying to go green. This, again, the heart of the market, the bulk of the weighting for the S&P 500 in many ways, more than $6 trillion worth of market cap here, John. Waiting to figure out what way to go.
Abby, thank you. Nothing dramatic here. Pretty muted open. Stateside, 2 minutes into the session. All the talk about the Fed and the hawkish tilt, do you want to call it that? That's what JP Morgan's calling it, the hawkish surprise. They say the following: we expect the trade to resume and see this move as an opportunity to add exposure to cyclicals and commodities. Inflation is likely to continue, driving bond yields higher and value outperformance. Talkback's Michael Purvis joins us now on this conversation. Mike, do you want to stick with a cyclical trade here?
I do, John. You know, I think one thing that I've been really trying to express to clients over the last couple of months is that if Treasury yields stay in this more subdued range than what we saw, you know, in Q1, that's not an indictment of the economic growth. That's really much more a reflection of sort of the new Fed policy there. So I am very bulled up on, you know, a lot of reflation equities, but I'm also very sort of non-bearish, if you will, of Treasuries. And I think that sort of those sort of typical patterns of seeing value, you know, move higher with rates, those are going to decouple, you know, in the second half of the year. And I think investors need to be prepared for that.
Mike, that is so important. Why do you think we will get that decoupling?
Well, really, it's a reflection of the concept that over the last 12 months, we've had extraordinary monetary policy shift and extraordinary fiscal policy shift at the same time. So if we had a 2018 style Fed, I certainly wouldn't be there on the on my rates call there. But look, the economic growth is very real. It's very robust. It's not just a 21 story. It is a 22 story as well. Obviously, we're going to have a slowdown here. We might be at peak growth here, but that doesn't mean that there's not going to be a lot of outperformance here. I think there's some parts of the value trade where, sure, you know, on banks, you'd love to see the 210 and the other yield curves, you know, re-steepen substantially here. But I still think that, you know, when you look at valuations of Bank of America relative to the market, and you look at the, you know, what's going to happen to their loan loss reserves prospectively into this kind of economic growth, I think there's a lot, you know, there's a lot of good tailwinds there as well. But you know, the materials names have some, you know, there's a lot of materials names that are I think going to be have seen fantastic leverage to the next leg higher in a lot of these commodities.
And Mike, just quickly, in about a minute's time, we'll catch up with President Williams of the New York Fed. Keep hearing this word surprise. What was surprising about the move last week for you?
Well, you know, I think look, I was expecting a hawkish nudge last week, just given that the 10-year had come in 30 basis points and the financial conditions had become remarkably easy. I think the 2 points was the big surprise, but the 2 hikes in 23, rather, you know, suggested by the dots was the big surprise there. But I think it's also, you know, if you look at the Citibank Inflation Surprise Index, that surged to record highs in April and May. It wasn't a Q1 story so much as it was a Q2 story there. And it, you know, did seem like the Fed was kind of reacting to some of those, you know, massive inflation prints that they sort of promised us that they would kind of look through. So it looked like they were sort of blinking, you know, at some of those.
We'll get some clarity on that in about 15 seconds. Michael Purvis of Talkback, and we'll bookend an interview with the New York Fed president. Ahead of all of that, pretty muted price action, both on the equity side and the bond market, after a pretty exciting past week for the bond market and the Treasury market stateside. From New York City, joining us on Bloomberg Television and on radio, I'm pleased to say the New York Fed President John Williams joins us alongside Bloomberg's Michael McKee. President Williams, always great to catch up with you, sir. And if you don't mind, I'm going to start the conversation with a quote of yours. You went on to say in the last day or so, from my perspective, we are quite a ways from achieving my interpretation of substantial further progress. So, President Williams, I imagine you anticipated this trillion-dollar question. What is substantial further progress?
Well, that's something we'll be analyzing. I'll be studying very carefully, looking at the progress we're making about getting back to maximum employment, and also our goals around a 2% inflation on average over time. So it's really looking at all the data, the indicators, and really seeing that actual achieve progress, both in terms of employment and also in terms of underlying inflation trends back to 2%. So it's really, looking carefully at all the data and indicators and assessing that to come to a conclusion.
President Williams, for the benefit of our audience on radio, as I asked that question, you smiled because clearly you anticipated it. I just wonder why keeping what constitutes substantial further progress vague is a feature and not a bug of policy.
Well, we are not following some mechanical formula for making monetary policy. We have to look at a wide range of information and different indicators. And we also have to think about where the uncertainties and risks to the outlook are too. So I wouldn't say it's vague. I think it's pretty clear. We've laid out very clear indicators about how we think about maximum employment and price stability. But there's no kind of a numerical threshold or something that we're looking at. We're really looking at the full set of data around these goals and taking into account all the extraordinarily high levels of uncertainty in the economy that we've experienced for the past year and a half, and we're continuing to experience as the economy reopens.
Well, John, there's a lot of uncertainty, but that stern taskmaster, Jay Powell, makes you write down your forecasts. And I'm just wondering, on the Fed spectrum from the Survey of Economic Projections, what you think growth will be this year and in 2022, and what you think PCE inflation will be.
Well, we're seeing great signs of the reopening of the economy in the past several months. So I have a pretty optimistic view of what GDP growth will look like this year. So my view is that growth will be about 7% on a Q4 over Q4 basis for real GDP, which is the best number. If if that forecast is true, that'll be the best number since 1984. So I feel very good about the progress we're making on vaccinations, on growth, supported by strong fiscal support. So that's my forecast. And I see the unemployment rate coming down to around 4.5% by the end of the year, which is, again, really great signs of progress. Looking to next year, I think growth will be, GDP growth will probably be around 3 to 3.5%, slower than this year because we're not going to get as much of that reopening dynamic. And some of the very strong fiscal support we saw last year and this year will be ebbing next year in terms of its contribution to growth. I still see the labor market continuing to recover next year, and employment trending downward. In terms of inflation, I do see the very sharp rise in prices we've seen in the past few months is mostly temporary. So after inflation being at 3% or so this year, I expect both core and overall inflation rates to come back down next year to around 2%. As some of the reopening dynamics, play out, and some of these big increases in some of these prices, like used cars and things like that, subside.
Well, let me put it the way the Fed has always put it. If the economy performs as you expect, would it be likely that we would see you begin to taper in the fourth quarter of this year, or is that too early?
Well, it's really going to be driven by the data. Mike, that I'm very data dependent in my views on policy. And right now we're still in the midst of just a really extraordinary and positive set of developments in terms of the economy, in terms of vaccinations and other things. So right now it's really about watching the data, seeing how quickly this economy can recover and get back to, to its full potential. And so any views I have about when we'll get to that point that we can start slowing the pace of our asset purchases. That'll be driven really by what's happening in the data. As I mentioned before, the risks that are out there in terms of the economic outlook, and doing it in a way, hope that really will be communicated very transparently and done in a very orderly way. So that's how I view that. The timings can be driven by the how the data evolve, and really my focus is on providing the appropriate amount of monetary support for a full and complete economic recovery, and with inflation averaging 2%.
Well, let's talk a little bit about what's appropriate. What do we get for $120 billion right now a month in purchases that we wouldn't get from less, given the state of the economy? And are you worried that the minute you announce that you might begin tapering, we get a taper tantrum? Does that keep you pinned in place?
Well, we really, in my view, we need to focus on getting monetary policy in the right place to support the very strong economic recovery and our 2% inflation goal. I think one of the lessons from the experience of the taper from years ago is the importance of not only getting the right decision and the right time for the decision, but also doing our very best to communicate that as transparently and clearly to the public. I do think that this time we have a really strong economy in terms of the recovery, the pace of recovery. We still have a long ways to go to get to maximum employment, but we're on a very good track for that. And I think that in the context of a strong recovery and a very good economic outlook, then we can adjust monetary policy, hopefully without any undue market turmoil or things like that you just mentioned.
President Williams, Mike asked that question in a really polite fashion, so I'll be a little bit more blunt. Does this housing market in America need the Fed's support?
Well, obviously the housing market is one of the key drivers, along with consumer spending and business investment, of the strong growth. Now, my view is that the monetary accommodation that we're providing, both in terms of the very low Fed funds rate and also our asset purchases, is supporting overall financial conditions, really lowering the cost of financing for households, for businesses in general. It's not specifically targeted to the housing market. My view on this is we need to focus on our maximum employment and price stability goals, and as the economy makes a substantial further progress on those goals, we can make decisions around adjusting asset purchases and then further down the road in terms of our interest rates. So it's really my focus is on those goals, where it's not really about supporting or not supporting the housing market in particular.
Just a little hint from you there on what your view might be when it does come the time to reduce asset purchases, on the composition of that reduction. President, is there a bias to reduce, say, the purchases of MBS over Treasuries, or what I'm hearing from you, maybe not?
Well, those are issues that we need to think about in terms of not only the timing of the adjustment of the purchase pace, but the timing over which that would happen, and also the composition of any adjustments that we make. So those are issues that we need to analyze very carefully and think through in terms of, again, achieving our maximum employment and price stability goals.
Well, you're talking about it right now because the chairman told us. So, President Williams, from your standpoint, what is the optimal approach to that conversation?
The optimal approach to the conversation around the asset purchases?
Yeah.
Well, I think we just, we do what we do the best. We analyze all the data, analyze the options we have in front of us, and really focus on the big picture of the goals that we're trying to achieve, the progress we're making on those, and how to best set our policy, instruments as we can to achieve those goals.
President Williams, forgive me for jumping in because you're too good at this. When it comes to the asset purchase program, do you view it as $120 billion a month, or a mix of purchases that need to be reduced independent of one another? Would you focus on MBS over Treasuries, Treasuries over MBS, or do you just look at the whole package that needs to be reduced equally? What's the optimal approach to that?
Oh, yeah. So, I clearly see the two supporting accommodative financial conditions broadly. So that's how I think about it, thinking to your question. Now, do we have options in terms of adjusting them in different ways, the purchases of MBS and Treasuries? clearly we have options to do that. And from my point of view, the main purpose of these is really to provide strong support for the economic recovery.
Well, John, if you do start the tapering process, do you go through tapering completely before you get to rate increases? Do you stop QE purchases altogether before you would consider raising rates?
Well, Mike, as you know, last time we had a sequence of decisions that were made around that. I think this time, clearly we've learned a lot from the experience of the slowing of the asset purchases last time, and then eventually the normalization of monetary policy. So those are lessons that I think are important to take. But this time is very different. The recession, the recovery are just very different from the global financial crisis because of the nature of it being driven by the pandemic. So I think it's really important that we don't sit here and just think what's going to happen necessarily a year or 2 years ahead and think through exactly all of those, but really watch the data, see how the economy evolves, and see how our policy decisions can best support the achievement of our goals. So those are issues that we'll obviously think about carefully, but also they're well off in the future, and we really should be based on how the economy is evolving rather than kind of where things are right now in June of 2020.
Well, let's talk about raising interest rates and your view on it. Where is your dot? Did you move it at the last meeting? Are you in 2022, 2023?
And you're not going to be surprised by my answer this time. So I'm not going to talk about my specific, view. As the chair, has said on last week, is that these are just projections based on a modal outlook. Each person comes into the meeting and has a view on that, and so I don't think really right now the key issue for the FOMC is when is the economy going to get to this point where we meet these these conditions that we've set out in the FOMC statement about time for the liftoff of the Fed funds rate. That's still way off in the future. Right now, really, I think the attention is on the taper. In terms of my own views, my focus is really on the framework. Is our new policy framework introduced last year I think positions us really well to deal with the situations that we're dealing with today and will over the next few years. And I think our FOMC guidance around the Fed funds rate is a very strong place to be. And that's, so when we get to that point where the economy is meeting those, conditions that we've laid out in the FOMC statement, I think that's when we'll get to the discussion about whether the Fed funds rate, what's the appropriate stance of the Fed funds rate. That's still, quite a ways off from today.
Well, if you won't tell us where your dot is, let me ask it this way. You were quite bullish yesterday in your speech. And yet we're still quite a ways from substantial further progress. Are we getting to that substantial further progress more quickly than you thought? Does the economy's speed surprise you, and is the inflation number to you surprising?
Well, let me start with the inflation. Clearly, recent inflation number has been very high. Obviously get a lot of attention from us and from everybody, and really we need to be very careful watching that data, seeing to what extent these are just transitory, temporary factors, or do they spill into kind of underlying inflation over the next few years. So clearly, inflation has moved up quite a bit. That's something that's part of the picture. In terms of employment, I do tend to go back to indicators like the employment to population ratio and the unemployment rate, and a lot of other indicators of the health of the labor market. And we have made progress for sure since December of last year, but that progress is I still don't think it's close to the substantial further progress that we set out on. And really, it's going to my views on this would depend on how the data evolve over coming months. Are we adding a large number of jobs? Do we see employment to population continue to move back up? And watching obviously all the other indicators as well. So I'm really focused on employment because that's what our mandate is, and are we making really strong progress towards the maximum employment goal that we have.
John, when it comes to the participation rate in the US labour market, do you have any conviction around what that looks like, how that progresses through the next 12 months? How unknown is that?
Yeah, that's obviously a really hard question. Participation changes for a variety of reasons. We've seen a lot of churn in the labor market in the past few months. People exiting the labor market, coming in. a lot happening with the reopening of the economy and all the events of the past year and a half of the pandemic. So I think right now it's hard to get a clear read on the underlying trends. I do tend to look at one category in the data, which is the employment population for 25 to 54-year-olds, which probably more in the middle of people's careers. And if you look back before the before the pandemic, that was over 80%. So I think that hopefully we can get back towards a number like that. But and for the overall population, we have seen some retirements from some older workers. So I think we'll have to carefully analyze that data to see if that's shifted the trend somewhat in terms of labor force participation. So I think we have to just look at the data carefully, analyze it, and come to our best assessment of what maximum employment was. Now, one thing I just want to say is we had an unemployment rate of 3.5% before the pandemic. We had very strong labor force participation, and I don't see any reason that our economy can't reattain a really strong labor market similar to that. It may be slightly different in terms of participation and some of the other issues, but it should still be an economy that is really a very strong one with maximum employment, again, with our 2% inflation.
Going forward from here, President Williams, as you know, you do get a lot of criticism over the current policy stance, and often the Federal Reserve will bring up the labour market to support the current policy stance. We had a story from the Wall Street Journal this morning on Blackstone agreeing to buy a company that buys and rents single-family homes in a $6 billion deal. This is Wall Street competing with Main Street for single-family homes. Is the Federal Reserve part of the problem when it comes to this?
Well, we're doing, conducting monetary policy, which is really about setting interest rates and supporting a strong economic recovery and our inflation goals. There's always developments in the markets that, or maybe they're affected somewhat by interest rates, but I think are really driven by other factors. And I just remind people too, when we think about why interest rates are so low and maybe how people are behaving around very low interest rates, I think a key part of this is that this is a structural change in the global economy. We have very low interest rates globally, not just because the Fed is holding interest rates lower right now to support the recovery, which we're doing, but even once the economy is fully recovered, we've achieved our goals. The neutral or kind of longer run interest rate is still very low. So I think just when we watch kind of things like this, we have to keep in mind that part of low interest rates is obviously intentional by Fed policy, but part of it is really a big part of the decline in interest rates over the past few decades is driven by more structural things like demographics and productivity.
Usage of the Fed's overnight reverse repo facility has surged, hit a record yesterday, $765 billion. Why isn't that a signal that there is too much cash in the markets and you don't need to add more?
Well, the goal here is not to add cash to the markets, Mike. It is to, with our asset purchases, is to provide really strong financial conditions to support economic growth. An effect of that is that, that does our purchases of assets and other developments have been pushing, up the amount of reserves that would be in the banking system. Now, we created the overnight reverse repo facility, which you just mentioned, years ago. Specifically to make sure that interest rates are in the range that the FOMC set. So the FOMC has set a target range for the Fed funds rate of 0 to 25 basis points. And it's, we want to make sure the interest rates stay well within that range and not fall below it or not be above it. And so one of the ways that we do that is by, through the overnight reverse repo, putting a floor on interest rates. So what we're seeing here is, I think, the natural operation of this kind of arrangements that we've set up to control interest rates. So, banks can hold reserves and do that at the Fed, and they offered, deposit rates and other services to their customers. Customers look at what the banks are offering in terms of deposit rates. They also look at money market mutual funds and other investments and think about where is it best to park their cash. So we see a natural movement between these two, especially with the large amount of reserves. We're seeing investors finding the money market mutual fund option more advantageous, and so we're seeing a lot more money moving the overnight reverse repo facility, and that has shifted over time. That's exactly how the system is supposed to work. Interest rates are well within the range, just as the FOMC wants, and we're not seeing any problems with market functioning or anything. It's working exactly as designed, and I'm not concerned about the large amount of overnight reverse repos. It's exactly what you'd expect given conditions in money markets. So this is I think a good sign.
President Williams, you've been kind with your time, and it's always great to catch up. We appreciate it, sir. The president of the New York Fed, John Williams, there alongside Mike McKee. Mike McKee, a little clarity there on the position of a core member of the Federal Reserve. We're not there yet.
Yeah, it's a little bit like the old Ronald Reagan saying about the Soviet Union, trust but verify. They think their forecast is good for inflation and they see a strong economy, but they want to prove it before they take any action. And maybe President Williams' comments today reassure markets that nothing too hasty is going to happen. We had a narrative that the Fed was going to move too slowly. After last week, it was going to move too quickly.
Yeah.
Now maybe they get the baby bear idea of it's just right.
Mike, when it comes to substantial further progress and data dependency, it's hard to reconcile the two right now if you don't give me a numerical description of the former.
Well, it's, again, one of those situations where they're trying to maintain maximum flexibility because they don't know what's going to happen. This is a brand new situation for any economist, and they don't want to go too far one way or the other and then have people say, well, the Fed screwed it up. So you can expect a lot more of this kind of either or. Two-handed economist talk.
I think it's fair to say you can expect criticism of the Federal Reserve regardless of what happens. Mike McKee on top of the story, as always. Mike, good to catch up. Good to see you, sir, and thank you for arranging that interview with the New York Fed President, John Williams. Your price action like this morning, Bitcoin extending its loss. The equity market price action pretty muted. From New York, this is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Bloomberg Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food, they're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá? I'm asking about why he's alone right here. He said things of in life happens. You know, I'm here by myself.
So ¿dónde vive acá? En la parte de Rivera.
This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansathi.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. Jeevansathi.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji like you use the most to send to each other?
There's a bear which basically we use for indicating a hug.
Yeah, that's our language basically, bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a Juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry city?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname
Pocahontas.
Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
Okay.
In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you.
Millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law, with its swagger and ill-fitting suits, caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
So there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty. The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
It's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood and it was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
The ongoing spat between Khan and US President Donald Trump escalated when Trump went after Khan, misquoting him on Twitter just hours after the terrorist attacks of June 3rd, 2017. Khan's now one of the most prominent Labour politicians in the UK. In fact, a recent poll of Londoners found Khan was more trusted to keep the country safe from terrorism than the Prime Minister or the Labour leader. His story of going from the son of an immigrant bus driver to the mayor of one of the greatest cities in the world plays well with Londoners. But can he appeal to the rest of the nation? Has Khan got his eye on the top job? And is the UK ready for a Muslim Prime Minister?
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, U.S. Navy, and other branches of the U.S. government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hacked emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning, who used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the Collateral murder video.
Come on, fire!
It was a vivid, graphic video. It changed the debate on the Iraq War, and importantly, it put WikiLeaks on the map when they put it online, and they couldn't be ignored at that point.
And those leaks were just the beginning. They went on to post more than 90,000 leaked documents known as the Afghan war logs, 390,000 documents known as the Iraq war logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats who faced real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the U.S. government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped at the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft to the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons, in all fairness. Don't you think?
Once WikiLeaks started exposing secrets of the Democratic Party, Julian Assange became a hero to many on the right. Public opinion kind of flip-flopped.
WikiLeaks!
From the emails, we now know Hillary Clinton's campaign manager makes risotto, and also how the DNC squashed Bernie Sanders' campaign. One thing we don't know is who gave Assange the stolen emails in the first place.
Many leading Democrats say they suspect it was the Russians. They released an analysis from a private cybersecurity firm that had said it was the Russians.
But Assange claims
our source is not the Russian government and it is not a state party.
So this is where we stand today. The public still doesn't know who provided the emails to WikiLeaks. Meanwhile, Assange is still running WikiLeaks and still releasing documents. In March 2017, he started publishing documents from the CIA's Center for Cyber Intelligence called Vault 7.
The CIA, the agency charged with finding and keeping our top secrets, can't keep its own secrets.
As long as Assange has a connection to the world, no government secret will be too far from exposure.
Julian Assange is still in the embassy. Maybe he'll leave, maybe he won't. Kind of regardless, his work has been done. He's changed the way people think about their governments, about their own secrets, about their own hackability, and really the world has changed because of him.
When it debuted, the 4G wireless we have today allowed people for the first time to hit the road and explore unknown places with only a smartphone for directions. When 5G arrives, it could enable driverless cars to take us there as well. 5G stands for 5th generation mobile networks or wireless systems. It's insanely fast and can accommodate a lot more connected devices. But the reason it's being called revolutionary is because 5G will allow connected devices to speak to each other as well as people.
Right now we're living in a world where really it's a one-way experience.
That's Bloomberg tech reporter Ian King.
The network talks to your phone, you look at your phone and access data, then you send something back to the network. What we're being told about 5G is that really for the first time we're going to see machines communicating with each other over mobile networks in a meaningful way.
5G could end up being 100 times faster than what we have now, with speeds that could reach 20 gigabits per second. In plain English, that means downloading a full-length HD movie in seconds. 5G will also increase total bandwidth, which we will need in order to accommodate the growing Internet of Things. We're talking about the class of devices like internet-connected refrigerators, thermostats, dog collars, but 5G will enable many, many more.
Things like your utility network, factories, where machines are just sat there not connected at all. Suddenly they're all going to be connected. Suddenly we're going to be able to have real-time monitoring. Other things like cars, like utility poles, like your light, the light poles.
But perhaps the biggest advance will be a huge reduction in communication lag time, known as latency. A network of driverless cars will need the speed of 5G to ping each other multiple times per second to avoid collisions. Near instantaneous data transfers could allow doctors to perform surgery remotely with a robotic scalpel. So how will all this work? First, you need to improve network density.
And that's just a fancy word for saying you put more towers out there. What we're being told is that's not actually the case with 5G.
The idea is 5G will not only use the existing mobile spectrum, but also tap into higher frequencies called millimeter waves. Millimeter waves can carry more data, but only travel short distances. This may mean you'll see a lot more of these base stations around town. And the new towers may have as many as 100 antenna ports, compared to about a dozen on 4G cell towers. So when will we get 5G? Getting 5G ready is expected to cost providers $275 billion over 7 years in the US alone. Look for the first 5G service to pop up in big cities sometime in 2019.
When people think of Vladimir Putin, they think of capital P, power. And that's exactly the impression he creates. Whether it's physical power, firing different weapons, riding in various James Bond-esque modes of transportation, or tossing hapless opponents in judo. Or political power, ruling his own country with an iron fist, crushing his political opposition, or, most recently, being accused of meddling in foreign elections for his own benefit. This is how Vladimir Putin went from a poor, tough kid in Leningrad to a KGB spy to the very symbol of modern Russia. Vladimir Vladimirovich Putin was born in 1952 in Leningrad, which is now St. Petersburg. His father was a factory foreman and his mother a homemaker. It is widely said that Putin's public-facing tough guy persona can be traced back to him getting into fights when he was younger, which paved the way for him to take up judo. After getting a law degree from Leningrad State University, Putin joined the KGB Foreign Intelligence Service. He spent 16 years in the KGB. When Putin returned to Russia, he began his political career.
He went to work for
Anatoly Sobchak, who was then the mayor of St. Petersburg.
That's Leonid Bershidsky.
I'm a columnist at Bloomberg View.
Putin thrived in Sobchak's administration because
he was sort of considered pretty efficient city official at that time. He was very loyal to Sobchak.
So loyal and efficient that
he was noticed by Yeltsin's close circle.
And those people soon brought Putin over to Moscow to work in Yeltsin's administration, where he quickly climbed the political ladder.
Then, of course, he was promoted to Prime Minister of Russia.
That's Dmitry Trenin.
I am currently director of the Carnegie Moscow Center.
Around this time, Yeltsin and the people around him, the so-called family, decided that Putin would become Yeltsin's successor. And then this happened. The apartment bombings were carried out in 3 Russian cities, killing 293 people and injuring more than 1,000. Putin immediately accused Chechen separatists for the bombings and followed it up with action.
He was credited with having a very successful military campaign against the terrorists.
And it worked.
After that, he became an heir apparent in the eyes of the Russian people.
3 months later, Yeltsin resigned. And on his way out, a famous exchange.
He was getting into the car in the Kremlin, and the last words that he addressed to Putin before getting into his car was, "Take good care of Russia."
So Putin took over as president, and 3 months after that, won his first election. But just because Putin won the presidency, that didn't mean he had all the power. This is Michael McFaul.
I was U.S. ambassador from 2012 to 2014. In the 1990s, there was a fire sale of all the things worth owning in Russia, and certain people,
the oligarchs,
did better than others in that fire sale, sometimes called privatization, and those people tended to be well connected with the Yeltsin regime, and they weren't Putin's friends.
But they probably miscalculated, thinking that they could easily find a way to influence him. It became impossible almost from the start.
From that very moment, there was warfare between him and the oligarchs.
That's when Putin gave the oligarchs a choice. Putin's way.
Some of those people from the 90s managed to figure out a new way of dealing with Putin and have survived.
Or prison.
Others could not find common vision, and so they lost their assets.
Khodorkovsky once was Russia's richest person, worth $15 billion, but he ran afoul of President Vladimir Putin and spent a decade in prison.
With domestic power consolidated, Putin focused on restoring Russia's global influence.
Putin is the guy who believes in the expansionist Russian state. Georgia and Ukraine and all the other Soviet republics that split off when the Soviet Union fell apart, he still believes that they're traditional Russian satellites. A lot of his strategy is about keeping them in the orbit. That Yeltsin line, take good care of Russia, that's how he understands it.
And he used annexation and invasion, as well as oil, gas, and trade to keep former Soviet republics in Russia's orbit. In 2008, Putin's 2 terms were up, and he decided to step down as president. Dmitry Medvedev stepped in as president, and Putin went back to prime minister. But really,
Putin never left power. He pretty much continued running the country, and Medvedev was a bit of a figurehead.
There was actually a period of cooperation between Russia and the U.S. that benefited both countries during Medvedev's presidency.
Because Medvedev did not have the same negative attitude towards the West as Putin did.
But when Putin came back to run for a 3rd term, in the lead up to the 2012 election, it was widely believed that both the presidential and parliamentary elections were rigged, and Russians took to the streets. Putin blamed the protests squarely on America, and more specifically, Secretary of State Hillary Clinton.
He believed that she had sent, and this is his words, a signal to demonstrators.
Still, Putin won by a huge margin and set about crushing the protest movement immediately upon his return to the Kremlin. Over the next few years, Russia's economy tumbled. Putin annexed Crimea, leading to sanctions. The price of oil fell drastically. The ruble hit a new low, and America played down Russia's influence, with Obama calling Russia
a regional power.
Despite all of that, Putin's approval rating remained sky high, and then an opportunity for payback.
I think I'd get along very well with Vladimir Putin.
In 2016, there was one candidate who called Vladimir Putin very smart.
Trump exhibited tolerance towards Putin's actions annexing Crimea, and similar views on NATO and sanctions.
Hillary Clinton didn't support any of those views.
Even though Putin denies any wrongdoing,
U.S. elections.
Yes.
the U.S. has accused Russia of being behind the leaking of 20,000 Democratic National Committee emails, which many say helped Trump beat Hillary Clinton in the presidential election. Which leaves us here, with the possibility of a President Putin until 2024, positioning Russia to be the world power he always imagined it should be.
Jack Ma is Asia's richest man and most recognizable business tycoon. He's the chairman of Alibaba, China's e-commerce giant and one of the 10 largest companies in the world. Yet he still wants more.
We know where we're going. We want to be the 5th largest economy.
Big words from the man some call Asia's Jeff Bezos. He's confident, he's charismatic, and he's definitely not the average CEO. This is how a poor school teacher went from the classroom to being one of the most influential multi-billionaires in the world. Ma was born in China's southeastern city Hangzhou in 1964. His parents were traditional musician storytellers. As a teenager, he started to learn English from foreign tourists after China opened up in the late 1970s.
And then for 9 years, Jack Ma hung around outside the Hangzhou Hotel, which is now called the Shangri-La. He would get up at 5 a.m. to talk to travelers.
That's Bloomberg technology reporter Lulu Chen.
And I cover China Internet for Bloomberg.
Ma failed China's National University entrance exam twice before being admitted to local teachers' college. He graduated in 1988. He applied for 30 jobs and got rejected, including from the fast food giant KFC.
When KFC came to China, come to us say,
24 people went for the job. 23 people accepted. I was the only guy.
Then Ma got a job at a local university and taught English there for about 5 years, earning just $15 a month. On the side, he started a translation company with several friends. During a company trip to the US in 1995, Ma had his first encounter with the internet at a friend's place in Seattle.
I searched the first word, beer. I don't know why, because it's easy to spell, baby. And I see beers from Germany, beers from USA, beers from Japan, but there's no beer from China.
So he searched for the word China instead and still couldn't find anything. And that got him thinking. He wanted to build something that would put China on the world's map.
He started China Pages, a Yellow Pages-like website, but it didn't take off. Then Ma joined a government agency in Beijing to help set up a website. By 1999, the internet stock boom had gripped Wall Street, and back in his Hangzhou apartment, Ma decided to try again. With his wife and a group of friends, Ma raised $80,000 and set up Alibaba, a site that allowed businesses to sell stuff to each other.
人家美国人强就强它的硬件，强就强它的系统建设，这方面确实比你早。但是玩信息玩软的，中国人的脑袋绝不比他们差。我们在座的所有人的脑袋绝不比他们差。
By 2000, Alibaba had raised $25 million from investors, including Goldman Sachs and SoftBank.
He had no business plan and zero revenue, but his eyes was very strong eyes.
In 2003, Alibaba started Taobao, a platform for individual sellers to trade with each other, and publicly declared war against eBay, who had started to make a foray into China.
Jack Ma has this famous saying that Alibaba is a crocodile in the Yangtze River, whereas eBay is a shark in the ocean. And if they fight eBay in the ocean, then they'll lose. But if they fight them in the Yangtze River, then they have a home base advantage.
In 2007, just 1 year after it forced eBay out of China, Alibaba debuted its business-facing division on the Hong Kong Stock Exchange. But it delisted 5 years later as its performance sagged. But in 2014, Alibaba raised $25 billion in the world's biggest IPO in New York.
Everybody should have a dream. What if that dream comes true?
After achieving dominance in the business of e-commerce in China, Alibaba has been building an internet empire worth $472 billion, with businesses in cloud computing, online video streaming, movie production, healthcare, sports, retail, and even news media.
Alibaba buying into South China Morning Post really raised eyebrows. This is the largest English newspaper in Hong Kong, and it shows that Jack Ma's ambitions weren't limited to e-commerce. He wanted to influence not just Chinese users, but also overseas users as well.
The US has criticized Alibaba for allowing companies to sell counterfeit and poorly made goods, but in China, it enjoys the favor of China's government. It's part of Ma's company philosophy.
In love with the government, but don't marry with them.
Jack Ma's an extremely fortunate man for jumping on the internet sector so early. Note that this is a person who has no coding skills at all. He's a natural showman and a gifted public speaker, and really able to convince others to believe in his vision.
Ma's vision of growing Alibaba to be the world's 5th largest economy faces strong competition at home and abroad. It will require more than just naked ambition and charisma, but Ma is great at getting himself in the right place at the right time. So far, it's served him well.
Peter Thiel is a walking contradiction. He got his bachelor's and Juris Doctorate from Stanford, but speaks out about the horrors of higher education, saying college is
as corrupt as the Catholic Church was 500 years ago.
He's a staunch supporter of the free press, yet he bankrolled a lawsuit to bankrupt an independent media company.
But these were not journalists.
And most of all, he's an immigrant libertarian who's the most public supporter of Donald Trump in all of Silicon Valley.
What Trump represents isn't crazy, and it's not going away.
This is the story of how an openly gay, immigrant genius, libertarian billionaire went from tech contrarian to Silicon Valley's biggest Trump supporter. Peter Thiel was born on October 11, 1967 in Frankfurt, West Germany, to Suzanne and Klaus Thiel. Peter's family emigrated to Cleveland, Ohio when he was 1. An Ayn Rand devotee during his youth, Thiel attended Stanford University majoring in philosophy.
His Stanford experience shaped a really big part of who he decided to surround himself with.
That's Lizette Chapman.
And I cover technology and venture capital here at Bloomberg.
He and his Stanford friends made their first big splash in tech with PayPal. After selling to eBay for $1.5 billion, they would become known as the PayPal Mafia for each incredible success after PayPal. For Thiel, that began with an early, modest $500,000 investment in Facebook.
And in VC speak, early means big risk, but also big reward. He turned that initial $500,000 investment into more than $1 billion in cash.
But Thiel was just getting started with Facebook, and he went on to make a whole bunch of wildly successful investments.
From SpaceX to Airbnb to one of the largest, most powerful companies in the United States, if not the world, and of course that's Palantir.
The incredibly controversial secretive data mining startup he founded with his colleagues from PayPal. It connects data silos and then allows non-technical people to search that information for patterns. Data like
financial information, feeds from video cameras, biometric details, passport information, flight manifest.
Palantir doesn't talk much about how they collect this data, who has access to it, or what they do with it. But they have contracts with
the Department of Homeland Security and the CIA and the Department of Justice and the Securities and Exchange Commission
and several other federal agencies. It's the richest company you've never heard of, valued at $20 billion. But there are plenty of obscenely wealthy people in Silicon Valley. What makes him different...
He's a complex ball of multiple contradictions.
Take college, for example. Even though college was extremely important for Thiel, there's something called the Thiel Fellowship.
In exchange for dropping out and a promise not to pursue college, Thiel would give them $100,000 each.
You basically tell people that if you get a diploma, you're saved. Otherwise you go to hell. You go to Yale or you go to jail.
Also, his relationship with the press.
Here's another contradiction. He's donated to free press initiatives, including the Committee to Protect Journalists.
But he also secretly spent tens of millions of dollars bankrolling a lawsuit filed by Hulk Hogan over the publication of a sex tape and bankrupting the independently run Gawker Media. Why did he do this? because in 2007, one of Gawker Media's blogs, Valuag, outed him as gay. And with the lawsuit, he
found an opportunity to get back at them by funding the lawsuit that Hulk Hogan was able to bring then, but he wouldn't have been able to do that without Thiel's money.
And finally, Thiel's biggest contradiction, his endorsement of Donald Trump.
When he was asked about his support for Trump, he was surprised at the outrage that came with it from many of his colleagues in Silicon Valley. He didn't want more of the establishment.
No matter how crazy this election seems, it is less crazy than the condition of our country.
After briefly supporting Carly Fiorina in the primaries, Thiel pivoted to Trump, donating $1.25 million to Trump and his associated super PACs in October 2016. And he didn't just help Trump financially. He gave a full-throated keynote speech supporting Trump at the Republican National Convention.
I'm not a politician, but neither is Donald Trump. He is a builder, and it's time to rebuild America.
And when Trump was finally elected, Thiel was given the reins to an enormous amount of power.
And I want to thank you, man. You have a very special back.
He was named the transitional advisor. And in that role, he did a lot of interviewing and a lot of vetting to fill hundreds of cabinet positions and different jobs within the administration.
But it turns out, Thiel's support isn't unconditional.
Talking to people who spend time with him, I have also heard that he is no longer a great supporter of Trump.
It was reported that Thiel was unhappy with the direction of Trump's presidency. Ever since, he's been mum, making no public appearances, no statements, and staying out of the spotlight altogether. Although there have been suggestions that Trump could tap Thiel for a top intelligence post or ambassadorship, there's no indication he'd accept.
He's described his relationship with politics as schizophrenic. He gets really involved, and then he runs away as fast as possible.
Whether Thiel takes a new position or simply continues as a board director at Facebook and Palantir, at just 50 years old, he's primed to wield some serious influence in technology and politics for decades to come.
2016 was again the hottest year on record, and the previous 17 years have seen our 16 most scorching. Scientists overwhelmingly agree. Global warming is the culprit. And it's just getting started. Ice caps, extreme weather, wildfires, droughts, and the hits keep coming. What are we doing about it? In 2015, the world took its boldest step yet to stem climate change with a historic accord in Paris. But now comes the hard part. Nations must change energy policies and invest huge amounts of money, and they will likely do it without the United States. President Donald Trump announced on June 1st that the U.S. would withdraw from the accord.
The reality is that withdrawing is in America's economic interest and won't matter much to the climate.
Here's the situation. Decades in the making, the Paris Agreement united the U.S., China, and more than 190 other nations in a push to limit fossil fuel pollution. The UN-sponsored plan secured pledges to cut greenhouse gases, the emissions that trap heat in the Earth's atmosphere, in an effort to avoid the rising seas and other environmental disasters that climate models predict. But even if all pledges are met, the globe is expected to warm by as much as 3.4 degrees Celsius this century, more than the UN target of well below 2 degrees. Meeting the Paris Agreement means that governments will have to offer more incentives for clean energy, scale back support for fossil fuels, make emissions more costly, and reduce deforestation. It's estimated that the deal will require $13.5 trillion of spending through 2030. Here's the argument. Unlike past climate pacts such as the Kyoto Protocol, each country set its own Paris targets and then promised to revisit and improve them. The U.S. was primed to play a lead role in climate change, but Trump's Energy Independence Executive Order reverses Obama-era rules and directives put in place to combat climate change, and expands production of coal, the dirtiest fossil fuel. The resulting policies threaten the global fight against climate change. Without the U.S. commitment to emissions reduction, other countries may join it in abandoning the Paris Agreement. This could make it almost impossible and even more expensive down the line to stop climate change. Optimists argue that the shift to a lower carbon future is already underway. Businesses, cities, and U.S. states, such as California, are already investing in wind and solar and taking other steps to make it work.
I've actually been called an environmentalist, if you can believe that.
There's an inherent attraction to light and being human. And I think on a very deep psychological level, light is this way in which we experience the energy surrounding us in a very personal manner. My name is Matt Dilling. I'm the founder of Light Bright Neon Studio, and we manufacture, produce, and restore neon works of art and design. Origins of the creative content of a lot of the work at Light Bright comes from a variety of sources. Sometimes people come with a napkin sketch, some people come with an Adobe Illustrator file, and we have a whole design team who then we kind of work together to help create layouts of what it might look like. Scale it up and create a paper template using a pen plotter. And that paper template actually becomes our guide for what we're going to bend the neon to. We take from the office into the glass shop. We pick out the right size tubing with the right color for the right size project. From there, we heat up the glass tubing. The torches heat the glass well in excess of 1,000 degrees in order for it to get into its molten state. We heat up and bend the glass tubing to match the template. One of our chandeliers has over 100 different bends in it. So each one of those bends has to be marked for a heated up bend. We also have to allow the glass to cool between the bends so that the next area can be worked on and heated up in its own unique fashion. It turns into spaghetti, and then we have to make sure that that spaghetti lines back up and cools to the template. We use a blow hose to connect our mouth to the tube, create a volume that's closed, and we can control the pressure in there with our mouth. There's just a variety of challenges that come up inherently in working with glass. Glass can crack due to stress, and sometimes you'll just have a batch that all it wants to do when it gets near a torch is crack. After we've bent various components, we have to go in using the crossfire or the hand torch and actually weld all of those pieces together. The last step on that is then to weld on electrodes onto either end. Each one of those steps is very, very specific. I draw inspiration from so many different experiences. It's hard to come up with one thing that's particular, but one of the ways that I really am able to connect with the creative is to float. Floating is a similar experience to meditation, to psychedelics. Going into a blackened room and laying out in a body of water and salt that's heated to your body temperature, and it allows for all sort of external stimulation to fall away. And your internal world really begins to bubble up and manifest. You really get to experience a different relationship to your mind. I think I work with neon because I can't not work with it. It's so challenging and so rewarding. And those things are so intertwined that there's no way of separating it out. I learn so much and continue to learn so much by working with it. I find so much inspiration in working with it, and I just continue to experience new and different things through the medium. It's that close to me at this point. Once the neon tube is completed, we have to hook it up to our manifold for bombarding. The manifold is opened, a vacuum is drawn. We check the tube for leaks with our Tesla coil. We close the tube back off, and we heat it up using a very large and powerful transformer. As the tube is heated up, it releases anything that's not inert inside the tube, and we evacuate that out. We introduce the gas into it. ignition, we seal the tube off, sealing into that tube whatever gas we introduced into it. I think my favorite part of making a neon light is when I see it lit up for the first time. Different gases, when electrified, emit different wavelengths of light. Neon gas is this very bright orange, fiery red color. Argon gas creates a very intense blue, but that light output that is produced can then be expressed in a different wavelength by coating the inside of the tubes with a phosphor coating that takes that one wavelength of light and emits at different wavelengths. We bring it over to the aging table where we hook it up to an age-in transformer and allow it to settle, age the gas in that we've introduced to it. There's always a stray particle of something left inside the tube. But that time that the oxide coating can act to scrub whatever is left inside the tube while things are getting settled into place. Once the tubes are aged in, we move on to our process of assembling two halves of the fixture together in a jig, gluing up the center of the fixture to its spindle. Once the adhesive dried, we would connect the wires from the fixture together into a transformer, and we turn on power and it lights up. Part of what we love about what we do here is that we try and put out into the world the kind of things that we'd like to see. I still am surprised when it lights up. I'm still excited when I get to see it illuminated. There's an ineffable quality to it. To me, it is this insight into the inner workings of the universe. It literally is. It's a way of looking at what is surrounding us in the cosmos in a new light.
a bit like an addiction. You've got to make something, you have to do something. It's borderline obsession. And every bike we build is my favourite bike at the time, and as soon as it's done, I want to build another one. Sven Cycles is something I've been thinking about ever since I started cycling in my late teens. We want bikes that ultimately you'll really enjoy riding. There's never a bike that's the same. There's always a slight change, and as we build them individually as well, they have the marks of a bike that's built by hand. Most people I know cycle have an idea of their dream bicycle, and it may be an evolving idea you've had in your head. And we've worked with a lot of people that have come to us with sketches and scrapbooks. It's really, really nice to build something that's just one-off and unique. I think a lot of people see a bicycle as two wheels and a frame in the middle. There are a lot of subtle changes and nuances in design which can change the riding characteristics quite dramatically. I'm a really big fan of modernist architecture, and the simplicity of a modernist building is really hard to achieve. And with some of our bikes, they may look very simple, but I think people should not underestimate the time and effort that goes into designing a product. Tubing is key to a bike's feel and ride. Reynolds tubing has been in my life ever since I can remember. Growing up, I could never afford a frame manufactured with their tubing. We can now put a badge on our bike saying manufactured at Reynolds, which is a sort of thing as a kid I just wouldn't have believed was going to happen. Every part of the bike has a specific tube. It's not universal. The first thing we do is get the tubes out, check they're correct, check the wall thicknesses, sand the edges, make sure it's all really clean, because if it's not clean, the tubes won't join together correctly. We build in steel because I still believe it's one of the best materials to use. It's been used in bikes since the late 1800s, and they're still using it now for a very good reason. It's the flexibility that we can replace the tube, repaint the bike, and you wouldn't know it's damaged. I just like working with it. It's very sculptural. This isn't sort of aerospace precision engineering. It's a steel rule and a marker. So when we're cutting the tubes, it's within a mil or two. But what we're trying to do is take the best from bicycle building in the past and add a little bit of modern flair to it. There's various techniques for building bicycles. We do a thing called fillet brazing, where you connect a pipe together. We use a bronze rod and a flame. We heat the tubes up to the same temperature and we fill the joint with bronze. And it gives a very, very sort of fluid, lovely, sort of quite sculptural feel. You've got to practice, you've got to be able to judge material temperatures, you've got to just look at it and you just get a feel for it. It's the stage where your tubes start to look a bit like a bicycle. My father's a jeweller. He'd make sort of very pretty things, which are lovely, but for me, they don't really have any function. What I love about bicycles, you can start on a Monday with a box of tubes, and you can be riding it by the weekend, and it can last you for the rest of your life. Outside of the frame and forks, the other most important part is the wheels and tyres. When you build the wheels, you have to lace them, so there's little holes going all the way around the rim. You poke the spoke through. We do build all our wheels by hand here because a machine can't get 30 years worth of wheel building experience. Colour is very, very personal. With any of our bikes, you can have them painted whatever colour you want. We've matched one to a teapot, so we can get that scanned and we can match that, or someone's favourite item of clothing. I like to let the bike sit for 4 or 5 days minimum, just so the paint can have time to cure a little bit, and then we assemble it. We get out all the new components, and it's a case of putting them together. Some bikes you can assemble in 3 hours, some will take 3 days. And we've built bikes that cost in the £10,000 plus mark. Some people, they're saving up and this is their bike and they're going to own it for the rest of their lives, so we just want to make sure they get the right thing. I think the bike for me was the first time I had some freedom, so as soon as I had one I was off. A lot of people still get that thrill as when they were a kid blasting down a hill, wind going through their hair. It's fun. Everyone has their favourite jacket or something that just makes them feel good. If you've got a bike that fits well, you actually feel part of it. Building bicycles as a creative outlet is fantastic. It's not something you do because you're going to get a big paycheck at the end of the day. You do it something you have a passion for it.
If you ever saw a wooden surfboard, it was probably hanging in somebody's house or underneath the deck. But kind of in the last 10 or 15 years, wood has made a big comeback. They surf wonderfully. It's beautiful and it feels great to be on one of them. I always had a love for wood and kind of passionate about things that went in the water. I've kind of been around wooden boats most of my life. There's just so much character. The way they're built, the stories that come with them, a lot of that has translated over to why we build surfboards the way we do. When we first started thinking about building surfboards, wood was the natural material we chose. They have a very high strength to weight ratio. Wooden surfboards have the longest history of use in the surf world than any other material. People have been surfing wooden surfboards since kind of the first documented history of people riding waves. The board starts in CAD, where we take a 3D model, break down the shape, and kind of create frames and templates and all the inner parts of the board that we get cut on a CNC machine. We take those frames and we just pop them out, assemble the frame into kind of a skeleton. We go out to our lumber shed, pick a bunch of cedar, and bring them into our mill shop, put glue along the edges, clamp it all together into a panel. Everything's book matched, you have symmetry in the colors and texture of the wood. Cut your outline. Take our assembled frame, gently put it down right on top of the plank. Once that foundation is started, you're basically building up the three-dimensional shape, the outside part of the board, using lots of strips that kind of interlock and fit together. Every piece of wood is going to be different, and it's all going to react differently. There are frustrations with it, but I think that's one of the things that keeps it challenging. You learn to read the kind of what the grain lines are doing and what the color of the wood is telling you. Once those rails are cleaned up, we put our top planks on. It's a little bit like putting a lid on a box. It's like, this is it. Whatever's inside that board is staying inside that board. And by tensioning some rope, you can clamp the two together. It's like a time capsule. What makes our boards unique are they are built right here in York. They're built using material that grows right here in the state of Maine. They're built 100% by hand by local craftspeople and surfers. There's a lot of time that goes into these boards, between 40 and 60 hours, start to finish. We wanted to build surfboards that were as hollow as they could be, but still be strong enough to work well. Too light and they don't surf well, but too heavy and they don't surf well. So there's a balance point there, and that's where we try to be. Taking the board off the rocker table once the top has gone on, that is by far one of my top favorite parts. It's just you and a shaping stand, a board, and a hand plane. Everything else is out of your view. It's simple, it's pleasurable, it's quiet. You can be with your thoughts and you can just kind of be present. There's something about taking a nice sharp edge tool to a beautiful piece of wood and feeling the curls coming off and knowing that every pass that you're making, you're kind of getting it closer and closer to what you have in mind. Once we've shaped it down and the board's looking like it's supposed to look like, it's time for it to go into the glassing room. 4-ounce fiberglass, laying it over the board, draping it over the edges, cutting it, applying epoxy, and on the board. Once both sides are lamb coated, it's time to put in the hardware. Drill and router and install the fin box. And on the other side, we drill and put in the leash plug and a vent. There's a lot of air just naturally inside the board, and that air wants to expand and contract with temperature changes. And that vent has a little piece of Gore-Tex fabric in it, and it allows air to kind of breathe both ways, but it doesn't allow water to get in. Once all that hardware is put in, it goes back into the glassing room. We brush a nice, beautiful, thick coat of epoxy over the whole surface, and that we call a gloss coat. That's supposed to look beautiful and glossy and shiny and flawless. You get to see that board come to life. Whatever the colors in the wood, they really come out. It just makes it look like candy. You just want to touch it and run your hands down it, and it's just kind of the icing on the cake. Once everything is hard, we put it into what we call the oven, get that epoxy to cure, really kind of bake it, and just get it to harden. Put in the fin, screw in the vent, and ship it out. We just love the idea of building something that's sustainable and long-lasting and made by hand. Kind of gives you a deeper connection to the product over something you might buy on a shelf. When a customer gets the board, they feel it. They 100% feel the amount of work and the amount of passion that went into the board. So I'm not really looking at hours and efficiency. We're looking at like doing it right and enjoying it as we go.
Ma Baoli, better known as Gang La, is one of the 4 Grand Marshals leading New York's Pride Parade this year. But in the country he comes from, being gay is still a social taboo. The CEO of a Beijing-based internet company is on a mission to improve the lives of millions of gay men in China.
对于每一个 LGBT 人群来说，即使这个国家不允许你跟同性爱人结婚，但是你仍然要勇敢地去选择你自己的生活，你仍然应该拥有幸福生活的权利。
Ma's company Blue City runs an app and a website specifically for gay men. Blued is one of the biggest gay social networking apps in the world, with an estimated 30 million registered users. Unlike most other apps, Blued is more than just dating or hookups.
大家可以在我们这个软件里面找他自己的情感，然后可以阅读相关的内容，然后可以进行一些娱乐，比如玩游戏啊，比如看直播啊等等。
Back in 2000, when Ma studied at a police school in northern China, he realized he didn't feel like everyone else.
因为他们都找女朋友，然后谈恋爱，但是我对长得好看的同性的男生，我反而觉得对我更有吸引力。所以那个时候我就到互联网上去找这样的一些资料，然后希望能够告诉我自己，我到底是谁。互联网上所有的信息都是负面的，都是错的，就是说同性恋要 电击疗法要被治疗，然后要吃药等等。
After visiting some foreign websites with different attitudes to homosexuality, Ma created his own site for a Chinese audience, encouraging people that
他们也是正常的，他们不用自卑，然后也不用自杀。
even though attitudes towards homosexuals are slowly changing in China, it's still a social stigma. The virtual world of Blued, where members can be open about their sexuality, is for most a striking contrast to their real lives. This is live streaming, a function added to Blued in late 2015, right as the internet craze was starting to take off in China. Many self-made stars like Jin make decent amounts of money by receiving audiences' virtual currencies and gifts.
我们不是彼此的初恋，初恋这种事儿多不靠谱啊。
For Kyle and Klaus, a couple who have come out, live streaming on Blued means something different.
其实我经常会收到很多粉丝的一些互动的留言，就是类似就是说你们让我们看到了同志情侣之间的一些希望啊。我看到这样的留言我是很欣慰。
The government's rules for acceptable content online may shift quickly in China, with LGBT material in a grey area. Many companies feel the chill of the recent internet crackdown, but Blue City still runs as usual. Ma has won the Chinese government's trust by helping with HIV prevention among gay men. A third of the company's staff are dedicated to screening pornographic and politically sensitive content.
我不太多的愿意去对抗，我更多的愿意去对话。 去改变他们的想法，我觉得这个可能在中国来说是更有效的。
In the past 5 years, Blue City has grown from a team of 7 people to a promising business with about 250 staff. Ma said the company earned over $15 million last year, mainly through advertising and selling virtual currencies to live streaming audiences. Now the company is expanding overseas.
我希望吧，通过我们的努力，Blued能够成为全球第一家在美国纳斯达克或者是纽交所上市的这样的同志互联网公司。
This is Rich Chigga. He's a Chinese rapper by way of Indonesia, and he's very popular on the internet. This is Joji. He's a Japanese-Australian singer, and he's also very popular on the internet. Plus, Joji invented the Harlem Shake meme. Let me say that again. This guy, Joji, in the blood bathtub, invented the Harlem Shake meme. But we'll come back to that. So Rich and Joji are both signed to 88 Rising, an entertainment company hoping to build a lasting global brand that will outlive singular moments of virality. They primarily create content combining Asian culture and hip-hop, a formula that apparently pleases the internet gods greatly. They've only been around for 18 months, but they're already putting up major label numbers.
I think that we have an unprecedented collective of talent, a group of predominantly Asian artists, really making waves globally, which from an independent point of view as well.
88's founder, Sean Miyashiro, cut his teeth launching Vice's electronic music channel, Thump. But quickly, Sean became interested in life beyond dance music.
I knew that after launching a whole content platform that I have kind of the ability and the know-how to do it again, but for what was the question.
So Sean moved to the Bronx to start over and figure it out. He couldn't afford an office space, so he worked out of his car at the top of a grimy parking garage.
Everything kind of started here. If you look around, this is my environment. This is my serenity, really. 88 Rising was built here. Built on the grounds of LA Fitness, residence in a parking garage. I was living in the Bronx. I'm just like, damn, where the hell do I go? So I just come up here and I just kind of figure things out every single day. Being like, okay, what the hell is this thing? Coming here was kind of like my own kind of private office, basically. To be honest, I would even go to the bathroom here. I would take pisses here, you know what I mean? It's just too far to go back down there. When I need Wi-Fi, I'd spend a good part of the day at Dunkin' Donuts. Hi, how are you? Can I get a chicken snack wrap?
Before 88 Rising officially launched, Sean caught a surprise break in the form of a Twitter friendship with a funny 16-year-old kid from Indonesia named Brian, who taught himself English by watching Rubik's Cube tutorial videos on YouTube. Seriously, that's true.
I thought his Twitter was genius, from the future, just crazy, and just the shit that he was saying, the memes he was making. But I didn't know that he rapped or anything like that. I really didn't, and he came up with Dat Stick 2 weeks later.
12 in the morning, pop shells for a living and baby gon' smell blood trail every minute road.
Dat Stick was Brian's first ever attempt at making a rap song, and it immediately went viral.
Everything was great about it, but the one thing that I noticed is the song was hard as hell. Just everything about it, man, just was menacing, bro.
Soon after the video dropped, Brian signed with 88 Rising.
I'll FaceTime with Rich. Sorry for calling you Rich Chigga on my phone, Rich. Brian, he gets super pissed off that he's saved in my phone as Rich Chigga. He's like, dude, am I not a human to you? What's good, bro?
What's good, brother?
How you doing?
Doing great. I just did sound check.
How was it?
It was tight. But you been a bitch, suck a thick cock.
So Brian could definitely rap, but some viewers understandably took offense at a Chinese kid satirizing rap cliches and calling himself Rich Chigga. But if a group of well-known rappers saw the video and genuinely liked it, that could at least help validate Brian as a legit hip-hop artist. Plus, it could be really funny.
It was just kind of an idea that I just had on the spot. Everything that rappers say is better and funnier and smarter and wittier. It's just more entertaining. We just edit it as tight as possible, put it up, and it really worked.
Yo, this nigga got a pouch on and a Reebok pouch.
This is the hardest nigga of all time. You said when you come for a chigga like me. That was dope.
Like, it's just lit, and I think people will take it as a joke at first, but it's like if he ran with that and kept doing more videos like that, it's just lit.
You know, I'd never been to America before, and like all of a sudden, just like I see like all the rappers that I listen to just like reacting to my stuff, and I was like, what? How did this happen?
The reaction video also went viral, and even led to a remix of Dat Stick featuring Wu-Tang's Ghostface.
I'll get on that track. You know what I'm saying? Yeah.
Really, on the remix?
Yeah. Oh, you know him?
And yeah, the remix went viral too. Brian has since acknowledged the misstep in his name and claims he may change it. But for the time being, he's still Rich Chigga to his fans. An ever-growing global audience, hungry for more releases from emerging talent around the world.
I didn't know that it was gonna be this impactful and this important to people, and I'm very thankful and blessed that it has. And every day now that I wake up, it's like it's just like a new mission every day.
A major part of that mission involves Joji. Remember the bloody bath guy? He's a former YouTube personality in the middle of a career transition.
The sound of this song, Will He, it's like a trap song that you can like slow dance to. Awkward prom shit, you know what I mean? I used to do crazy episodic internet videos. It was going well, and one day it was me and a few friends just in a room. We were casually chilling, and then someone plays the song, and it's brand new at the time. I happened to have a lot of costumes laying around, so I told the other guys, I was like, get in these costumes and let's just dance to it, like who cares? We were like, okay, let's just go crazy at the drop. So that video goes up, I go to sleep, and the next morning, everyone's doing it, like next morning. That taught me a lot about the internet, how people want to just be a part of something. And from that point on, something changed, and I was a little better at understanding demographics and people and what they want to see and what they want to hear. I was friends with a couple other artists who were affiliated with 88, and then I also started to realize that 88 is the bridge between Western and Asian entertainment, and I really wanted to be a part of that.
Joji just released the In Tongues EP, his first project as a serious artist.
Joji's In Tongues record came out a couple weeks ago. It's #2 on Billboard on the R&B charts, which is crazy for independent release, and he's like a brand new artist.
And the success is even more impressive, knowing he went from creating something like this,
"It's just Taco Bell, what could possibly go wrong?"
to creating something like this, the newest music video for his song Demons. Tonight, Rich Chigga has a show in New York City. Tickets sold out in an hour.
I came here, I'm first online. I was here at 1. I was the third person online.
So why'd you get here so early?
Because I want to see Rich Chigga. I want to touch him.
What do you guys think of Joji?
Oh my God!
That's my dad, son.
Did you guys cop the new EP or like?
Yeah. I woke up at 6 in the morning just to cop that shit. And then I listened to it, and that shit started making me cry.
This is actually kind of exciting. Every time, this never gets old. Like, you live online and social media, but like, there's nothing like just being with the people.
the fuck you said I should quit?
More often than not, viral success happens by accident. And then after an appearance on Ellen or Jimmy Kimmel, the creator's star power fizzles out. But 88 Rising has figured out how to turn potential gimmicks into brands with an actual following that keeps coming back for the next thing.
Oh, shit!
So keep an eye out for 88's next move. But more than likely, it won't be covered on network television or terrestrial radio. Although, as they've already proven, nowadays that really doesn't matter.
Online retailer Farfetch is betting it can shape the future. This is its concept store, showcasing the latest in retail tech.
How do you capture all of that fantastic information that you gather in store with customers, touch and feel products? And we created a concept called the Connected Rail. And this is using a combination of RFID and ultrasound. The RFID signal recognizes the product, and the ultrasound recognizes the movement. Take the product off, and then you'll start to see your products appear. And essentially, it's like online browsing behavior. Whichever products you touch and pick up in the store are automatically sent to your app. This is effectively what you've created is your in-store wish list. In the middle, you'll see essentially a hologram of the product. What the customer sees, they control the experience on a touch device. What this allows the customer to do is take elements of products and then add their own style to it. Right, so this is the connected mirror. So in this example, I see my products. I select a coat, and that's tried it, and it's slightly too big for me. So what I can do is choose an alternative size and send a request to the sales associate, and they'll bring that size to me in the fitting room mirror. You'll also see that we've got some product recommendations here. Crucially, the sales associate's able to push items into the mirror from their device. If you wanted to, you could simply use the mirror and pay and go. Your items would then be packed and dispatched to you afterwards.
Do you want me to turn you so you're looking outwards? Yes, please. How about there? First time we came out with B, Jade said, "It feels like I've been released from prison." Do you want these, Mrs?
Definitely.
Definitely. Right.
Yeah.
And she could say hello to everybody, people she hadn't seen for months.
It's
Hi, it's
Jade.
Jade.
Oh. So you can talk to Jade through this.
Hi, Katie. She's there.
Hi.
Every time anyone's seen her, they want to know why she's there. And it's kind of the opposite of when you're in a wheelchair and people see you and they kind of go, oh, should I look? I don't know what the right protocol is. When there's a tiny robot with its bright little eyes going around just looking happy everywhere, it really opens you up for conversation.
You've got some friends here, look.
Hiya! When I saw her for the first time, I remember thinking, this is going to change things. This is one of those points where if this was a book, this would be the cliffhanger. have a condition called Ehlers-Danlos syndrome, which means that I have a lot of dislocations, there's a lot of pain, and a lot of seizures and whatnot. So I can end up on my own in my room for long periods of time.
Yeah, my love.
A lot of the time with a condition like my own, of course there's the pain, and the pain is bad, and the dislocations are bad, and the seizures and being in paralysis and never knowing whether you're going to be able to wake up properly tomorrow, that's bad. But what's worse still is being able to count the number of people you see a day on one hand.
Are you ready?
Sure am, I'm just hoping the connection's going to stay.
Yeah, me too. Alright, here we go.
When you're used to just the same little metre by metre and a half window every day, and you've been there for months, being able to just see the sky from somewhere else, or the tops of trees, or a sign, is incredible. Or being able to have that kind of chat in the car that most people would probably take for granted.
I'm going to go past Grandma and Grandad so you can give them a wave. Now, if Jade is particularly seizure-y, she can still take part. And that's brilliant, really, because before she would just be left in a bed or in a house with just her carers. It's quite a small world, that.
Right, so there's one of her. Here, this costume I'm busy making at the moment. When I'm not on bed rest and I'm not just wearing pyjamas all the time, I enjoy being able to dress as different characters and go to Comic Cons and that kind of thing, because it just lets me show a different side of myself, and it's a bit of fun. If you can't go out that often, you've got to enjoy it when you do.
Was that? Good.
It's one of those weird things where I want to not have to use B because I want to be well enough to be able to go to those places myself. Like, it really makes a big difference to me to be able to go into school. But the thing is, with my condition fluctuating all of the time, I can't go into school reliably. Written out bigger on the pod, thank you. Today's the first day that I've been in school via B, and so far it's interesting. There's still a few little things that we need to work out, but for the most part I think it's going fairly well. And it's brilliant because I can really tell the difference between today and yesterday. How yesterday I forced myself to go into school when I wasn't very well, and I was really tired afterwards and ended up having loads of seizures. Whereas today I've been able to do all of the work, I've been able to keep a clear head and not be ill, which means I'm able to be more focused on my schoolwork.
So there is my first step of working, is to simplify root 8. The algebra test is next week.
Now I'm trying to make friendships which I'll be able to maintain with B. Before that, I end up letting people down quite often. B gives me hope, yeah. She's just always there. And if I can't do something, she can. And if I need sort of assistance to be able to make commitments, then she's there, and she means that I feel like a more valuable person because I'm more reliable.
When it debuted, the 4G wireless we have today allowed people for the first time to hit the road and explore unknown places with only a smartphone for directions. When 5G arrives, it could enable driverless cars to take us there as well. 5G stands for 5th generation mobile networks or wireless systems. It's insanely fast and can accommodate a lot more connected devices. But the reason it's being called revolutionary is because 5G will allow connected devices to speak to each other as well as people.
Right now we're living in a world where really it's a one-way experience.
That's Bloomberg tech reporter Ian King.
The network talks to your phone, you look at your phone and access data, then you send something back to the network. What we're being told about 5G is that really for the first time we're going to see machines communicating with each other over mobile networks in a meaningful way.
5G could end up being 100 times faster than what we have now, with speeds that could reach 20 gigabits per second. In plain English, that means downloading a full-length HD movie in seconds. 5G will also increase total bandwidth, which we will need in order to accommodate the growing Internet of Things. We're talking about the class of devices like internet-connected refrigerators, thermostats, dog collars, but 5G will enable many, many more.
Things like your utility network, factories, where machines are just sat there not connected at all. Suddenly they're all going to be connected. Suddenly we're going to be able to have real-time monitoring. Other things like cars, like utility poles, like your light, the light poles.
But perhaps the biggest advance will be a huge reduction in communication lag time, known as latency. A network of driverless cars will need the speed of 5G to ping each other multiple times per second to avoid collisions. Near instantaneous data transfers could allow doctors to perform surgery remotely with a robotic scalpel. So how will all this work? First, you need to improve network density.
And that's just a fancy word for saying you put more towers out there. What we're being told is that's not actually the case with 5G.
The idea is 5G will not only use the existing mobile spectrum, but also tap into higher frequencies called millimeter waves. Millimeter waves can carry more data, but only travel short distances. This may mean you'll see a lot more of these base stations around town. And the new towers may have as many as 100 antenna ports, compared to about a dozen on 4G cell towers. So when will we get 5G? Getting 5G ready is expected to cost providers $275 billion over 7 years in the US alone. Look for the first 5G service to pop up in big cities sometime in 2019.
The cubicle represents a tyranny. It confines your imagination, your thoughts, into a small physical area. Imagine pretty much every software engineer or finance person being able to, disconnect from their desk and look at holographic monitors on a beach and doing their work from there. That's not going to be science fiction. It's the modern office place.
Silicon Valley is all about building the future. A startup called Meta thinks it's getting there first, thanks to a big bet that it's made on augmented reality.
How are you?
Good, thank you. Welcome to Meta.
Thank you.
Call it a 360-degree office where you can spatialize your thoughts as part of your workflow for education, architecture, design, engineering, etc.
People often mix up augmented reality with virtual reality. VR totally blocks your ability to see or hear the real world. AR overlays holograms onto what you already see. Meta has tried to make its version of the workspace feel familiar.
You grab the hologram instead of using a controller or a mouse, and your brain already knows how to do it. In other words, we've designed an operating system that humanity has always known how to use. So you can see this eyeball, which is, by the way, photorealistic. You can see my hand is occluding the eyeball, and now the eyeball is occluding my hand, right? You see those two circles? They get small, and then they turn into this glowing white ball, and then I can move my hand around supernaturally. I can do this with two hands and rotate the thing. I can stretch it. I can throw it back right into the shelving system, and that's all you have to learn to become a modern worker.
And to prove this, the employees at Meta have started to get rid of their computer monitors, trading them in for Meta's augmented reality headsets. Mayron thinks that in less than a decade, we'll all be just wearing strips of glass that can project holograms.
In the early 80s, everybody had computers on their desktop, but no one was using them because they had a lot of work to do. So they were still using typewriters. And at some point, the CEO took all the typewriters away and everybody was forced to use their computers. So it's very exciting to see a new generation of technology, a new paradigm.
I consider us like pioneers in the holographic wild. I'm pulling up my browser with my hands and sending out emails to colleagues and just kind of really acclimating to the new environment.
Now you're putting on my computer, essentially. Our digital lives live on our phones. We have all of our pictures and notes and all these kinds of things. So why don't you write yourself a little sticky note? I like it. And go ahead and just take your fist right over the top of the sticky note and close your fist. And now...
Oh, what? Meta's own transition to augmented reality has run into plenty of unexpected problems. And it's still going to be a while before you'll start to see these devices in your office. But I think it's worth waiting for.
If we could see these holograms between us, we will have been able to share our work with one another more naturally, more efficiently, and more productively than ever before. Humanity will have evolved slightly.
This is Hatsune Miku, Japan's sensational virtual pop star. She's released over 100,000 songs in multiple languages and performed sold-out concerts around the world. Her image has appeared in games, on TV, in car races, and is even etched on the side of a Japanese space rocket.
I came for Hatsune Miku, Carlos.
She's Lady Gaga's favorite digital pop star and opened shows for her in the US 3 years ago. Tens of thousands of fans attended her exhibition and live shows near Tokyo recently.
理想のアイドルっていうと、どの曲でもミクはすごい綺麗に歌ってくれる。
他没有缺点啊，没有任何让我们感到不开心的一些新闻。
She's everything to everybody. That's probably why she's so popular.
Miku's creator Hiroyuki Ito and his Sapporo-based company have been developing the virtual diva for over 10 years.
初音ミクとは、キャラクターとしてすごく、YouTube とかで検索すると、たくさんの初音ミクが出てくるんですけども、元々の、初音ミクのその原点は歌声を合成する、ソフトウェアなんです。
Both the software and character are named Hatsune Miku, meaning the first sound of the future. Originally based on Yamaha's Vocaloid technology, Miku the software has a sound bank containing voice samples and a huge array of tools. You input the melody and lyrics, then Miku the character sings them. To date, Krypton has sold 120,000 software licenses at $200 each to fans around the world who use it to create numerous songs and share them online. Some of the fan-created songs are chosen to be part of Miku's concerts, for which they're paid a royalty fee.
もともと初音ミクっていうその、存在自体がそのボトムアップって言いますか、中にはアマチュアクリエイターじゃなくて今もうすでに、プロになって活躍している方もいらっしゃるんですけども。
The company also has other revenue streams. It makes money from merchandising, licensing deals, and concert ticket sales. According to the real-life musicians who perform with Hatsune Miku, the virtual pop star is interesting and surprising.
今年で3年ぐらい、ちょうど3年ぐらいになってきて、ライブも数十本、数百本だったの。そういうことが演奏によって起こせるための、そういう器みたいな感じになってきて。初音ミクらしさって僕はあんまりない。初音ミクって何だってありっていうか。
For Ito, Miku has the potential to change the way we think about music.
そういう新しいそのテクノロジーによって新しい音楽のあり方っていうものを模索していきたいと思っていました。
And for her fans, it goes even further.
初音ミクって魂がないので、だからみんな魂を作り上げるために存在する。
Now, there are a lot of fitness gadgets out there. In my quest to get fit, I tested 17 of them over the last few months. At least one personal trainer I know was a little bit skeptical.
Yeah, I've been watching these new technologies come to the market for almost as long as I've been a personal trainer. They're just tricks and tropes. They're not much different than the Bowflex machines or, to be honest, the original Jane Fonda workout video.
But some of these gadgets that are just coming to the market do so much more than what they used to do, just tracking your activities. Out of all of them, this chest strap was my favorite. It comes with a robot coach that points to the future, one where you might not need a human trainer at all. And it works like this. You wear the chest strap so that it can read your heart rate, and that connects to Move's free app that talks to you.
Welcome to Move Heart Rate HIIT Outdoor Running. Let's get moving and warm up in Zone 2.
Move's computerized coach tells you what to do at that exact moment, whether you're running outside or you're doing body weight exercises indoors.
Swing your arms faster to get your legs moving quicker. Let's crush this round.
And by reading your heart rate, she knows exactly how hard you're working. She keeps you honest.
Way to go, you are in the target zone. Keep pushing, you're almost at the end of the round. Don't give up.
I've been running for 7 years now, and my biggest problem is that I never push myself hard enough. I end up going on the same slow, comfortable 30-minute jog, but the Move HR Burn blasted me out of that rut. By the end of these half-hour exercises, I was drenched in sweat in a way that I never am when I work out alone. Training with a real person is great, whether that's your group instructor or your coach or your personal trainer, but humans, they're expensive. For the rest of us, this $60 gadget is all you need.
what does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, U.S. Navy, and other branches of the U.S. government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hack emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning. He used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the Collateral murder video.
Come on, fire!
It was a vivid, graphic video. It changed the debate on the Iraq War, and importantly, it put WikiLeaks on the map when they put it online, and they couldn't be ignored at that point.
And those leaks were just the beginning. They went on to post more than 90,000 leaked documents known as the Afghan war logs, 390,000 documents known as the Iraq war logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats who faced real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the U.S. government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped at the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft to the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons, in all fairness. Don't you think?
Once WikiLeaks started exposing secrets of the Democratic Party, Julian Assange became a hero to many on the right. Public opinion kind of flip-flopped.
WikiLeaks!
From the emails, we now know Hillary Clinton's campaign manager makes risotto, and also how the DNC squashed Bernie Sanders' campaign. One thing we don't know is who gave Assange the stolen emails in the first place.
Many leading Democrats say they suspect it was the Russians. They released an analysis from a private cybersecurity firm that had said it was the Russians.
But Assange claims
our source is not the Russian government, and it is not a state party.
So this is where we stand today. The public still doesn't know who provided the emails to WikiLeaks. Meanwhile, Assange is still running WikiLeaks and still releasing documents. In March 2017, he started publishing documents from the CIA's Center for Cyber Intelligence called Vault 7.
The CIA, the agency charged with finding and keeping our top secrets, can't keep its own secrets.
As long as Assange has a connection to the world, no government secret will be too far from exposure.
Julian Assange is still in the embassy. Maybe he'll leave, maybe he won't. Kind of regardless, his work has been done. He's changed the way people think about their governments, about their own secrets, about their own hackability, and really the world has changed because of him.
I'm about to expose everything you won't admit. And action! This entire video is based on a true story. When I do like motivational speeches or even tell myself like, love yourself and you should love yourself.
This is Lily Singh.
But to fans all over the world, she's the YouTube star Superwoman.
What up, everyone? It's your girl, Superwoman. I know we can change the world for the better, one positive day at a time.
My parents now know what I do. They didn't know what I did for a long time in the beginning of my career. I was just making videos in my room. They had no idea.
Mom, Dad, have you seen my keys? I can't find them anywhere. Because you're always on phone.
Until someone called them, like a family member from another part of Canada, was like, Canada, is your daughter making videos? And the mom was like, I don't know, Lily, are you making videos?
Just making videos grew into an entire career. Today, Lily's YouTube channel has some 12 million subscribers, over 2 billion views, and guest stars like Michelle Obama, Dwayne "The Rock" Johnson, and Seth Rogen.
I think a lot of young girls are raised to believe that you're gonna go to school and then graduate and then get married and then get a job and have kids.
And Lily was on that path, all the way through a psychology degree at York University in Toronto. But when she started thinking about a career,
I started to immensely panic and think something was wrong with me because I tried to figure out my life and it wasn't working in that straight line.
It was 2010 and YouTube was only 5 years old.
I thought nothing of YouTube. I was probably the last person in my circle of friends to discover YouTube. And I remember when I did, I thought, this is so strange. There's people making videos in their rooms and other people are watching them.
So she figured, why not give it a shot?
I one day posted a video because I was sad and I wanted to be creative and happy.
She didn't know how to edit video or write scripts, so she winged it.
It was so bad and so cringe, and my expectation was literally nothing. I was like, I'm gonna put this video up, a couple of my friends are gonna watch it, probably make fun of me, and that's gonna be the end of this. The second and third video came from, wait, 70 people watched my first one, can I get 80 to watch the next one?
She kept creating, she kept posting, and the viewers kept coming. Lily had found an audience.
A lot of the comments were, oh my God, there's a brown girl on YouTube.
More specifically, Indian. Lily's parents immigrated to Canada from India, and Lily was born and raised in Scarborough, near Toronto.
My home life was awesome. My parents, even though I portrayed them to be quite strict in my videos.
Oi, Lily, wear the rest of your skirt, huh? I teach you like this, to walk around like this, showing everything to everyone.
They actually aren't like that at all. They're pretty modern and pretty cool.
Your dress is short. Don't know what for.
And were pretty lenient with me. I mean, I got away with a lot of things. I was a brat. I was a brat.
She had a different idea of what she wanted out of life than other kids. In a grade school graduation slideshow, her classmates said they wanted to be lawyers and doctors.
And then I came up and I was like, rapper.
Making out with your friends, man. But then you say that you hate hoes.
I could just feel my parents being like, why?
Because that's just not something women really did in the Singh family.
I know there was a ton of people that weren't happy about my birth being a female, so I think, and that's some real-ish, but it's a real thing. The best thing I could have done to prove to so many people that didn't want my mom to have a daughter was to become Superwoman.
What up, everyone? It's your girl, Superwoman.
It was the name of Lily's favorite hip-hop song by Lil Mo featuring Fabulous.
I love the song so much because it was one of the only songs at the time that was an empowering female song, where Lil Mo's going on about like, I will save guys with my superpowers, and I will save girls with my superpowers, and I am the Superwoman. I thought, this name that I've had for so long that empowered me when I was younger, I'm gonna make this my screen name.
Maybe this should be a new series.
Superwoman didn't just burst onto the scene overnight with a viral video. It was a steady climb fueled by hard work.
The moment that I thought this is going somewhere and this could be a career was the first time I performed internationally. It was in India. And it was the first time where I was truly across the world and people knew my videos.
Singh has transformed herself from a bratty kid to an internet personality to a media mogul. She started a feature film, A Trip to Unicorn Island, in 2016. And her book, How to Be a Boss, hit the New York Times bestseller list in 2017 while she was on a 30-city international tour. Lily started out with the goal of getting millions of subscribers and financial security.
Hurry the hell up!
But after surpassing those goals, success has new meaning.
I really come to terms with the fact that my definition of success is what's the best legacy I can leave behind. And it's not the number of views and the number of subscribers. It is the number of people that can say, this girl changed my life or changed something in my life positively.